Right, good morning everyone. Hello. I'm not really known for my punctuality, so let's get underway at 9:06, shall we? Welcome, thank you all for coming. It's wonderful to see you here in Manchester. This is our 6th annual Manchester conference. First hosted an event here back in 2018, right here at the university, and it's with thanks to the university that we can be in this fantastic, beautiful space. We're right over the road from where the world's first programmable computer was invented as well, so it's brilliant being right at the forefront of innovation in technology today. So I just want to say a few words of thanks, first and foremost, and a little bit of housekeeping before getting underway. I'll also explain a little bit about the work that we do at FinTech North, and I'll give you a really quick run through of some of the activity that we see in Northern FinTech today. So just quickly, I've already thanked the university as one of our brand sponsors. I want to thank the team at NCC Group, Software Resilience, for their wonderful support as headline sponsors. There's a number of other amazing organisations that have helped bring everybody together today as well. So I want to say thank you to Manchester-based AccessPay, GFT, who've got a base here in the city as well, Mastercard. Obviously, I've already thanked the university. There's Rise, created by Barclays as well. Some fantastic organisations. Another thank you as well to the team at Marqeta for these fantastic recycled name badges that we've got today, and also the team at Intercash for supporting our pre-conference get-together last night as well. Other organisations worth giving a shout-out would be Innovate Finance, FinTech Alliance, Pro Manchester, the team at Midas, all of whom have been a fantastic support of ours promoting the conference to their communities as well. So there's a load of other people I need to thank as well. Ryan Walsh, our marketing and events executive, I think he's at the back, so you can't see him blushing there, but he's two years into FinTech North at the minute, so he celebrated his anniversary yesterday, which is amazing. And our newest team member, Rachel, who's probably downstairs manning the reception desk at the minute. She's a month in as well. So we're slowly and organically growing the team at FinTech North, and we really look forward to continuing to support the North's FinTech ecosystems. I mentioned a little bit of housekeeping. Obviously, the whole conference is taking place in one room today, which is great. We can keep everybody together to maximize the networking. You've all hopefully had your sticky tutorial with the networking as well, so hopefully that enhances that for you all today. Toilets are downstairs, pretty much directly below where we are now. There's also a ladies' toilet down the corridor there and a gents' toilet a level below that on the mezzanine. You've got teas and coffees and refreshments being served in the room today. We've also got Christie's Bistro down there as well. If anybody wants to sit and do some work and grab another coffee down there, that's absolutely fine. There's no fire alarm scheduled today, so please follow the signs to the fire exits if you do hear an alarm. So who are we, FinTech North? What are we all about? Primarily, we're here to do exactly what we're doing today. We're bringing together the FinTech community right here in our own back garden in the north of England. We're also here to develop the sector in the north, so supporting our entrepreneurs, our scale-ups with profile opportunities at our events or business development opportunities within our wider community and network. We're here to make sure that all of the development going on in the north of England doesn't happen in silos and it's part of a national landscape. Regularly, we're speaking at national events and international events, talking about what's going on here in the north as well. So we're making sure that there's a connection between the regional and the national. And finally, we do all of that in a neutral way that doesn't promote any one city or geography as the capital of Northern FinTech or capital of banking or payments or lending. We try and promote the North as one region because we believe that can really differentiate ourselves on an international scale. All of that's pretty big picture. How do we actually do that on an operational level? It's through things like this, bringing people together. You can't, impact business connections. You can't build relationships without getting together in one room. And primarily, FinTech North is a face-to-face community. So it's great to see so many of you here. Really looking forward to seeing some great conversations happening over the networking. And this slide just visualizes all of that really for us. I think the key point to mention here is the funding point. We get a bit of confusion sometimes. Are we an inward investment agency? Do we get public sector funds? We're entirely self-funded as an organisation, so we rely on the support of like-minded organisations within our ecosystem to come on board, take a partnership, sponsor an event, that kind of thing. So if you're interested in working with FinTech North, I'd love to have a chat with you today. You can reach out to us at info@fintechnorth.uk as well. So yeah, it'd be great to explore working with you guys as well. That'd be amazing. I mentioned some of our partners as well. This just gives you an idea of all the different types of organisations that we work with. We can add value at any stage of a company life cycle. There's everybody on there from regional FinTech startups right through to instantly recognisable global financial services brands like Mastercard, of course. So what's going on in the north? I'll just take you on a little tour, a mental tour from west to east. In Liverpool, in the Liverpool city region, there's a real strength in wealth management and asset management. a lot of these regional strengths go back to the city's sort of individual industrial heritage and past prosperity, which is really interesting to me as a proud northerner. Here in Manchester, long been a centre of retail and textiles and all of that trade, really strong on payments and e-commerce here. In the Leeds City region, there's a real strength in banking and lending. And up in the northeast, between Newcastle and Durham, there's an innovation corridor springing up with an emerging specialism in payments up there as well. So there's probably around 400 fintech firms across the north of England as a whole, generating around 2 billion every year for the UK economy. If the north was an EU economy, it'd be the 9th largest in Europe. So this patch is both economically and geographically vast. So it's about communicating that and kind of shouting about all the opportunity that's here on our doorstep, and making sure that people can see a career for themselves in tech, in fintech, right here in the north of England. So yeah. That's pretty much it from me. I hope to catch some of you across the day for networking. Brilliant to see so many of you here, and it just falls to me to introduce our fantastic long-serving chairman, Chris Sier, who's appeared from nowhere as if by magic. So thank you very much.
You promised me a handout. Okay, we'll try the handheld. Can you? Yes, you can hear me. Very good. Thank you, Joe. It's been an interesting six and a half odd years. This, I believe, is the 6th Manchester conference in this or a very similar venue close by. And what we've seen is a big change. The audience sizes have always been big, but we've gone from no employees, it was just me and Julian and perhaps Stefan, just trying to get things done off the back of an envelope, to Joe. And now we have 2 additional full-time employees who are funded by the surplus funding that we get from sponsors. So there is no revenue model other than the fact that if we didn't have an audience that was appealing, we wouldn't get sponsors, and if we didn't have sponsors, we wouldn't be able to run these events. But surplus funding pays for Joe and for Rachel and for Ryan. So it's been really interesting to see this company slowly grow. And I call it a company. It's not even a company, but it is nice to create something. So it's been an interesting year, hasn't it? Apart from the global geopolitical crises, of which I think we all have plenty of opportunity to reflect. I took particular joy yesterday at the rather chaotic announcement of a new cabinet, and particular joy to see that David Cameron had been appointed as Home Secretary, not because I like David Cameron, but because he was appointed to the Lords at the same time, and I could feel the anger emanating from Nadine Dorris's household at the idea that it was indeed possible to appoint someone to the Lords at short notice. Quite one of the most bizarre political commentaries that I've ever seen serialized anywhere. Nadine Dorris must have been absolutely outraged, and that makes me happy. So what have we seen in the past 12 months of note, specifically for our constituency, specifically in the world of fintech? And I've written some things down here. I may need to do this to read what I've written, but I'll kick off with the bond crisis at the beginning of the year. Now, the bond crisis, I think, passed most people by. It was something that went on, that happened to everybody else, but I cannot emphasize just how serious the bond crisis was. I may have mentioned this in a previous conference, but I was sort of sitting on point. My role is chairman of FinTech North. It's my vocational hat. It's the thing I do because I really enjoy it, but I'm also the CEO of a startup. Actually, it's not a startup, it's a scale-up. It's a proper company now. We have 30 employees that works in the asset management and pension fund world. And so I was right there watching what was going on. In fact, I was giving data and evidence to the Work and Pension Select Committee after the fact when they were investigating what actually happened. And you'll have heard words like LDI, liability-driven investment. And I kid you not when I say that the entire financial world nearly came crashing down around our ears as a result of the leverage that pension funds specifically held on government bonds in the UK. Some 4 or 5 times or more leverage over the bond holdings devalued bonds by so much that we nearly saw an entire crash out of the FTSE 100, 250, 350, as corporates who hold pension funds could sequentially have gone bust. Now, if you want to know more about the technicalities of it, then I'm probably the one that knows more than anybody else. There are a few people who know more, and I'm happy to talk about it, but I cannot emphasize how close we came to catastrophic financial meltdown. Cheerful, eh? We got our way out of it, though. The fix, it turns out, was quite simple. The Bank of England stepped in, said, grow up, everybody. We're going to buy back bonds and inflate the price. And all of a sudden, the leverage situation disappeared. But it took a very brave move by the governor of the Bank of England to announce a bond buyback program to get us out of that big pickle that we were in. So that was the start of the year. Great, eh? So what else has happened in the year that's relevant to us? So I think the next one I want to focus on is probably the reversal of the government's clean tech approach. You know, this is probably a source of some great disappointment to many companies, certainly in the north of England and some in the room today perhaps, but the idea that the government made commitments about net zero and has stepped away from them means that the regulatory backing for a lot of solutions that people in this room might want to create has evaporated. And this is disappointing. The good news is people are pretty cross about it, which means that it makes it all the more easy for you to win a market share if you've got something compelling. So just because they have withdrawn, if you like, legislative support and government support for a move to net zero doesn't mean that your proposition isn't going to be valuable. It just means that if you are differentiated and good, you become even more valuable and you're not part of a herd of other organizations. So please don't give up. But that's a big one. That's a big and disappointing one. And I think there are some questions that need to be asked about why that has happened. And yeah, some of them are not very nice. So what else have we had? What have we had? Well, there's obviously been a fall in VC funding. I mean, I felt this acutely. There was a point last year when I was trying to raise money for my company, Series A round, and it was tough. There was a period, I think we started probably the middle of last year, and by December I just shrugged my shoulders and given up. So I have some good VCs in my seed round anyway. Outward VC is an organisation I know that some of you will have met. They've just received co-funding from the British Business Bank. They are open for business. They're one of the few VCs that are. If you are looking for funding at seed and Series A, have a look at them. As I say, the money is being co-provided by the British Business Bank. They have a fund they're closing at the moment. They're interesting. I've got a very big international VC, Lakestar, and they were very clear. Money has dried up. We're trying to raise money. We can't. It's a very bad market. So I gave up, and I concentrated on one thing and one thing only. And if I were in your shoes and you were a startup, I would do the same thing. Get to break even. By whatever means possible, get to break even. It wasn't fashionable to do this a few years ago because the idea was VCs give you money to spend it, splash it around, grow quickly. Well, of course, all you're doing there is putting yourself in a leveraged and risky situation. Get to break even because then the monkey's off your back. So this is what I've done. I've got to break even. And that's a really nice place to be. I can sit back and go, I don't need to go and raise money. Raising money, by the way, is an absolute pig. For anybody who's raised money, trying to put together a data room for a VC that wants it in a particular format, and then the next VC wants it in a different format, and you've got to put together growth models and business models and contracts. It's horrible. It wastes your time. It's a real overhead. So if there's no real prospect of raising money, don't do it. If you can get to break even, you don't need to. So get to break even. And of course, as soon as you get to break even, what happens is all the people who said no to you last year want to come and ask you and offer you money this year, which is what's happened. So the trick here, if you're going to raise money, is a very simple one. Find the VCs that have recently closed a fund. Because right now, deploying money is hard. There aren't many good prospects out there. And if you've just closed a fund as a VC, you can be sitting on perhaps a couple of £100 million of other people's money and you can't spend it. And so what you do is you have to spend it, and so you lower the barriers to entry. And they come and find people like me who have broken even, who are much safer bets. Bear in mind, when a VC funds you, 90% of you will fail, regardless of how you feel about yourself, regardless of how they feel about you. They give you money, they're gambling. They're gambling that you will fail 90% of the time. So no matter how good you are, and you'll go along to these VC meetings and you'll meet 10 other companies, look at those 9 other people in the face and wave goodbye to 9 of them in 2 years' time. That's the bet they're taking on you, and the chances are it'll be you that fails. Don't be. Get to break even. However you can do it, and you won't fail. So all of those VCs that have been trying to deploy money now have spare capital, and they can't not spend it. Well, they're investors, they're LPs. their limited partners will come and take it back. And that £200 million fund they've raised will evaporate. So they're now a little bit desperate. There aren't many of them, some of them. I know some of them. I'm happy to point some names at you if you come and speak to me. I'm going through it at the moment because I just don't want their money. I don't want to dilute. I don't want to give away my company. I don't want anyone to have a board seat. Series A means that they'll put someone on your board, takes away your control. Right now, I make all of my decisions myself. It's lovely. I don't make much money. I break even. I've got some silent investors. Don't take on a VC that wants a board seat unless you absolutely have to. So my advice is if you really need money and you want to raise and you want to be part of that zeitgeist, yes, go raise it, but pick the VC. But if you don't need to, don't do it, break even. But you know, the bubble has burst. So this thing that we had, this zeitgeist several years ago of let's throw money at the growth economy, has burst. You've got Theranos, you've got WeWork, you've got FTX. These are companies that sold a message, and they've gone bankrupt. Some of the biggest corporate bankruptcies in history, and you know, you've got FTX in court, you've got Theranos in court, WeWork, I suspect it's probably only a matter of time. These are massive, massive failures of the VC model. They're massive failures of this growth, this exponential growth model, where if you throw money at the problem, all the problems go away, we can grow ourselves out of the situation. It's failure. So to bring us back to the UK, it was with some surprise that I saw the Mansion House speech. Who here saw Mansion House speech? Who listened to it? Listened to the Chancellor talk about the plans in the UK for the growth economy? Right, there were two broad themes. The first theme was, you know, let's pool assets. Let's go and take pension funds and pool them because there's benefits in pooling. I completely agree with that one. I have the evidence to do it. That's what I do. That's my job. But the idea that pension funds should invest in the growth economy is spurious. So this was the big deal. The big deal was we need to invest in the growth economy. We need to take long-term savings, long-term capital, your pension funds, your savings, and invest them in an economy where 90% of it will fail. Now, I talk to pension funds all the time. I've got 1,000 pension fund clients, and I can say that this idea that pension funds thrust their money into this VC economy is mad. As a pension fund trustee, if every year you have to report that 90% of your investment has disappeared, as a trustee with a fiduciary responsibility, that just doesn't work. It just doesn't work. I have no idea where this idea came from. And therefore, I wasn't surprised. The follow-up to the Mansion House speech, which was the King's speech, where many of these things would move into enactment, they would become parliamentary issues. None of this, none of the Mansion House speech was mentioned in the King's speech. So again, this impacts us, because we're all part of this growth economy. So on the one hand, the government's saying we should throw money at this world of the growth economy, we should throw money at private equity, we should throw money at VCs. Private equity, by the way, is not the growth economy. Private equity does not invest in the growth economy, it's the buyout economy. These are large companies that are being delisted, they're management buyouts. The growth economy is a VC. But nevertheless, this conflation of terms, the government wanted to see money taken from long-term savings and given to us. Ridiculous. I work in this space where all of my clients are pension funds. If I went to them and said, would you like to fund me, they'd kick me out of the door because of the risk profile of my company. I'm not quite a 9 out of 10 chance of failure anymore. I like to think I'm the 1 in 10, but nevertheless, I'm the wrong risk profile for long-term savings, which is why none of it made it into the King's speech, and none of it has moved forward into policy and regulation. So that would be another big one for me, would be the Mansion House speech. The final one I probably want to speak to is consumer duty. So this is much more of a regulatory thing. This isn't about policy. This isn't about the government stance. It's about the regulator trying to figure out how to protect the consumer. And consumer duty rolled out in June, much to the surprise of lots and lots of companies who were told about it 3 years ago and hadn't done anything. Now, we have a few experts in the room on consumer duty from the retail perspective. I think Georgina, put your hand up. Right, there she is. So Georgina sits on 2 fund boards, and so she has to deal with the practicalities of how these retail funds are sold to the consumer from the point of protecting the consumer. Consumer duty is all about making sure that you protect the consumer from their own actions, effectively. i.e. you understand what you're buying, you understand the risks associated with it, the costs associated with it. It's a massive piece of legislation. And it's not just about the operation or the organization that faces the consumer, because the responsibility backs down the supply chain. So you're a distributor, you're Hargreaves Lansdown. Consumer duty definitely impacts you. I'm the fund manager. I make the products that are sold via Hargreaves Lansdown, consumer duty sits on me, and so on and so forth. So all of those organizations in the supply chain of a retail-facing product are responsible for consumer duty, and this is the nub of it. They're not ready for it. It's already come into place. People are already getting fined, but it is the perfect place for fintech to focus. It's about data, it's about technology, it's about communication. And these are the things that we should all be good at as fintech companies. So I'll leave you with consumer duty as the final thing I'll talk about. I'll hand back to Joe now to introduce our next speaker. All I have to say is lovely to see you. I mean, it's great to see such a big audience. We have a very, very long day ahead of us, for which I apologize. But by the time we get to this afternoon, when we're talking to actual startups who are going to be here, not pitching, but describing what they do, giving themselves an opportunity to maybe practice in front of an educated audience, please, please ask questions. And I do this every single year, please ask questions, because the alternative is I'll ask the question. And I'm generally, because I'm curious, I tend to ask the really tough question that no one likes. I've been doing it a long time. I can usually find the weak spot pretty quickly. So try and ask questions. Piece of advice for you, if you're a startup that's in the pitching event this afternoon, find a friend in the audience, tell them the question that you want them to ask, and I will just give the microphone. Right? I'll do it, because I want the audience to ask questions. So set yourself up for success. And that's about as good a piece of advice as I can give any startup. Thank you.
So next we've got a welcome from the University of Manchester, Professor Dame Nancy Rothwell.
I'm very happy to welcome you today to the 6th FinTech North Manchester Conference, which we're proud to have hosted at the University of Manchester since the inaugural event in 2018. Since FinTech started to develop as a significant and valuable sector in the Greater Manchester regional economy, the university has been investing in this growing area through both research and teaching, while at the same time developing relationships with business and policymakers. As the only university to have a strategic academic partnership with Innovate Finance, the industry body for UK FinTech, we have a clear ambition to deliver research with real and relevant impact on industry practitioners and policymakers in financial services. In collaboration with Innovate Finance, Professor Marcos Zachariades from the Alliance Manchester Business School established the UK Academic FinTech Network to develop research agendas that tackle real challenges in UK financial services and in the fintech space. We're also bringing leading academic minds together to advance knowledge on digital innovation in finance, including applications of artificial intelligence, blockchain, and smart data in financial services. In 2022, we launched the Centre for Financial Technology Studies, based at our Alliance Manchester Business School. This centre focuses on advancing cutting-edge research on the role of digital technology in financial innovation, developing a broad range of specialist courses and bringing together fintech firms and financial services organisations from across Manchester and the UK via regular conferences and seminars. We also launched an ambitious recruitment programme which allowed us to hire some great academic talent, many of whom are here today. If you want to know more about the activities of the Centre for Financial Technology Studies at Alliance Manchester Business School and how your organisation can collaborate with the academics involved in the centre, please do take the opportunity to speak to us today. Our business engagement and knowledge exchange team, as well as FinTech faculty, will be available throughout the day in a dedicated drop-in space. We're pleased to see that today's conference will focus on the theme of trust in FinTech and financial services. It's very important to ensure technological innovation impacts society in positive ways. Here at the University of Manchester, we strive to bring social and technical disciplines together to produce research that makes a better world a better place. Aligned to this theme, our keynote academic speaker of the day, Dr. Andrea Lagner from Alliance Manchester Business School, will be speaking on his published research on how FinTech can improve financial inclusion and eradicate poverty. I hope you enjoy the day and that it's productive. Thank you. I'm very
Awesome to have the university support once again. So for the rest of this morning, we're going to hear from CFIT, the Centre for Finance, Innovation and Technology. We'll also be hearing from Mastercard and our colleagues over at Innovate Finance as well. So really looking forward to Janine joining the conference virtually, Innovate Finance's CEO. Before I introduce Ksenia from CFIT, I just want to hand over quickly to my director, Julian Wells. Julian, do you want to come and say a few words and just do a few introductions on behalf of Whitecap and FinTech North? That would be great. You can use the lectern or you can go for the handheld. Awesome.
Yeah.
Thanks.
Thanks, Joe. Morning, everybody. I'm going to be sort of chairing a chunk of this morning, so I'll be introducing some of the speakers. And I'll just take a minute to just say how brilliant it is to see you all here today. Thank you for coming. For those that don't know me, I'm Julian Wells. I'm director at Whitecap Consulting, and back in 2016, we co-created FinTech North in partnership with White Label Crowdfunding, which is a fintech company based in the North as well. Joe put the slide up earlier, 114 events later. It's been fantastic to see the momentum growing in everything that happens in fintech across the North and beyond. And I see that through FinTech North, but also through my role at Whitecap, where we're a strategy consultancy and I lead on financial services and fintech, and we do a lot of projects in this space. So the momentum in the sector is really clear to us, and I love coming to days like today to see that happen. Joe was talking a bit about FinTech North earlier, and one of the really important things is that we don't, as Joe said, we don't just focus on one region in the North or sort of align ourselves to one region. We represent the whole of the North. But the other thing that's important is that we link to what's happening nationally and also internationally. And so our next two speakers are a really important part of the agenda because they give you a flavour for what's happening across the UK, not just in the North. And so I'm really delighted that we've got Ksenia here from CFIT, and I'll let Ksenia introduce CFIT, but it's a new and very exciting and very important organisation for the UK's fintech sector, and one that all of us have a chance to become involved in some way, and a very interesting organisation to sort of be engaged with. So we're delighted to have CFIT with us today, and Ksenia, would you like to come and talk to the audience? Thank you.
Hello, everyone. Can you hear me okay? Yeah. Well, it's a pleasure to be here, and it's an honor to be addressing you today representing Centre for Finance, Innovation and Technology. Ksenia Grant, I'm the Director for Ecosystem and Partnerships, and I joined CFIT just over 2 months ago. We are a very new organization. And I'm delighted to have my first speaking engagement at the FinTech North event. We've been collaborating with FinTech North for a while, and we're really passionate about your mission and your work. And I'm also happy that this event is actually at the University of Manchester, as I'm a true believer that really successful fintech ecosystems need connections between academia and skills providers and the fintech sector. Before joining CFIT, I actually spent a few years developing such partnerships between fintech, financial services, and academia in Scotland, back at the University of Edinburgh. Just before I tell you more about CFIT, I think it's worth mentioning a few things about the sector. We really have an incredible success story here in the UK. FinTech is the single sector in which the UK is most globally competitive. In terms of FinTech investment per capita and as a percentage of GDP, UK is second only to Singapore. In terms of total investment, it comes second only to the US. And it is a success story that spans the UK. And Manchester and North of England is a fantastic example of that success. FinTech sector in Greater Manchester is the largest outside London. It employs 10,000 people, and it has experienced an incredible 67% growth over the last 3 years, with impressive core strengths in payments, lending, wealth tech, and accounting. The UK needs to maintain and enhance its position as a world leader in fintech innovation. Despite the progress and fantastic achievements all over the UK, I think some of you, or maybe all of you, will agree that some challenges still persist. We still have some fragmentation. There's high demand but low supply of some specialist technology talent, inefficient allocation of resources, especially if you think about London-centric focus in terms of investment, and challenges of scaling beyond the domestic market. So now a bit more about really CFIT. Those challenges I mentioned were really identified by the Khalifa Review of FinTech that was published in 2021. The Center for Finance, Innovation and Technology was created as one of the key recommendations of the Khalifa Review to drive forward the financial services and fintech sector's growth on a national and global scale. CFIT's mission is to unblock barriers to innovation, accelerate growth of the sector, and maximize economic development across all regions in the UK. As I mentioned, and the organization launched earlier in February, our CEO officially joined in April. We announced our first coalition in June and started really delivering on it in September. Our immediate priorities are delivering coalitions, and this is the model that you may be familiar from the Green Finance Institute. It came as one of the recommendations from Khalifa Review for us to adopt that model. So what are coalitions? Coalitions are really time-limited working groups comprised of experts from finance, technology, academia, regulators, policymakers, brought together to tackle specific challenges using research-led approach. We also focus on talent and skills, supporting national talent pipeline by building closer bridges between education providers and the companies, and developing opportunities for new skills training. For example, we are developing a pilot program, placement program in Wales that should start later today, and we hope then to develop similar initiatives elsewhere in UK. Ecosystem and partnership focus is really working with fintech hubs like the one here in Manchester and organizations like FinTech North, creating the conditions for national coordination by improving connectivity across nations and regions and showcasing local excellence nationwide. We are doing it to make the UK the #1 destination for fintech startups and scale-ups, and eventually also drive better financial outcomes for British consumers and SMEs, setting blueprint for financial innovation globally. Let me tell you now more about actually our coalition focus. Our main objective for coalitions is to unblock barriers to innovation by coming up with tangible outcomes and recommendations, to inspire, support, and give the right tools to the industry and sector stakeholders to take coalition findings further, build innovative products, and benefit consumers and SMEs. Open source nature of our outputs is incredibly important to us. Therefore, end results of all our coalitions will be widely available. Our first coalition focuses on open finance. And here you see some of the partners that are working with us. We really have brought some of the best talent across the country for this coalition. We bring partners specifically for the purpose and duration of the coalition. They provide high-level strategic insights, while our use cases, or what we also call working group members, focus on actually delivering the hands-on work of the coalition. and you'll see some of them here as well. So the larger companies usually become the strategic coalition partners, where fintechs more often work within our working groups. At the beginning of this presentation, I mentioned a few challenges that the sector is facing, so I think it's worth highlighting why we have decided to focus on open finance and why we see it as a fantastic opportunity for the fintech sector. First, let's consider the broader context. With the UK as a globally competitive fintech leader, we believe that the momentum is gathering around the opportunity for open finance and smart data economy. The upcoming Data Protection and Digital Information Bill is set to lay foundations for a smart data roadmap in the UK to include financial services. And momentum is also growing in the Smart Data Council within the Department for Business and Trade to deliver a cross-government vision for a smart data economy. JROC committee is committing to progressing the work outlined in their April report to taking open banking to the next level. And FCA is also interested in this space. Chief Executive outlined opportunities for consumers from increased data sets and a digital ID in his recent Mansion House speech in October. So just briefly, why open finance? Open finance represents the next phase in the evolution of financial services innovation. Obviously, it will build on open banking, which introduced the concept of securely sharing consumer data with trusted third parties. It encompasses an even broader range of financial information: savings, pensions, investments, insurance, mortgages, and other key aspects of personal finance. It revolutionizes how individuals manage their finances and interact with products and services. Consumers will gain a more comprehensive view of their finances and more personalized solution. Already a global leader in open banking, there is a key opportunity for the UK to assume a similar role now, setting global standards in open payments and data, and unlocking new avenues for scaling fintechs and trade. And why now? Obviously, Chris mentioned consumer duty, evolution of open banking is in motion, but there are also broader issues. UK cost of living crisis, really driven by persistent high inflation, is causing a lot of stress to consumers, with 77% reporting they were worried about the cost of living, and 1 in 2 UK adults reporting stress and mental health issues. We also have broader societal issues with aging population, with insufficient savings. Those approaching retirement age are almost 250,000 short of what they need to deliver their desired pension income, with a total savings gap of 132 billion. And UK homeowners' occupation rates are also hitting their lowest since 1988, with the home ownership gap at 5 million. So taking all of this into consideration, I want to tell you a bit more what we've been doing with Open Finance Coalition so far. To really show the impact of increased data ownership and data sharing, the first phase of Open Finance Coalition is focusing on showcasing how to deliver more accurate and accessible credit records and the positive impact this can have on credit decisioning. You might say, well, why credit, right? Open finance is broad. There are so many other financial products we could be tackling. But we believe, you can't boil the ocean. You have to start somewhere. And by providing the case for opening data for credit, we'll pave the way to opening data in other parts of the sector and delivering better outcomes with savings, insurance, and so on. Currently, credit scoring and lending decisions are made using traditional information on credit history, which in effect excludes those who have never taken or repaid credit. Through our work on removing barriers, we are making a case on how to incorporate additional data sets. For example, for consumers, they may be rental, utilities, and council tax payments. For SMEs, This could be data that could be shared more seamlessly, such as VAT, tax returns, or company's house information. This will improve credit decision-making and will lead to enhanced outcomes, such as increasing access to finance for SMEs, as well as boosting young people's prospects of a better credit score to allow them to rent their own home, buy a car using finance, or get on a property ladder through more accurate assessments of affordability. We're also working on several use cases, and it's probably the first time we are sharing some details on those. Those use cases are for consumers and businesses, and they will showcase how accessing and combining different data sets from multiple sources will improve credit scores and create better financial insights for improved credit decision making. We don't have time to talk about them all, but just briefly, these use cases include, for example, a tool combining over 250 different data sets to enable Citizen Advice Bureau to provide quicker financial guidance to consumers in financial distress, reducing time for customers' recovery to financial stability. For SMEs, we are developing a prototype to enable better lending decisions from utilizing non-traditional types of data on financial health of the business rather than historical credit records of only its directors for credit assessment. So just to wrap it up, CFIT will deliver a blueprint for open finance, an incremental pathway for how data sets can be unlocked and used to create value. We will provide the UK with a path to operationalize further financial innovation in the coming years, confirming how the industry can build on the outputs from CFIT's coalition. We will also recommend policy enablers and factors that would accelerate a move to open finance and help advance more affordable credit products. The blueprint will be a driver of our engagement and communication in the days ahead, and then we will be announcing on progress from this work at the end of November, where our interim report will be published, and our full recommendations are going to be published in February, 3 years after the publication of the Khalifa Review. And just to leave you with the message that our continued approach will be to energize the finance industry and other key partners to adopt our coalition work. Obviously, our final report will be published in February, but that's not it. We will be moving then to the next phase. Details are to be decided, but I encourage you to stay tuned, stay involved, reach out to us. I'm here for the rest of today, so really keen to speak to you, and so do reach out to me if you have any questions. Thank you.
Fantastic, thank you, Ksenia. And yeah, I encourage you guys to follow their social channels because they put out a regular flow of information, also photos from events and reflections from things that the CFIT guys are involved in. One of the things that we didn't mention earlier on is that as well as all the work we do directly at FinTech North, we're always keen to promote relevant things that are positive for the FinTech North community. And one of the things that's upcoming next year is the FinTech Awards, the FinTech Awards North, which Matt and Emma, if you guys, could you just stand up so everyone knows who you are? Come on, Matt. You're lucky I'm not getting you to come and do this bit yourself. Come on, stand up. So these guys, if you're interested in what's going to happen with the FinTech Awards North next year, have a chat with Matt and Emma today. They have run the FinTech Awards Wales, the FinTech Awards London, and the FinTech Awards Southwest over recent years, which has been a really successful programme that if you speak to anyone that's been involved in it, we'll talk very positively about. So we're delighted to have you guys here today, and it was good to see you last night as well. Right now we're going to hear from Max at Mastercard. Max, where are you? There you are. So no pressure, but Max was one of my favourite presenters last year. So in fact, you were right up there. But you couldn't be here in person, could you? You were only here virtually. So it's really great to have you here today. And also Darren and the Mastercard team one of our biggest supporters. So thank you very much. Welcome, Max.
Thank you. Thank you. Good morning. No pressure. Thanks for that. But yeah, thanks to the organizers for putting on such an impressive event. Really good to be here with you today. So I'm with Mastercard, and I'm going to be talking to you today about what we see happening in the economy, how that's affecting the consumer. Who am I to speak about this? I'm part of the data and services practice at Mastercard, so we have a whole range of services that we provide beyond the traditional card payments that Mastercard is known for. And within that, I'm personally part of the Economics Institute. And what we do there is we're a team of economists and data scientists, and we both look at the official economic data that everyone has access to, but we also harness the power of our payments insights to identify unique trends that can be useful to our clients, who can be retailers, or can be issuers or acquirers, anyone who's trying to better understand consumer behavior, those sort of things. And I think this audience would be really well placed to understand the power of payments data, because if you look at traditional economic data, it's sort of like navigating with a paper map. It's very easy to interpret. Everyone knows how to read one, but it's not updated frequently. You can't zoom in. It's not real time. And you have to wait for the next iteration to get a new update. Payments data, it's sort of like navigating with satellite data, where it's incredibly granular, it's real time. You can have incredibly customized view, but it requires some expertise and capability to know how to interpret it, to know how to capture it. And that's what we do at the Economics Institute, and that's what Mastercard Data and Services do more broadly. So just with that as a background, I'm going to talk about the three key trends that we're currently seeing in the UK economy affecting the consumer. So the first one is that the consumer is resilient, and this is maybe sounds a bit odd coming in the context of the cost of living squeeze, but it really is striking how resilient the consumer has been in the face of the extraordinary headwinds that we all know very well about, both in our lived experience and in the news. This has been driven over the past 12 months by the very strong labor market. That's really important in supporting consumer spending in general. Even when inflation is very high, if the labor market is doing well, that's really supportive of consumer spending. And now we finally have some real downward momentum in inflation, and that's going to start to improve purchasing power. And so that's going to be a real tailwind going forward. The second point is on the affluent consumers. And the affluent consumers were really those that were propping up spending during the cost of living period because they were able to absorb higher prices. Now they may be the segment of consumers that feels more of a squeeze than elsewhere because of higher interest rate environment, higher mortgage rates, and mortgage holders tend to be more affluent, they tend to spend more, so that's going to be a really different environment going forward. The last point is on what consumers are spending on, and the big story for the past 2 years since reopening from the pandemic was spending on experiences, going back out in person, and that did extraordinarily well, both in travel and hospitality, and just in anything that was social facing. And then people were sort of shunning retail goods, a bunch of things we spent on when we were stuck at home early in the pandemic. Now both those trends are starting to normalize. There's still a huge craving for experiences. So especially for perspective of retailers, combining experiences in their selling of retail goods is really important. That's what we see in the payments data. So I'm just going to illustrate now each of these 3 points. The first of that is how consumer purchasing power is starting to improve. So if you look at inflation in orange there and wage growth in blue, you can see obviously the huge gap that emerged over the past 12 months, and that's basically cost of living squeeze. You have prices rising faster than people's incomes. And now that is just about starting to ease. So we now have wage growth that's rising faster than prices. And as inflation keeps coming down in the next few months, that gap is going to start to widen, and you're going to have people's wages growing significantly faster than prices. We're only at the start of that process. If you asked anyone probably if they really feel like their purchasing power has improved lately, they would say absolutely not. So it's going to take a lot of time, several months, several quarters, for that really to start feeling impactful on people's take-home pay. But that is where we're headed, which is a real positive story given what we've been through in the past 12 months. And that's really important for consumer confidence, which is the chart on the right there. So it's been really extraordinary how low consumer confidence has fallen during the cost of living squeeze. You can see that trough there in late 2022 that was a record low. That was lower than in April 2020 when we had no idea what would happen in the pandemic. That was lower in the global financial crisis when people were losing their houses and their jobs. So it just gives you an idea of how much people dislike high inflation. And the reason for that also is because it's something everyone experiences. No matter their situation, everyone experiences higher prices, and particularly in the petrol stations and grocery stores. So it's a broad experience that people really dislike, obviously spending more and more and getting less for their money. But you can see as inflation has started to peak and slow in the last few months, you can see that consumer confidence starting to improve, and we're sort of halfway back to recovery from the lows caused by the cost of living squeeze. But we're now sort of plateauing. You see there's sort of a stagnation in consumer confidence. And the reason for that is we're still not back to normal. And the main sort of remaining trend is that interest rates have risen a lot. They're a lot higher than they have been in a long time, and they're sticking higher now for a while. And that is causing this affluent squeeze that I was talking about. And illustrating that here through, these are average direct debit payments for your utility bills and mortgage payments. And I'm showing the increase in those payments since 2021, since the start of the cost of living squeeze. So you can see in orange there how utility bills, people were spending £90 a month more on their energy bills at the height of the energy crunch last winter. But now that's started to ease, and now people are only spending £65 more than they used to. So that's a bit extra purchasing power that people have, and that's something everyone experiences because we all have utility bills. And it disproportionately helps people on lower incomes because they spend a higher proportion of their income on essentials like food and energy. The flip side is mortgage payments are rising steadily, and they're going to continue rising. So you can see the average mortgage payment is £180 more than it was at the start of the interest rate hiking cycle. And that's going to continue as people roll off their fixes and refinance. And that increase can be much, much bigger depending obviously on the size of the mortgage. But as I said at the beginning, if you look at the population, households with mortgages, first of all, it's only a third of households. So it's a very targeted group. And it's a group that tends to have higher incomes and to spend more. So going forward, we're going to be in this cost of borrowing squeeze that's going to be affecting a very different part of the population than the cost of living squeeze did. And that's really important for a lot of maybe some of your clients in this room who depend on the spending and preferences of more affluent consumers. So that's a real trend, and we're sort of at this inflection point now when it comes to this. In terms of how this has affected consumer spending, you can see how across all of these markets, the discretionary spending of your standard card holders, so people with regular card products, was squeezed much more than for affluent card holders. In fact, you can see there in Czech Republic, in the UK, affluent card holders even managed to increase their discretionary spending during the cost of living squeeze. So it just shows they have disposable income, they have savings, they were able to spend on what they wanted to, get back out there and travel. While other people had no choice but to cut back on discretionary spending. Now that's going to change. So some of those big declines in discretionary spending for your standard cardholders, there's some headroom there for that to recover, and that can then be directed more towards other areas. So that's going to be something to look out for. And I'm just also showing these other countries to show that the UK is not really an outlier. It's this really common experience across Europe. The other trend that we saw in consumer spending, and this is somewhat counterintuitive, is that higher inflation led to lower ticket sizes, lower average spend per transaction, particularly in high inflation categories. So what I'm showing here is how ticket sizes are lower now than they were in 2019 across all of these markets, with the exception of the US, which I'll explain. And that reflects people managing their budgets by spending more frequently, but spending less when they do spend, to try to manage that cash flow, avoid wasting, avoid buying too much. That's particularly visible in grocery, but also in restaurants, also petrol stations, sort of essential sectors. And it was obviously more impactful for less affluent consumers than affluent consumers, and you can see that in how the ticket size fell more for less affluent cardholders. The US really stands out there, where you actually have an increase in ticket sizes, and actually less affluent cardholders increased their ticket sizes even more than affluent cardholders did. And that just reflects that, you've all seen how the US economy is outperforming right now. much more government spending in the US in response to the pandemic, directly putting money in people's pockets, and that's translated it into much stronger spending momentum there. So the US is a bit of an outlier, different trajectory than basically the rest of the world, the rest of advanced economies. UK, quite similar again to other European markets. This has been really important for a lot of retailers, impacting their loyalty programs, how they retain consumers if people are shopping around more. Now that there's going to be less pressure on people's wallets, it might be an opportunity to increase some of these ticket sizes. So that's something we're looking out for now as inflation starts to slow. So that was the decisions people were making when they spend, in terms of what they spend on. This year is showing insights from our Spending Pulse product. This is based on Mastercard card spending, but then we incorporate external sources to model spending in all payment types, other card payments, cash, etc. So it really tries to capture all spending in the UK. And I'm showing there 2022 and then this year, year to date. And you can see last year the massive outperformance of experiences, of spending on restaurants and lodging, things like that. Obviously, that was the reopening boom. And then you see the really strong increase in spending on fuel and petrol. That was just a big increase in petrol prices. And then you see the underperformance of things. Again, as I was saying, we spent on all those things when we were locked down. There was less interest in spending on that last year. This year, this is starting to normalize somewhat. You have negative spend on fuel prices, and that reflects lower petrol prices than last year, and that's great because that's a little more purchasing power for people. You also see how experiences are still very much outperforming, but the growth rates are less frothy than they were last year, and that's just because those growth rates are impossible to sustain. Now that we're back to pre-pandemic sort of habits, those growth rates are going to come down. It doesn't mean that experiences are doing badly, it's just that they're normalizing. And then you have things also normalizing as well, less of an underperformance there. And we've seen also a shift in preferences. If you look at consumer surveys and ask people in the context of cost of living squeeze, what are your priorities of spending? Last year, it really was very clearly travel, holidays, going out. Now it's starting to shift where clothing, apparel, beauty, some more retail goods are coming to the top of people's priority lists. So maybe sort of, again, maybe a normalization after the huge vacillations coming out of the pandemic. So that's the big picture of what people are spending on. What's interesting is to look within sectors, the different scales in the marketplace. This here is an index of looking good spending. We call it our Bella Figura index. So it's anything related to looking good. So spending in retail categories like clothing, watches, jewelry, luxury, those sorts of things across the largest markets in Europe. And we clustered businesses together based on whether they were mass market, mid-market, or luxury. And what happened during the cost of living squeeze, we had this dumbbell economy that emerged, where you had low and middle income consumers trading down, focusing their spending on mass market, affluent consumers spending on luxury because they can afford to, and that was their preference, and the mid-market there was really squeezed, and that has really underperformed during this period. Now we're starting to see this trend start to shift slowly because of the trends I mentioned earlier. You might have seen luxury groups reporting softer earnings in Q3 of this year. So some of that strong momentum that was supported by affluent spending is starting to ease somewhat. And now we're on the lookout for, as your low and middle income consumers get a bit more purchasing power, maybe they will trade up, maybe the mid-market will benefit, or maybe they'll hop up to luxury and buy in small luxury doses. We've seen also evidence that there's real demand for value in terms of like high quality value from consumers, where they're spending small amounts but on very luxurious brands. So there's a lot going on under the surface beyond the headlines of cost of living squeeze. This has a lot of implications for maybe some of your clients who are retailers or people who are dependent on consumer spending trends. Obviously, a lot of implications for loyalty. So as I mentioned earlier, during the high period of food inflation, we saw people start to shop around more. So we saw an increase in the share of cards that were shopping at multiple merchants in the same sector. So here I'm showing grocery, but this was also very visible, for example, in petrol stations. When petrol prices go up a lot, people start going to different petrol stations to find the best deal. And that responds very quickly. Now that petrol prices have been lower in the past summer, we immediately see that loyalty behavior shift. And then people are just, there's less pressure, less incentive for them to shop around. They tend to then just stick to one petrol station. But that same principle applies to other sectors as well. So grocery, that certainly is going to be a shift in behavior over the next 12 months as food inflation slows. And so the loyalty proposition is going to shift in terms of of getting people the best deals to try to get them in the store, to getting, maybe it's easier to retain, and then the focus becomes more on getting people to spend more when they do visit. So that's definitely been a big topic when we talk to retailers. I thought I had one more slide. The other slide that's not included here was just a shift on how the days of the week people spend across different sectors, which has been really interesting to look into. There's been a real fall in the share of people spending in the middle of the week on Wednesdays and Thursdays across any sector, whether it's retail, whether it's restaurants. And in some sectors, it's meant even a greater concentration of spending on weekends. So if it's electronics or clothing spending in person, that made the weekend peak even greater. If you look at grocery spending, it's actually smoothed it out more, with people maybe working from home more, going to the shop during a weekday and then not having to do the shop on the weekend. And if you look at restaurants, what's really interesting is both in person and online, there's been a greater concentration of spending on the weekends. So when you maybe used to do takeaway just as a meal with not much thought into it, now it's almost treated. You might do a takeaway as a date night or just a real treat, and we've seen that increase on Fridays and Saturdays, along with in-person restaurant spending. So the point here was just on how important it's become for our clients to be able to meet the customer when, where they want to spend, and have data and insights into that, because people are shopping, they're starting their experience online, they're moving in person, but they might still want delivery. There's a real blurring. Of course, omni-channel has become the buzzword. And that's something, again, it's just very visible across sectors. And whether you're playing in e-commerce space, whether you're trying to provide consumer insights to clients, this is something that we've come across very much. So I'll leave it there. I think just to conclude, what we found very striking during this period of the last few years is how payments insights has really highlighted the structural changes in consumer behavior in the economy. And these are things like spending on experiences or granular changes in consumer behavior that you can't see in official economic data. So it has served us very well during this time, and I'm sure and again, this audience would appreciate that. So thanks for your time. Hope that was useful.
Well, that was great. Thank you, Max. I think it's always brilliant to have an economist speak at an event like this to give you that broader context. And obviously, Mastercard have got such a unique view of a massive data set that they can use to tell that story. So thank you again. So we're now going to go back to the sort of the fintech ecosystem, the fintech sector, and that national view. We heard from CFIT. We're going to hear from Janine at Innovate Finance in a minute. Janine could be with us in person, but we're delighted to have her join virtually. We've also got Peter Canane here today. Peter, can you just stick your hand up and say hello? So Peter's one of our sort of greatest friends and allies at FinTech North. He convenes the FinTech National Network Group, which also includes all the other regional FinTech organisations like FinTech Scotland, FinTech Wales, FinTech Northern Ireland, FinTech West, Supertech in the West Midlands, and we meet every couple of weeks and we communicate with each other and compare notes on what's happening across the UK, and it's a really valuable forum. And so thank you, Peter, and you're also on standby just in case this doesn't work out, aren't you? So, Janine, but you're laughing, which means you can hear us. Can we hear you?
Yes. Yes. Can you hear me?
We can.
Good.
Fantastic.
Although I have to say, I think you'd be better off if it doesn't work, because Peter is a great speaker as well. But you've got me now. But please do hear from Peter later.
Yeah. Just before you start, Janine, you guys at the back, if any of you want to sit down, there's quite a few seats down. You can't really see them from where you are, but down here on the front left, there's about 20 seats there. If you want to come and grab a seat, so feel free. Don't be embarrassed. Come and sit down and enjoy the conversation with Janine. So, Janine, sorry we can't have you here in person, but I'm just going to hand over to you now and let you give us an update on what you guys see happening in the world of fintech.
Right.
Thank you.
Thank you, Janine. Thank you so much, and thanks to Joe and the whole FinTech North team. I have to say, I'm really sad that I can't be there because I absolutely love the energy at your events, and I'm really disappointed I'm not there in person. But excited to have been invited, and really pleased to tell you a little bit this morning. Firstly, about Innovate Finance and what we're seeing in the market in terms of some of the key trends and the state of fintech, and then talk a little bit about what we see as really critical to progress this momentum that we have as the UK fintech ecosystem. So I'll start out, just give a very brief background. I mean, Julian mentioned the FinTech National Network. We at Innovate Finance are so pleased and so proud to be a part of that with all of our peers across the UK. Innovate Finance really is the industry body for UK fintech. We launched in 2014 off the back of a government consultation, but we were set up to be a completely independent entity so that we could lobby and advocate on behalf of the sector. We are a not-for-profit membership association, and we bring together a very wide spectrum of members across the ecosystem as part of our community. We represent early-stage fintechs through to your very high-growth fintechs, including the likes of Revolut, Monzo, Starling, Klarna, Zilch. And we cover all fintech verticals, such as your more traditional plays like P2P, FX transfers, through to artificial intelligence, cybersecurity, regulatory technology, and insurtech. And then in addition to that core fintech ecosystem, we also have a number of the large traditional financial services as members, including the Barclays, the Lloyds, the Citigroup, as well as some of the large tech firms such as Google, AWS, and Apple. And then we have some key consultancies and professional services firms that we work with to really drive the agenda forward. And I want to mention a specific partner of ours, which is we run something called the FinTech Academic Network in collaboration with the University of Manchester, which is specifically about driving thought leadership that can promote the forward momentum of fintech. So we're really, really pleased with that engagement and in bringing practitioners and industry together with academia to drive the continued momentum of our sector. So, Innovate Finance, we look at really 5 key priority areas, and the reason we look at these areas are because it is what the fintech ecosystem have told us matters most to them. So the first one, and I should add this is in no particular order, but the first one is around investment, growth, and partnerships. And we do a lot of work on both early stage investment, so connecting fintechs with those investors, and we do quite a significant amount of work on late-stage investment. And some of you will have seen the Mansion House Compact that was signed over the summer and delivered by the Lord Mayor, which was really enhancing pension funds in the UK's ability to invest into high-growth companies. And this is something we've been advocating for a very long time and worked closely with the Lord Mayor, because ultimately it is the fintech sector that will benefit the most from that here in the UK. We see a lot of pension funds around the world investing into our own sector, but our own pensioners weren't benefiting from that. So we're delighted to see now that the UK pension funds will be investing into that space. Within the investment, growth, and partnerships, we also do a lot around fostering stronger partnerships, both on a fintech to fintech basis, so on that marketplace effect, but also looking at how fintechs and large institutions can work more closely together. So identifying those obstacles, overcoming those obstacles, and also providing incentives to see that collaboration continue forward. Because we are a big believer that if we're looking to a better financial services sector in the future, that needs to come both from disruption and also from collaboration as well. Our second priority area is around skills, talent, culture, and governance. And I'll talk a bit more about diversity at the end of the session. But part of what we hear from our fintechs is such a pressing issue at the moment is making sure they have access to the great talent that is out there. So making sure they have access to a phenomenal pipeline of talent here in the UK, but also access to that international talent from all over the world. So we work with the Home Office and we look at fostering things like the Scale-Up Visa to offer that access as well. And then we have a strong program around driving greater diversity in the sector. We have a very active Women in FinTech program. We are just about to launch our Women in FinTech Power List, open for applications in the next few weeks, so I do encourage all of you to apply. And we have just released our very first Pride in FinTech Power List as well. And we work across all areas of diversity, so neurodiversity, ethnic diversity, racial diversity, socioeconomic diversity, and beyond too. And then our third pillar is around international connectivity and scaling. At Innovate Finance, we run something called the International FinTech Group that we co-chair with the Department for Business and Trade. And we bring all of the FinTech National Network into that because we want to be promoting the great hub that is UK FinTech all over the world. And so we make sure through that group that we have a cohesive UK presence at major global conferences such as Money 2020, Singapore FinTech Festival, Web Summit, and other events throughout the course of the year. And we also at Innovate Finance run a US program to help our members scale and to encourage more US fintechs and more US investors to come into the UK as well. Our fourth priority area is around fintech as a force for good. And I'll talk a little bit more about that in a moment. But we are incredibly passionate as a sector to create a more inclusive and a more democratic financial services sector. And that really is our mission at Innovate Finance, is to support the next generation of technology and led innovators to create that better FS space and put the consumer back at the center of the proposition. So we run a FinTech as a Force for Good forum in October of every year. And we also do a number of thought leadership pieces with our partners, EY and Accenture, on the role of FinTech in terms of the cost of living crisis, and also the role of FinTech on creating a broader impact, which I'll again talk a little more about in a moment. And then the fifth priority for us, which underlines all of the work that we do, is around regulation and policy. Because we, as the voice of UK FinTech, are advocating for an environment here in the UK that allows FinTech to thrive. We need a regulatory framework that is protecting the consumer, but equally we want the British consumer to be able to access the benefits of all of this new technology. So finding that balance is really core, and it's something that we work very closely with government all the way through to number 10, and also with the regulators, including the FCA, the PRA, and the PSR, to try and deliver on as well. So that's a little bit about Innovate Finance. And I want to give an overview really quickly of where we are in terms of the state of FinTech here in the UK. And every year, Innovate Finance puts out an investment landscape that looks at where the money is going into FinTech here and on that international basis. Now, in 2022, despite economic turbulence and a cost of living crisis, we still saw more than $12.5 billion US being invested into UK FinTech. That is second in the world only to the United States. And to put that in perspective, that is ahead of more than the next 10 European countries combined. So not only are we the global leader in Europe for FinTech investment, but we are a global leader second only to the US. Now, we did see a drop in 2022, which is to be expected from 2021, but I think there were such high valuations in 2021, many point to it as really an anomaly of a year. And in 2022, despite the economic crisis, we still saw more investment pouring into FinTech than any other year prior, which is a real testament to the strength of our industry and that continued momentum as well. A few weeks ago, we did an assessment of the first half of this year, 2023, because we know it's been a difficult year for the sector. We found that in the first half of 23, $2.9 billion US was invested into UK FinTech. Now, that is a decline from the second half of last year, but what we've also seen is that the United States has started to tick up in their investment. And that is generally a reflection. We tend to be here in the UK about 8 months behind the US. So we do expect that next year, by H2, we are hoping to see that tick up as well. I will also add, on a global basis, in 2022, we saw around a 30% average drop in fintech investment globally, but the UK saw less than a 10% drop. And again, I think that really is a testament to the strength of our sector that we have here. So let's move slightly away from investment and look really at the impact of fintech and the state of fintech in the UK. I mean, we know we have one of the highest adoption rates in the world, with 8 out of every 10 individuals here in the United Kingdom using at least one fintech tool, and that number is only growing. We also know that today, more than 50% of all SME lending is being done by fintech. So we are already seeing a massive impact being made by the industry. And a few weeks back, we decided that for the past 10, 15 years, we've been talking about this positive impact that fintech has made. But it's been really hard to actually quantify that impact. So we developed a report and a program in collaboration with our partner Accenture that quantifies the impact of fintech against the United Nations 17 Sustainable Development Goals. And we had some really heartening data come out of that assessment. We found that 98% of all UK fintechs are having a positive impact on those UN SDGs. The 2% not included in that 98% are simply not included because they're too early stage to be deemed as having that significant impact. We also found that more than 1/4 of the fintech ecosystem here in the UK is directly addressing the issues of inequality by providing either greater access or access to more financial services products. And we found that more than 1/3, 37% of UK fintechs, are having a positive impact on the pillar of peace and social justice, which includes strengthening international and domestic institutions, so through things like reducing fraud and increasing authentication through platforms like KYC as well. So overall, a really positive picture for UK fintech, both in terms of moving from strength to strength to strength as an industry, but also in terms of having this incredibly positive impact on the individuals and the businesses that we serve and on our consumers. So a really, really positive picture for where we're going. But we have to make sure that we do not rest on our laurels and that we keep up the momentum to support this sector. And I want to highlight a few areas that I think are important for us to address as we are moving forward. Firstly, we have to make sure that we continue to have proactive, effective, and fast regulation here in the UK. I would argue that one of the reasons we have such a thriving fintech ecosystem here is firstly because of the amazing entrepreneurs, and so many of you in the room today, our amazing community. I would also argue that the fact we've had such a proactive regulator in the past has been a key component of that as well. You know, we were the first ones, the FCA, back in 2016, to launch a fintech sandbox, and that's now been replicated by more than 40 countries around the world. We have to make sure that we continue to have that momentum, and there's a few key areas that we want to see that progress in. One of those is around open banking. And we were delighted when the EST at our Innovate Finance Global Summit in April of this year announced that this would be the year of delivery for open banking. We need to see quicker and faster movement forward on open banking, through to open finance, through to open data, and ultimately, in our eyes, what we'd like to see is the UK as the world's first smart data economy. So having industry work with regulators, work with government to get there is absolutely critical. And that's an area we're pushing for. On policy more broadly, we also need to see further momentum around areas like crypto assets, around areas like fraud, and reducing that fraud for the consumer, and app fraud is a key area. And we also want to see faster regulation on issues such as buy now, pay later, and making effective regulation as well. The second area I want to point out and really call to everyone in the audience to take a step forward on is around having a positive impact on our climate and the issue around climate change. So one of the more I would say disheartening facts we found in our impact report was that despite all of the amazing work that FinTech is doing to create a positive social impact, only 9% of our ecosystem is having a positive impact on climate on the planet. And I think there's huge opportunity for us here. So much about reaching our net zero goals is about driving investment into initiatives tied into that, and that will be based on data. And ultimately, data is what fintechs do best. So I think there's a real key opportunity for us to step up as a sector and deliver on addressing the issues around climate change as well. And then I think I'm running out of time. So the last point I just want to add is on diversity. Now, if we are looking to create the next generation of financial services, we want to create a diverse one that brings in everyone in the same way that we are catering to so many different types of consumers. Of that $12.5 billion of investment I mentioned earlier, less than 5% of that went to female-led or female-founded fintech firms. And for other underrepresented founders, it's too small to even measure. And that's something that we need to change. So driving that diversity, really highlighting the strengths of dynamic and diverse companies is an area that we want to do a lot more work on and push forward ahead on. So in closing, I would love to invite you all. Next year is the 10th anniversary of Innovate Finance, and it is the 10th anniversary of our Innovate Finance Global Summit, which we host every year at the Guildhall in London. We bring all of our FinTech National Network partners. We're delighted that FinTech North will be there as well and speaking. And we'd love to have you join us to celebrate the great ecosystem that is UK FinTech. So thank you so much for inviting me here today, and I hope you all have a fantastic day.
Thanks so much, Janine. Fantastic insights as always, and delivered with energy and enthusiasm as always. So brilliant to have you here. You've built on what we spoke about before, built on the insights that Max shared around the economy and told us how FinTech's having a disproportionately positive effect on that. And you've talked about open finance, open banking, open finance, and open data. We heard a lot about that from Ksenia, talking from a CFIT perspective. This afternoon, well, later on this morning, we're talking about trust across a number of sessions, and then this afternoon we're talking about sort of FinTech for good and reflecting on some of the things that Janine mentioned as well. We're going to stop for a break now. Before we do, I just want to take a photo that we try and get each year, which is I want to take a picture of the audience from the stage, and I want everybody to just hold their hands in the air, please, if you can. Thank you very much. And they'll shout FinTech North. Yeah, right. Excellent. Brilliant. Thank you. So you've all earned the right to have a cup of coffee and a chat now. We'll call you back in about half an hour. So enjoy the break. And don't forget about the sticky, our sponsors of networking today. The little tag on the back of your cards. If you touch base with people, you can download their contact details. Thank you.
We have a session now on trust and data. And that's not going to be as much fun as coffee. Julian, am I wrong when I say that? It's going to be lots more fun. Oh, you can turn the volume down now. Thank you. So my job is to fill in the spaces. Hopefully you had a good morning this morning. What I will say is that it was surprising to hear from Janine that the Mansion House speech was a significant piece of information. I can confirm, because I work with pension funds, that it is not a significant piece of information. Mansion House is very interesting from the point of view of defined benefit schemes and defined contribution schemes, bearing in mind that defined benefit schemes in the UK represent near 2 trillion of assets, of which 1.3 are my clients, by the way, so I sort of know where I'm coming from, and then a few hundred billion represent defined contribution. The idea that defined benefit schemes will invest more in private equity is spurious, because they are already heavily overweight after the bond crisis. They are divesting. So most DB schemes are overweight, they're divesting. So that market, including the VC market, which I've mentioned earlier they wouldn't invest in, is not going to be a source of funding for the growth economy, I'm afraid to say. Another interesting piece of information, anecdote I'll hand over to Julian in a second now, the idea that investing in the growth economy via VC is a means of investing in UK companies. I can tell you I have the quantitative data to say that 70% of money invested in in private equity in the UK immediately goes offshore. Only 30% of it is invested in UK domestic companies, 50% goes to the US, and 20% goes to Europe and the rest of the world. So if you see private equity as a way of bringing domestic innovation and domestic investment, it's not. 70% of it is invested in growth economy in the US, infrastructure projects in the US, not in the UK. It's a very poor and inefficient mechanism for investing in the UK. Anyway, on that note, I'll hand back to Julian. Here we go.
Thanks, Chris. Welcome back, everybody. There are some seats. If you guys are standing up, you don't need to stand up. Please just feel free to come and come sit at the front. I know from standing at the back myself, it looks like all the seats are taken, but they're not. So just feel free to come and make your way forward. In this next segment, we have got quite a big focus on the word trust and trust in financial services. And to kick things off, we're really delighted to have with us the Rise from Barclays team. We're going to have Charlotte and Will come and join us on stage. So, guys, do you want to come up? Thank you. And thank you to Rise and to Clare especially for all your support for the event today as well. Thank you. Okay.
Right. Hi everyone, I'm Charlotte Kanagasapabathy and I'm a director in the innovation team at Barclays. We run Rise, as Julian said. We're delighted to sponsor this event today. And Rise is a global community of fintech innovators, and our mission really is to accelerate innovation across financial services. We offer fantastic digital academy programs and a virtual membership called Rise Connect, so please do come chat afterwards if you're interested in either of those things. But plug over, I'll just say it's great to be here in Manchester, and I'm absolutely delighted to have Will Billingsley with me. He's the CEO and founder of ApTap, an alumni of one of our digital academy programs. And we're going to be talking about data, trust, and finding the opportunities in new regulation. So, to kick us off, I guess I just wanted to share a few insights and reflections on trust, starting with some takeaways from this year's Edelman Trust Barometer, which, if you don't know, is a survey. It's global. It's been going about 20 years now, and they survey more than that, even 30,000 people across the world. And this year, that survey found a few things. One, business is the sole institution seen as competent and ethical. Unfortunately, government is viewed as the opposite. Second, business is under pressure to really bridge that gap. People actually want more societal engagement from business on things like climate change and economic equality. And thirdly, people just don't trust the media, especially social media, and they want business to stand up for the truth. So that might be a little bit bleak, but positive for business. And what about financial services? Well, it seems that fintechs are really starting to turn the tide now in the financial services industry. So according to research by Ernst & Young this year, they found that for Gen Z consumers, 37% now say that a fintech is their most trusted financial brand. So fintechs, like, amazing work, not so good for Barclays. And that is versus 33% who name a bank and 12% their wealth manager. And so it just got me thinking, like, what does this really mean? Like, what is trust? Because in the past, it's probably more about being competent, like keeping money safe, accessible, not doing anything bad, like financing terrorists. And trust is still all of those things, obviously, but now it's also more about like the softer, kind of more human side of it, right? Like showing integrity, compassion, and goodwill, particularly when a customer's facing kind of challenging times. So that got me thinking, how do you translate these really human things like compassion, into relationships that we're basically establishing in a purely digital and often automated fashion. And obviously it comes back to data, and that's something that fintechs are great at, so that Gen Z stat maybe is no surprise. But just to talk a little bit about what we're doing on this, I spoke to our Barclays Consumer Duty team before coming here today, and I kind of learned that in response to consumer duty regulation, we have created the largest MI resource that's ever been created in Barclays, and we did it in the fastest time, which is kind of huge. You know, we have tens of thousands of metrics now that combine various indicators and customer groups so that we can actually systematically monitor and ensure that we're truly delivering those good customer outcomes that we absolutely must do. And this all kind of comes into that trust piece. So data is obviously really foundational to this, and meeting our customers' needs in the best possible way. And on that note, I'd love to bring in Will to start talking about the origination of ApTap. Because before consumer duty, there was obviously another
Maybe not as, I don't want to use negative as a word, it's more just kind of how is that delayed, but also contextualized what we do for banks and for their customers. And then bigger picture, kind of zooming out, that becomes a lot more about just what is the tangible thing I can put in front of my customer, and actually, the whole concept of consumer duty is, that customer support and how we do things for the well-being of that customer and how we help them take actions. And obviously, largely that's been centered on someone's financial products today, but how does that, someone earlier mentioned the evolution of open banking into open finance, into open data. And ApTap at its core, we want to be part of that. We want to be the kind of infrastructure layer in there and, enable banks to do that without having to slow down, as it were.
Yeah. So one of the trends that we're really interested in at Barclays at the moment, and I'm sure a lot of people in this room are working on, is this idea of hyper-personalised financial products and services. And I feel that's becoming like a bit of a buzzword. But how do you meet that customer need at the right time
in context with a solution that's really tailored to them, but without doing it in like a really creepy way.
But I think there's levels to that, where I would find something maybe a lot less creepy than like my parents would. If someone's putting a product, you know, I get it on Instagram, social media all the time where a product's put in front of me, I'm like, yeah, I'd buy that. And I'm not thinking that, oh, they're using my data to try and put something in front of me. It's like, oh, good, I don't have to do the legwork. Yeah. Whereas maybe my mum and dad would be a little bit irked by something like that happening.
So generational differences then,
sure.
Potentially. Yeah. Well, so, I mean, what's your experience of how banks are approaching like hyper-personalization, or, I mean, I guess really any personalization with respect to working with fintech partners like yourselves? Because there's a lot of like data exchange kind of involved, isn't there?
That's the crux of it, I think, is kind of how do you break that barrier? No, probably don't want to use those words when you go and sit down with a bank. Yeah, data sharing is at the core of all of this, and so when it comes to someone like Barclays, or we work with TSB Bank at the moment, how do we share data in a way that's obviously for the better of the customer, and who are the other stakeholders involved in that relationship? So for our business case, or from an operational perspective, we see a world in which consumers have a relationship with their bank, consumers have a relationship with their merchant, but we feel that kind of merchant-bank relationship beyond the world of payments needs further work. And we're there to kind of enrich that and build out the kind of three sides of this triangle and sort of get this flywheel spinning. And so it's not just about how do I make the user experience better, which is obviously a part of it. An insurance policy quote today is like 35, 40 questions, but we think with the data that banks and merchants have on these consumers, this could be a handful of questions. So there's an easy kind of win with the user experience, but then what's the kickback for the financial institution who's helping their customers do that? Largely that's an engagement piece where customers will come back and kind of transact more regularly and renew financial products with the bank. But for merchants as well, who we feel are often left out of this equation, it's then about how do you incentivize these merchants to open up data in the same way that PSD2 is or open banking has kind of forced these big banks to do so. But get ahead of the regulation on merchant, you must open up, energy provider, you must open up energy usage data, to an energy provider saying it's in my best interest to open up these data with user consent, talk about this customer with this financial institution, and really enrich that ecosystem. And that's not an easy conversation by any means with any of those three parties. And I think banks are in such a good position to do that because they own a relationship with a consumer, but they also own these kind of corporate banking relationships as well.
So could you give us an example, like paint us a picture of what an amazing user experience could be with ApTap if you had a little bit more of that data that could really enlighten the...
Yeah, well, shameless plug to go download the ApTap app, even though that's not our primary business model. Yeah, I think we see a use case for you, right? Yeah. So I'm a user. I've just opened up let's go with Barclays app. I'm scrolling through my transactions and I see like an Aviva, I don't want to name names, an anonymous insurance provider. You can identify that that's probably home insurance or car insurance, but there's some measure of educated guessing, I suppose, involved in that. Barclays, you have this massive MI data set, so that's probably improving over time. But it's a question of then what can you do with that? How can you further contextualize that? So not only should you know what I'm paying for, or should you know what I'm paying, can you know what I'm paying for? So if it's an X insurance provider, being able to attach my policy or, God forbid, scrape my email inbox and be able to pull that policy on my behalf and attach that to that transaction and say, hey, you're actually paying this much for this policy, and now you've gone to an Evans Cycles and you've spent £2,000, you've probably bought a new bike. by the way, that's not covered in your current content insurance plan. And here are the products and services that are going to be best suited to that, whether that's switching that current policy into something more holistic, or whether that's purchasing a new policy. Those are the kind of actions that obviously a financial institution can pull levers on, I suppose, and obviously I kind of use the insurance example as many banks are looking to resell their own products. But I think there's applicable across utilities, telecoms, even subscriptions products, financial products.
But I mean, that's a great example though, isn't it? That's very relevant to consumer duty and making sure that customers have got the right products for their needs, and that those products evolve with them over time. So another kind of aspect on the subject of trust, I think would be insightful for us to hear from you about is, obviously you've alluded to doing lots of work with banks. So I'm curious what you've learned about how and when to trust the banks that you are selling to. It's something that we don't talk about very much.
Yeah.
But
it's usually the other way around.
Well, yeah, but there's a lot of learnings for founders, and it's a tricky path. So, what have you learned, and what's your advice for any founders in the room who are in a similar position?
If the bankers in the room could close their ears. It's never going to be easy, I think would be the first insight, if you can call it an insight. I think everyone kind of knows that. As an early stage startup, we're kind of 11, 12 people and kind of on that fulcrum, turning that corner into something a bit more kind of growth mode. You're going to need certain levels of like structure and policies and procedures and things in place. And so I think the first indication that a bank, let's say, is maybe more serious about actually working with you is when you start to dig into that sort of stuff. I think we've had plenty of conversations with various different financial institutions where they've come along and said, we've got this use case, we think we've got a cool product here, how could we change what you do to fit this thing? And it's like, well, it's actually not what we're really here to do. And there are some tweaks, and you've got this kind of horizon piece around your core proposition, but maybe not a trust piece per se, but more about the actual applicability of what you're doing versus what those use cases are. Then it's about, I guess, getting your champions. So I think there's a gut feel element in it, as always. We try and default to trust, and I think you mentioned earlier, right, like the consumer's trust is in business as a whole, and I think not always is a customer going to like their bank, but they do trust their financial institutions, and I think that bleeds into the partnerships piece or the sales piece as well, where at the end of the day, if a bank was to turn around and be naughty, we could go talk about that in the ecosystem or out here and say, look, this bank did this to us, and that would have real ramifications for them. And that's maybe not the healthiest way of running a relationship, but I think you do get that kind of gut feel, and then you start to build relationships with real people in these organizations who really want to see you succeed, and I think that's what Rise do so well. Shameless plug. That's what the team at Lloyd's Launch, for the sake of annoying Rise, do really well. TSB Labs did really well for us as well when we were first starting out with that relationship, and these are real people who want to see fintechs succeed. Fintechs can have real impact, and so
there's definitely something in that in terms of you have your direct relationships with the people who are making your decisions about your particular use case or opportunity, but having those broader networks with other people who can almost kind of go and help sense check for you what you're being told and what you're hearing, that can be really valuable in terms of what I've observed to the fintechs that I work with. So.
Yeah, you're experiencing that now.
yes, we are.
No, I think that's really valid. But being able to tell when you can push those barriers or boundaries as a fintech, as a salesperson, as a founder, it's you don't always want to breach that too soon or too late. Timing is really important, and the right people are really important. So yeah, totally agree.
Absolutely. How are we doing on time? Are we all good? 5 minutes?
A couple of minutes. Yeah.
Oh, amazing. We'll keep going.
More questions.
So tell us a little bit more, Will, about like how ApTap are doing now. What's next for you guys? What's the big plan for 2024?
Exactly the challenges, let's say, that you've discussed. So a number of financial institutions in the work, and what we've done over the course of the past year is really tried to dig into how our product relates back to the problems that we've discussed that they have in addressing consumer duty and addressing kind of fair customer outcomes, and it's like surprise and delight seems to be the kind of coined term flying around at the moment. And so what we did is essentially split our products into two and say, well, you know, the uptake of open banking, frankly, has been kind of disappointing, I would argue. Well, that's my opinion anyway.
Elaborate. What has been disappointing about it, and what are your hopes for open finance?
There's like 7 million active users or something of open banking products, and is that enough probably to make like a real difference? And most of that is happening in the SME space. So from a consumer perspective, there's loads of ironing out to do in terms of the user experience. Like if I'm in a Barclays app today and you wanted to integrate ApTap's transactional analytics tools, it would mean redirecting a customer to either a browser or some interface or a pop-up of ApTap's to say, are you happy to share this data? It goes back to Barclays to confirm that, then it goes back to us to say yes, and then it goes back into the Barclays app. So there's loads
When you
of
put
work.
it like that, it sounds terrible, doesn't it? Yeah.
So there's loads of work to be done on that before customers are actually going to pick it up and say, oh, it's better for me to pay using open banking payments, PIS services, as opposed to just like Google autofilling my card details and off I go. So that's why we divided up our product suite and said, look, we can help you build out this ecosystem relevant to your specific needs or customer needs. Then we can start to plug in these insights to really make that more and more relevant over time. And in theory, that should increase the conversion of those products and services, and obviously keeps the bank's financial team quite happy if that starts to work out. And so that's the aim of the game for us, right? We've, like I said, live and operating with TSB. So if you're a TSB account holder, go check it out in their marketplace. We have recently signed a couple of major financial institutions, with one more en route. So next year for us is kind of client success driven work and optimization of product and that sort of thing.
Brilliant.
Exciting times.
I think we will wrap it up there, but thanks so much, FinTech North, for having us. Thank you, Will, for your time, and thank you all for listening.
Well, thanks, Charlotte, for running that session, and Will, great to get the insights of a fintech founder in that format as well. So our next session, we need to talk about ISO 2022. Anish, why? Come and tell us why. I'm sure there's a very good reason why we need to talk about it. Great to welcome Anish Kapoor from AccessPay, one of the best known fintech names in Manchester for many years now as well.
So hi everyone. So on the topic of trust and data, I think there's a huge elephant in the room, which is that we are about to embark on the biggest change in data requirements for payments, probably in the last 20 years, and we are not talking about it enough, I feel, both in the ecosystem and to the users of that ecosystem. And so that's what I'm here to talk about today. There we go. No, going the wrong way. Right. So, what I'd like to do, what I'm hoping to do at the end of this talk, is to have convinced you all that ISO 2002 migration should be certainly one of the top 3 things that you're focusing on through next year. And to do that, I figured I'd probably need to cover 3 things. So, number 1 is, what is it? Kind of what's the background to it? Why are we doing it? The second is, kind of what have we learned about ISO 2002 migration? How can I stand here in front of you and comment on this, and what useful insights have I got to give you? So that's the second thing that I'll cover. And then the third point is to actually talk about some of the major changes that are coming up in the timelines, which hopefully then will bring it all together, and I'm hoping at the end you will all be convinced. So if we start from the beginning, what's ISO 20022 all about? So think about the world today and how we make payments today. It's actually a really, really simple sort of data world, if you like. So if you think about what we need to instruct a payment, you pretty much need bank details and amount. Through certain schemes, you don't even need a name, to be honest. You can literally just make the payment with those details. What then happens is, as that goes into banks and various sort of financial institutions, there's then a whole series of checks that are performed on that payment, things like AML, sanctions, etc. And because none of the data has been provided, that normally involves quite big operations teams having to get in contact with customers and say, actually, can you tell me what this payment's for? Can you tell me who it's going to? Can you tell me where it came from, etc., etc., etc. So slows everything down. Payments get delayed. It's just not a great experience. And then the other side of that is that when the payment gets to the other end and it lands in your account, there's normally very little reference data alongside it. So if you're lucky, you got 16 digits of reference data, but that could get stripped out as it goes through the system, so you may get no reference data. I think actually the previous talk talked about actually trying to infer, if payments to an insurance company, what kind of insurance is it for, right? So there's really no data at all flowing through the system that tells anybody about what that payment's for. And at the back end of all of this, you've got, again, lots of human beings in banks and businesses trying to reconcile lists of payments and figure out what's what, and they can't do it because they simply haven't got the data to do it. So that's what ISO 20022 was really designed to address. It's about saying, right, well, can we get more data going in the front so that all of the various processes that we've got to run as financial institutions can be done in a more automated fashion? And can we actually make the lives easier of all the people on the receiving end of this by giving them much more data about what payments are actually for? And so to do that, ISO 20022 was created, and this is a hugely rich data format. So for those that don't know what it is, it's basically an XML format. It has about 1,000 different tags in it. So in other words, 1,000 different places to put bits of data. Within those, you can have multiple separate tags. So actually, it's a hugely rich format. And so the idea would be, so the vision here, the vision for an ISO 20022 world, is that a payment gets instructed and it has all this metadata attached to it. So, what's it actually for, and lots of detail about that, and the address of the person it's going to, so that it can, when it then flows through the system, all of those processes that are currently manual can be automated. Things like KYC and AML and everything just happens really, really quickly and easily. And then when it gets to the other side, all of that rich data is maintained. Okay, so suddenly when I get my statement, I'm able to look at it and I can go, okay, well, a payment's gone out and I know exactly what that's for, broken down into granular detail. And that makes everyone's life in the ecosystem much, much easier. So that's the vision, right? That's what we're trying to get to. But there's a problem, okay? And I kind of stand here and I'm talking about this problem not because I've kind of read it on Google or read it in a book or anything like that. This is what we do as a business, right? So we are one of the world leaders in helping organisations migrate to ISO 20022. We've done it hundreds of times. We've connected hundreds of kind of back office systems to hundreds of banks. And time and time again, what we're seeing is the same issues, which is that on the what is the right-hand side, as you're looking at me, as I'm standing up here, organisations initiating payments, they just simply don't have most of this data, right? They simply cannot, either within their current systems, provide this level of rich data. So there's an awful lot of kind of data transformation work that has to go on, and sometimes there's a lot of data enrichment that has to happen to kind of make these ISO 20022 messages actually exist in the first place. And then on the other side of the equation, when we what we see with financial institutions and market infrastructures is that they're in a state of flux at the moment. So their systems are in the middle of a whole set of changes, and the data that they require and the format that they require it in is changing over time, right? So it's kind of a bit of a moving target in terms of what you're trying to actually get through the system to the banks to actually make things work. So, when you put that together, it actually makes this quite a complex sort of problem to solve. And again, the one thing that we've learned and seen is that a really important part of this is actually engaging with your underlying bank or financial institutions and actually trying to work out what is it that you can. Oh, thank you. What data do they actually need and when do they need that data? And banks have got limited capacity to have that conversation with their end customers, okay? They have very, very small teams that work on this. Those teams are very, very busy. So you have to kind of plan ahead and you have to allocate slots of time with those teams to get this information from them, okay? So I guess the key message I'm trying to get across here is that this is not something you can do in a week or 2 weeks, right? It takes months, it takes planning, it takes time. And so you might then say to me, well, so what, right? It takes time, it takes planning. Well, the issue is that we have a number of very, very big changes that are coming up, and they're coming up very, very quickly. Actually, maybe a quick show of hands. Who here is aware of the Bank of England RTGS renewal programme? A couple? Yeah. So, I mean, that's probably what, less than 10% of the room, I would suggest. I mean, now, that's, in essence, what that is that the Bank of England run the CHAPS infrastructure in the UK. And they've basically ripped it all out and replaced it with some new core technology that allows them to be ISO 20022 compliant. That essentially went live in April of this year, and you've seen there's been no change so far. But what they and this process has been ongoing for a number of years, by the way. So this isn't a surprise. This has been going on for the last 4 or 5 years. But what they're now saying is, okay, we've now got this new core infrastructure. It can now handle a lot more data. We actually now want more data, and we will soon start mandating that you provide that data. And if you do not, the CHAPS payments will fail, okay? So this is actually quite important because they're very important payments, right? And what they're doing is they're doing it in phases. So November 24 is the first date, and that's not very far away, okay? Essentially what they're starting with is for FI to FI payments, and if anyone wants to know what that is, I can explain that to them later, but FI to FI payments, there are some additional bits of data that they're going to mandate. It's a legal entity identifier and a purpose of payment code. Essentially, they want to know what's that payment for, right? But then the other key thing for November 24 is for any property transactions, there has to be a purpose code. And now that isn't just one code that says it's a property transaction, it's actually 6 different codes, and you've got to pick the right one, right? So it's, you can sort of see why I'm sort of up here trying to make sure that we're talking about this, because I go back to my earlier point of all this takes time. November 24 is not far away, okay? But then beyond November 24, there will then be a separate set of mandated requirements in November 25. That's going to be a structured address. Okay, I'm going to come on to talk about that in a bit, but if you imagine today, when you enter the address of somebody, it can be free form. What they're saying is, no, we need that in a certain structure. And again, if that's not in there, we're just going to reject the payment. Now, the thing is, that's not just chaps in the UK, that's actually any high-value payment in Europe. So that's why I've got, kind of target €2 on step 1 in here. They've also upgraded their core infrastructure, and they will also be mandating these requirements in November 25 as well. And then the final piece on here is that in November 25, structured remittance will also become mandatory for chaps payments, although there is some debate over exactly how that will be applied. So initially, Bank of England said it's for all payments, structured remittance is mandatory. And again, when I explain what that is, you'll see what a huge undertaking that is. So there's some debate as to the scope of that, but it's likely to be narrowed, and it's likely to be kind of FI to FI payments and probably domestic payments within that scope only. But anyway, that's still to be determined. So this is why I'm up here, kind of trying to kind of ensure that we're, when the topic of trust in data, we need to make sure that we're kind of making everyone aware of these changes, and that we're giving them plenty of time to plan and get ready to make sure that there isn't a mad rush or people aren't suddenly finding payments failing. Just a little bit, just to give you some examples of kind of how complex some of this stuff is. So structured address, on the face of it sounds simple, but really what you have is you have kind of like a format, and I'm not going to read this slide out. It's very complicated, but how you interpret that format will vary, and this is what we see. It varies bank by bank, market infrastructure by market infrastructure. So having this two-way conversation about actually what data do you expect in what fields? Where do I put Manchester, for example? Does it go in town name? Does it go in district? I mean, where does it go, right? Which particular bit does it go in? And so there's lots of granular data you've got to get into to make this stuff work. And then structured remittance is just fiendishly complex. I mean, really what we're talking about here is adding really granular detail on what a payment is for, to the point where you're breaking it down into, and if I sort of take the previous example about insurance, it would break down actually what different types of insurance are you buying, which is great, for, if you want that data, but to flow that through the system and have that maintained in messages is quite a difficult undertaking. And to actually inject that data in at the beginning is also super, super difficult. It requires a lot of deep integration actually with core systems to make that work. So these are big complex things, right? That we haven't got a huge amount of time to get right. Now, I suppose I don't want to panic. I actually want to leave on with a message. Look, it can be done, right? It can be done. It's not an insurmountable problem. It can be done. It just takes time and planning. And I think, again, just to reiterate the message, I really don't think we're talking about this enough, and we are definitely not talking about it enough we're not talking about it enough with people outside of this room, the other constituents of the ecosystem. So as an example, this is an example of actually an FI that we worked with that had really, really basic data that wasn't even ISO compliant, and this whole process probably took 3 to 4 months maybe, working with them and their underlying bank to work out what data was needed. In some instances we were able to take the data, transform it. In other instances we had to enrich it. We help them create structured addresses, and we're integrated in their systems and ready for structured remittance when it becomes clearer what that actually is and what it needs to be, right? So it's doable. It just takes time and planning. So hopefully I have convinced you to at least think about the fact that this should be a priority in 2024. And I've covered what it is and what is ISO 22 and why it's something that the industry decided to do. our sphere of expertise in it and why I'm standing up here kind of raising the alarm that we need to talk about it. And finally, most importantly, the immediate deadlines that we are facing that we have to address, I think, as an ecosystem. Now, before I go, so one more thing. This is my Columbo moment. One more thing. So we really, really do care, and we really, really do believe that we should be talking about this more. So we're going to be doing an awful lot of free webinars, events, to help not just the entire ecosystem, but anyone that's in the fintech world, institutions, corporates, you name it. We want to just get the word out there that this is happening, and there'll be a ton of free resources to help you all figure out what you need to do, how to do it, how to plan your projects, etc. We actually will be doing this for a number of large UK banks, so watch this space. But if anyone else wants to tag on to this or have us do this for them, we're happy to do it. We just think it's something really, really important that we need to talk about. Thank you very much.
Fantastic, thanks Anish. That was very informative, and I'm sure you'll all agree that Anish's subject matter expertise comes through loud and clear through that presentation. From one subject matter expert to another, really pleased to welcome Wayne Scott from NCC Group, a really long-term friend of FinTech North, headline sponsors today. We've all got our gurus that we go to for certain topics, and when it's operational resilience, which is a big topic, I always see what Wayne's got to say. So I'm going to sit and listen intently, Wayne. Great to see you.
I was promised theme music when I arrived on stage, to be honest with you. Never mind. Morning, everybody. My name's Wayne Scott. I'm Regulatory Compliance Solutions Lead within the Software Resilience Division of NCC Group. Software Resilience is the artist formerly known as Escrow. We've been doing this for 40 years with the largest escrow company on the planet. We deal with 90% of the GSIBs, vast majority of financial institutions, if we're open about it. And because of the nature of our business, that means we also deal with the supply chain, the critical third parties that are involved. And if you're not familiar with escrow, it's essentially a legal agreement with some testing on there that establishes a right to carry on accessing business critical information. And ensure that financial institutions primarily can carry on legally using the services should the supplier fail. I have an unusual role. I do quite a few different things. The whole role is designed to accommodate and get the best out of my wonderful ADHD brain. I do lots of different things that relate to financial institutions, all those different roles there. I liaise with the global financial services regulators. I write our consultation paper responses. I ensure our products exceed exceed regulatory. I need a raise. Exceed regulatory requirements and advise systemic financial institutions on accumulative, compound, non-cyber risks. The kind of stuff that's it does involve cybersecurity, and I've contributed to a number of different global regulations that are going on right there now. A lot of people think of ADHD as an inability to concentrate. I just have too much concentration and I can't control where it goes. What it means is I make leaps, information leaps if you like, and I spend a lot of time explaining these leaps as I go along. This is essentially what all this slide backdrop is that you'll see here. It was wonderful to hear Chris talking earlier about pensions. I agree with him on that front. But to talk about trust and failure, kind of the links between them, it's a tough subject to talk about. I want to try and get people to talk about it a little bit more. Your customers within fintech, they trust and they believe, and They hope that your services are there and you'll deliver what you're supposed to do and that you'll always be around. And if you take a sort of look at the entrepreneurial mindset, failure is not an option. But when you start to really look at the data, as a number have kind of touched upon today, it's a possibility, it's a probability within FinTech, as Chris mentioned a little earlier. And if that's there, and it can happen, and it potentially will happen to a large number of us, you've really got to address that, particularly with your customers and potential future customers. You've got to embrace it, you've got to understand the ramifications for it, and to a certain level, to a certain extent, you've got to plan for it and show your customers that you've planned for it, that your service will be available, even if your company no longer isn't. And as somebody else mentioned, trust at the moment is in decline across everything. Same survey, I thought you were going to massively steal one. But it's, trust in financial institutions. Well, I'll come back to that, but trust in education, media, our government, it's massively in decline across the board. And that breeds polarization. It kind of means that ideology becomes identity. And it undermines economic development across the board. But interestingly, trust within the financial institutions remains stable and is increasing. And that's vital to a healthy economy. Money is trust, finance is trust, banking is trust, insurance is trust. You get rid of that trust. And it's not good. It's really not good, particularly for us as an industry, and certainly as a company going forward, a country going forward. And fintechs, whether you've really considered it or not before, you are a bank, you are an insurance company. You might only perform 1% of a function of a bank, but you are. That previous process used to be formed internally. You're part of that. And there's a support structure, a rescue features, there's a safety net for financial institutions that doesn't exist for yourselves. There's always a regulation or a step in, a buyout, a rescue, whatever, takeovers. But that doesn't exist for the supply chain. And a rapid decline in trust has a very negative effect. You'll all be familiar with Northern Rock. The difference is back in day, as my daughter would make me say, is you had to queue up to get your money out, and it took some time. It took days for Northern Trust to fall. It doesn't work like that anymore, and you can really just ask SBB about that. And now, obviously, I'm massively oversimplifying this. There's a lot of different contributing compound factors that fed into that, changing regulatory stance, unwise lending decisions, investment decisions, should I say, questions around the auditory function. But nevertheless, it was exacerbated by a loss in confidence, a loss in trust, pushed out by the old Twitter sphere, and enabled by our thumbs, tech, the ability to move billions of dollars very, very rapidly. That wouldn't have been able to happen before. It's important to address and understand that trust. And it's been categorically proven across the board that with every sort of economic shock, there always comes a significant rise in operational risk losses. This is taken from Michael Grimway's work. It's a fantastic book that's well worth having a look through. And if you look at the economic environment that we've got at the moment, certainly over the last 5 years, we've had some of the biggest economic shocks in the history of economics. Brexit, COVID, let's have a look, energy prices, inflation, war, two wars, big supplier failures, banking failures. And all of that compounds, the real risks and the potential chance for failure increases with each economic shock. We've seen some big supplier failures over in Europe that could have caused a lot of damage. So the next big supplier failure is going to last for longer. It's going to get bad really, really quickly. It's going to have a huge impact. And it's going to take a long time to fix, and it's going to take a lot of money to fix from there as well. And the clicker isn't working. Aha! And this leads to a decline in trust in the market, a decline in trust in investment, and a number of people have already touched on that already. We've all felt it, we've all seen it. You know, the mega round stuff still's going on. Yeah, big companies are still getting bought out by bigger companies, which is a clear demonstration of concentration risk as we go on. But funding is harder to get hold of. And companies, companies do fail. They all fail for different reasons. It's all either bad decisions or bad employment or conflicts of interest or anything like that. But ultimately, when something fails, a tech company fails, they all have one thing in common, and that's they have customers, and customers that depend upon those services. It's been noted by government. Hey, now on the National Risk Register for the very first time, supplier failure within a retail financial institution over here is listed there as a plausible risk. Also within a financial market infrastructure as well. Now, they rate the risk as low, it's just 1 to 5%, but to me that's a massive number, right? It's not a small number, and the ramifications of a supply chain failure within a systemically important financial institution would hugely damage trust within the economy, within the financial institutions themselves, and it does spread out really, really rapidly. The regulators, all of those regulators over the last 3 or 4 years have introduced legislation that revolves around third-party risk management, operational resilience, outsourcing, crisis management, and it's in. There's actually a few more there. I've just got bored of copying and pasting logos. ISO 27001's just been updated to include these elements as well. And our regulator made it a priority for dual regulated entities at the start of this year to build plans, mitigation strategies that should be in place by the end of March next year and then tested throughout the final year of it. But the financial institutions are behind on this, really are behind on this. And I mentioned the lovely ADHD, but what it does do is it allows me to identify these patterns. And now, obviously, throughout these regulations, the taxonomy differs and the prescriptive nature of the regulators differs from region to region and country to country, but there are patterns dotted about all over the place. And first of all, one of those is the naming of supplier failure, service deterioration, and concentration risk as risks. Now, these are risks that cannot be mitigated with any level of cybersecurity. No firewall will stop you going bankrupt. No ethical hacking will stop you from getting taken over. And somebody's got to own those risks. They've got to map it, understand the estate, set at-risk appetites and risk tolerances. And then you've got to build plans to deal with these risks. You've got to test them. If the plans work, yes, but if they don't, you've got to learn from it and feed it all back into the procurement process and over time building resilience within the financial institutions. But any of these plans have to be proportional. It can't be expensive. The idea is the financial institution should at some point be able to bring the management of your services in-house or pass to the management of somebody else, another third party. Think about that. That's not easy. How many of your customers can manage your service without you? It's going to involve a lot of change. And it's the building of controls, really. Ideally, everybody would already be ready for this. It would be a preventive control that would be introduced. You'd bang it in right at the beginning of the procurement process. But ultimately, tech's not really been built with this in mind. So it's going to be a detective control. We're going to investigate and see how bad the situation is and try and build some corrective controls on the back end to cope with it in some way. But what we've really got to do, what they're really looking for is a control that will reduce the frequency, the duration, the severity and the velocity of an operational IT failure and the total cost of settlement as well, which is cost of putting it right plus fines. You know, you really want to reduce the potential for fines. and that's why escrow solutions are being named directly within global regulation with an increase in frequency. Only last weekend we heard that the Reserve Bank of India have made it mandatory across critical services. It's here within the UK and across the United States. The list goes on and on. And you can, it fits into a stressed exit plan. A stressed exit plan, a lot of the time is just the process of moving away from your service. The procurement process, but that's not a short process. If you've ever sold software into a financial institution and it's business critical, you're talking 18 months, maybe 2 years. You know, if there's an intergroup outsourcing model going on, it could even go even longer. So they've got to keep the lights on. They've got to keep on using that service. And in order to do that, they need access to source code or single-tenanted access credentials or spun down fresh instances, multi-tenanted services along with access to the client data, but they need to understand it, yeah, and they need to be able to prove they can use it or somebody else can use it. And that's what we do. That's what we've been doing for 40 years. Okay, there's nothing new here. And the reason why we tick all the boxes on this particular front is because we are proportional. The financial institutions, and escrow is proportional. The financial institutions already know what we do and how we do it, and the vast majority of critical third parties already use us too. So that makes it a wonderful situation where a one-size-all-fits-all approach to mitigating these risks of supply failure, service deterioration, concentration risk, it suits or exceeds global regulatory requirements. So the financial institutions are looking for trust in their supply chain, or maybe looking to be able to demonstrate that their trust has been well placed. And they're approaching every single material or critical party to them and asking them for all these stressed exit plans. And they're getting 5 different responses. The first one is agreement. Can I have a stressed exit plan? Yes. Brilliant situation to be in. Ideally, it should be followed with contact NCC group. It's already in place. And then the next one that they're receiving after that is an education. Can I have a stressed exit plan? Yeah, but what is it? Once again, it's a great response. You know, it's an ethical response. It's an openness, if you like, to resilience. But increasingly, no, well, not increasingly, but it's not uncommon to get one of the 3 next responses. And proportionality objections. In other words, this big supplier or small supplier to simply push back and say, it's going to cost you. It's going to cost you for us to accommodate this. Now, that's always a really interesting response. It's an acknowledgement that it's not been thought of. It's not been built into the way that they build their services. There's a refusal. It's not in your contract. Strategically, it's kind of a good way to push back, really. It kicks it down to the next kind of contractual renewal and certainly gives time for a supplier to understand the ramifications of this. But very frequently, the first 2 are nothing more than a technical inability to be able to deliver these stressed exit plans. The services are simply not resilient. The services haven't been built with regulatory change in mind. We've had instances where the source code doesn't exist anymore. Or because they've gone through a buyout or a takeover, they've laid off everybody that actually knew how to do it. Or it was really, really stable and it's in a safe somewhere in Geneva and we've lost the password. These things is real stuff that actually happens. But, you know, I've ran a fintech. I won't say it was successfully. I sold it after about 18 months. But I've ran a fintech. So when my customers come to me, used to come to me, you know, I want to be in those green boxes. Yeah, there's no problem saying, yeah, but I don't know what you mean, but I want to be in those green boxes, particularly when you consider that the bottom 3 responses have to be recorded, have to be noted, and have to be reported on to the regulator. Ultimately, what will happen as this goes further on into the process, at-risk suppliers would end up being directly regulated by the regulator. It's some time off, but there'll certainly be some critical third parties issued, well, in theory, by the end of this year, by the end of December. Talking about these things, talking about the potential for failure, talking about how you've considered it, and building plans on how to cope with it will just feed back into trust. Being able to guarantee that your service is available and will be available. Talking about resilience and baking it into it. I talk about it as resilience by design. I wish I'd copyrighted that because somebody trademarked it about 4 months ago and I've been talking about it for 4 years. But yeah, it just builds trust. Are we doing on time? I've got one thing that I've been toying on whether I was going to do it or not, actually. I had a bet with a gentleman last night from GFT. I can't seem to see him. And I bet him that at the end of this, I would get a standing ovation. Slightly annoyed that I didn't achieve one organically, but I'm gonna try and engineer it. And this is genuinely true. It's complete fluke in every single way. At 11:07 this morning was actually a very important time for me personally. 11:07, 4 years ago, I realised I'm an alcoholic and I stopped drinking. 11:07 this morning marked 4 years of sobriety. And if that doesn't deserve a standing ovation, I'm going to start drinking. Thank you.
Well, if you didn't have enough of Wayne just then, don't worry, because he's on the next panel as well. If I can invite the panellists to come and take the stage. This panel is going to be chaired by our good friend Paul Lambertson from Squire Patton Boggs. I'm going to let Paul take things from here and introduce the panel. Paul, good to see you. Thank you.
Great, and so now we're all sitting comfortably, I think. We'll begin. Welcome to the panel session. I think we'll pick up some of the themes that Wayne just talked about, no doubt, amongst others. I'm delighted to be here, and thank you, Julian, for inviting me along. Over the years, I've talked about all sorts of things in financial services around duties, but I've always talked about them from a legal perspective, of course. So I start with, is there a duty, is there an obligation? Has someone done something wrong? Is there therefore a damage or a loss at the end of it? And then some pesky regulators introduced TCF and treating customers fairly, and I thought, hold on a moment, this is a little bit difficult to define in my legal world. This requires some thought and some work to work out how to comply with a general principle to treat customers fairly. And consumer duty took it a step further still. And when I first looked at it, I thought, this is terrible. How are we going to advise our clients to comply? Are we not at risk of somebody turning around some way down the line and saying, you've done it all wrong. You haven't even worked out what consumer duty is. You haven't tested your clients. You haven't worked out what your target market is. And you haven't monitored who's bought your products and how they've used them. So, frankly, it fills me with dread. But I think what we will probably learn from this session and probably from the previous ones is that the solution does seem to be in the tech. And hopefully that is where the trust can be gained. So I'd be really interested to hear from our panel what their thoughts on where consumer duty reaches and how tech can take us into a solution and one that hopefully gets firms to a place where they don't have to ring me up and say, I'm in regulatory enforcement. Because that would be a bad outcome, to use the word outcome. So I think let's just go down the panel and please introduce yourselves as we go along.
So hi, I'm Shiraz Afzal. I'm the Group Legal Risk and Compliance Director at Monevo. Monevo is a software solution that connects brokers or aggregators on one hand with lenders on the other. So we've got around 50, 55 direct-to-consumer brands and around about the same number of lenders in the US and the UK. So, you know, the likes of, you know, if you want to shop for a loan and you kind of go to somewhere like, oh, I don't know, a USwitch or a Confused.com, we're the software suppliers that will bring those consumers their loan offers.
Hi, I'm Nicola Mathias. I'm Risk and Compliance Director at Arrow, previously Freedom Finance. We are a data-driven personal credit matching platform, working either direct to consumers through our website or B2B with partners such as Very, the Co-op Bank, AA, RAC, either of those.
Hi, I'm James McKenzie. I've got a confession, not on the same level as Wayne's, but I'm a data geek. I'm really sorry about that. I'm the commercial director at Hippo, and we work with lots of organisations across many sectors, not just the financial sector, helping them put together their data so that they can really understand what their consumers, their customers are doing, and help them take experience that we've gathered with vulnerable customers in lots and lots of sectors and build solutions that provide answers to the regulatory requirements for consumer duty.
My name's Wayne, and I've checked my phone. I've not been fired, so I'm still involved with regulatory compliance within NCC Group.
Great, thank you. So let's kick off. So data is at the heart of all of this, by the sounds of it. As a consumer, there's something scary about data, and that's largely, I think, around loss, being tampered with, being used in the wrong way. Do you want to tell us what is it about data and its use in this context that is of great benefit to achieving consumer duty? Will it speed up the achievement of those consumer duty outcomes and the way you use it? Do you want to just talk around that subject? Again, in any particular order. Do you want to go first?
I'll jump in. I think from my perspective, if we think back pre-consumer duty, so treating customers fairly, the FCA were at times quite happy for you to roll out your policies, your procedures. It was quite theoretical, whereas under duty, they've made it very clear. I'm very familiar there, just going straight to the duty. But under consumer duty, they've made it very clear that that will not be acceptable. We have to provide real life examples through case studies where appropriate. We have to look into the fees that we're charging and again drive that down into very specific numbers and validate those numbers to the FCA or the regulator when they ask, but also to our partners. So they've made it clear it has to be the full end-to-end journey. We can no longer sit in our silo and pretend that we don't know what's going on either side of the journey that we have. And in Arrow, that means the people who are passing customers on to us and also the lenders or credit providers that we're passing customers on to. So we need to make sure that we can pass information, who are our customers, and again, targeted, not theoretical, very specific, what do they look like, who are they, and how we've provided good outcomes to that customer. And in true regulatory style, that good outcome is very grey. So, excuse me, probably everybody, probably everybody here has had that conversation probably 18 months ago to say what is a good outcome for one of our customers. And we've had to describe that first, but again, that will be data-driven as well.
So in terms of data helping sort of consumers, you know, I'll talk a little bit about the sort of the personal lending market. So, you know, once upon a time when you wanted a loan, you know, you kind of walk in to see, you know, a bank manager, or you'd apply online. I don't know about you guys, but when I applied for a loan, and I'm, you know, 20 years experience in FS, I would still cross my fingers, feel a bit of butterflies in my stomach, and sort of hope that I'm going to get the loan, right? But ultimately, consumers don't want to get a loan. You know what? Consumers kind of want to do the thing that the loan will help them do, right? So when I remember joining RBS years ago, and a guy who used to run retail banking called Benny Higgins said, you know, customers aren't coming in for a loan, they want to get married or buy a car, right? They're not coming in for a mortgage, they want to buy a house, right? So that's the outcomes the customers are trying to achieve, and some of the things that we're doing are merely steps in those outcomes. So over the last 5 or 6 years, you know, what has happened with data is, you know, regulatory intervention mandated bureaus to be, you know, the holders of data, you know, to allow people to access that using something called a soft search, right? So that means that you can have a look and see whether you're going to be eligible to get a loan without doing any kind of harm or leaving a record on your credit file that you're looking for a loan. So what does that mean then in turn? It means then that you've had these, you know, great companies spring up they're all about giving people comparisons about the best loan offers. So instead of just going to one vendor and hoping that, you know what, they're going to give you a loan, then if you do get the loan, you get the rate that they've said they might on their advertising, but also you might not. Nowadays, you can kind of walk into an aggregator, as they're called, and you'll get a wide number of offers from a wide number of lenders with rates that will be what you'll actually get if you apply. So that's, you know, revolutionary from where the market was 10 years ago. You know, 5 years ago, these aggregators didn't exist. The data, you know, the regulations weren't there to allow this to happen. So I mean, there's just one really small example of how the use of data being done thoughtfully has really helped consumers, you know, achieve a far better experience in kind of getting something than they would do otherwise. And now, when you go shopping for a loan, you don't get those butterflies in your stomach and that clenching anymore, and that's got to be a good thing.
It's interesting, if you go back to what you were talking about in terms of the risk around data, I think fundamentally, consumers are funny people, because we're all consumers and we sort of talk about them in third person, and people sort of get really, really concerned about, well, what happens if I share my data? When a customer sees the value in sharing their data, actually giving that data away doesn't become such a problem. If you look at Tesco and you look at Sainsbury's with Nectar cards and Club cards, there's a massive jump to sharing lots of data because they get 30p off a jar of Kenko, right? So there is a concept there that if I see that value, I don't mind that. I actually think the issue in the financial services sector is with the providers and how they look at data. Because, and we see it across lots and lots of different areas, but you know, if you see data as a risk in your organisation, which is not unlikely in a regulated industry, if you always see it as a risk and you don't see it as an asset, you're always going to be suboptimal for what you can provide for your customers. You're always going to fall short of what they think their expectations are. And you fail to, we always talk to clients and we always say to them 3 things, right? What data have you got in your organisation and how are you using it? What data have you got in your organisation that you're not using and why aren't you using it? Does that have a benefit for customers? And what data sits outside your organisation that you really should be using to provide that benefit for customers? And I think if financial services businesses get the answers to those questions and are clear on how they can use data as an asset, that's when you get to places like the aggregators. That's when you get to places like, oh, I can see the value in that. But it's got to start within the financial services businesses and organisations because it's too complex for the customer to work out themselves.
My concern around data, this kind of stuff that we're talking about here, very rapidly going off piece, is the data that's not there and what that kind of data is built upon. These lending decisions are based on hundreds and hundreds and hundreds of years of economic data that has revolved around racism, misogyny, bias all across the board. And it's those bits that are missing, those bits that can influence lending decisions that need to sort of be factored into there, those gaps that are there. I did some work, there was a while back with the Data Foundry identifying racist decisions in the South of America, some of these huge data sets that they have there, and it was very interesting to pull out these kind of incorrect lending decisions that were based on the colour of skin. I think having the trust in the data is fantastic, but you also have to understand there's going to be huge gaps there. There's other elements that need to be fed into it.
I mean, that's a really interesting point, but actually I'd wonder whether it's trust in the data or trust in the model, right? Because ultimately data is agnostic of anything. Actually, it's not even agnostic, it's just a thing, right? You know, it is not in itself inherently one or the other, but, you know, for sure there is this inertia of models which, you know, and look, I mean, I'm sure we all understand this, right? But if you're trying to build a model and you've got a bunch of stuff here that's outcomes and you've got to pick some correlatory factors here, right? That's where the bias comes in, because you might pick certain factors that then build that you're attributing these outcomes to, and then those become enshrined. And we've seen that with gender in particular, insurance, right? So this isn't conspiracy theories that we're sitting here kind of smoking up, right? This is, you know, a fact, and there's been regulatory intervention to try and sort of break through that. So I think that's right.
Garbage in, garbage out, right? If you don't have, I get really frustrated about this focus on AI. It's a massive buzzword. AI will change the world. It can do amazing things, but everyone's focused on the big, shiny, wonderful silver bullet that AI can deliver. They're not focused on the stuff that's important, which is what do you train the bloody model on, and how do you get that right? You know, it's all well and good, the government and Rishi sitting on a panel with Elon Musk and being a tech bro. I mean, I'd rather be Prime Minister, but he can be a tech bro whenever he wants. But yeah, if he's looking at the end bit, what organisations and businesses need is guidance, because 95% of them are nowhere near that. They need guidance of how you prevent the garbage in, garbage out and get the bias wrong.
Yeah, that's it. AI, if we use it today, it's built on flawed models. So we'll get the exact same decisions as we're getting today with manual models.
Just quicker.
Just quicker. And I'm a great advocate of open banking, and I think it can do some really good things. But currently, we're still using flawed models with open banking, and lenders are using open banking to say no rather than say yes, which is what it was built for, to see a different way around people's data.
So, I mean, those flawed models still come under the heading of consumer duty. So fixing the flawed models is number one task, by the sounds of it. Yeah. Okay.
On that point, we're working with a very large financial services client, obviously I'm not going to name, millions and millions and millions of customers. Their first iteration of identifying their vulnerable customers on consumer duty, they found about 25,000 out of millions and millions because the model was flawed. Yeah. Their decision-making process hasn't taken this into account historically.
And that's still a subjective model, isn't it?
Of course it is.
Because we all go through vulnerable characteristics at some part of our life, but do we want to, no one wants to be flagged as a vulnerable customer. And I feel very strongly about this, that rather than being called a vulnerable customer, it is a vulnerable characteristic that a customer is going through at a moment in time. Mm-hmm. And that's what we should be educating our people, that's what we should be educating consumers on, is how to not to be ashamed of identifying a vulnerable characteristic and advising that you need support. And the data, more with open banking, should be giving us that information without the customers having to step forward.
So on consumer duty, and I'm not too familiar with it, I've read through it, I've had a look at the elements that possibly relate to what I do. And, you know, there's a tenuous argument that you've got to be resilient, look after your customers, it's really tenuous. But how does it work then? And, you know, are you going to end up with decisions where we're not a lender that you should deal with?
Yeah, definitely.
And after you've got to put their best interests at heart, so have you then got to refer them to I won't say better lender, but a more appropriate lender? Isn't that
or a support, step change, or people like that, the government advisory service, all that sort of stuff.
I think you have to see consumer duty through the lens of the death of rational thinking, right? So, and by that what I mean is, for years, all of our models, all of our economic models, all of our rational, I've assumed that the human is a rational actor, right? And that a human walks into a shop, right, or a loan shop, for example, and carefully scrutinises the paperwork and makes a considered decision around the payment protection insurance premium that's on their loan, and reads the small print and ticks the box and says thank you very much, right? We know now that that's not how humans interact. Humans are this is kind of behavioural economics, right? Humans are a function of heuristics, nudges, biases, right? And FS isn't built that way, right? FS is built around, hey, if you want a product, we'll give you lots of information disclosure, right? And we expect you to kind of get yourself up to speed with that. And I think over the last, so if you think about some of the things that you just mentioned, TCF and senior managers regime and now consumer duty, it's this movement away from thinking about the consumer and the organisation are on an equal footing, right? Actually, you've got a consumer who is not rational, and you've got a big organisation that probably is rational, but it's a bureaucracy. And actually, consumer duty, in my eyes, is more around being, to an extent, paternalistic towards your consumer, and understanding that actually, the consumer is not going to read everything that you put in front of them, and actually, it's not okay to pretend to yourself that they will and make them buy something that actually they're not going to, right? There's a lot of stuff in the consumer duty around friction, when so marketing journeys love seamlessness, they love people just sort of going through and clicking yes, and the regulator saying, well, is that okay, when actually on the other hand you make it really hard for people to cancel, right? And I think from a regulatory perspective, they've been saying this stuff for 10, 15 years, the industry doesn't really seem to listen, or in some areas of the industry practices haven't changed, so I think they end up with this kind of this duty that says, do you know what? Put their interests at the forefront and think about how you can help them achieve their goals, as opposed to you trying to do your own. And that's how I see it. It's real evolution of that kind of understanding of the way consumers behave.
I absolutely agree with that, and I think there's a massive institutional challenge in financial services to use the data to deliver that, because it depends on the more complex organisation you are. If you're a startup fintech, you haven't got legacy systems or policies that are 70 years old or 80 years old. But those big complex organisations are all run in silos, right? So there's a current account team, and all of the support to those customers is built around that current account. There's a separate savings account team, and all of that support is there, and there's an insurance product and an annuity and whatever. What we discovered when we were working with a client is one of the biggest indicators of default on a mortgage or a loan or an insurance product that client had with that banking institution was the number of times a day they checked the balance on their current account, right? Seems really simple, that. If somebody's checking their account 10 times a day, they're worried about money coming in or money coming out, but nowhere in the organisation was there anybody linking that behaviour and that data to another product or another thing. And what the data revolution can do is help that paternal growth by starting to draw all of these behaviours together and start to understand how irrational that behaviour is, but understand the data that is showing how irrational that behaviour is. And that's the key to consumer duty, because consumer duty is forcing financial services institutes to think of the whole journey. But most financial service businesses are split up into silos, and that's why there's so much tension.
That's really interesting, because another thing the consumer duty is making firms do is look across the supply chain, right? So actually, the same thing that you've described in an organisation is the same, in sales, right? So so the duty takes firms and thinks about them as either manufacturers and distributors and co-manufacturers, and for the first time it's requiring firms to share information on a sort of potentially a commercially sensitive basis around. So if I'm a manufacturer of a product, actually I've got to tell people who are distributing it kind of who my target customers are, kind of, and how I want to reach them, and then actually I'm then sort of mandated for people to kind of be asking me back. So for the first time, we were going to see this kind of requirement to share information between firms about individual consumers, and that I think is really interesting, because to your point, if big orgs are finding it hard to share data, within themselves, it's going to be even more tricky to kind of do it in between firms. So I think it'll be really interesting to see kind of where this ends up in 5 years' time, when because we're all just taking those first baby footsteps and kind of figuring out kind of what this means. I reckon the next 3 to 5 years are going to be really interesting.
And I think that ties in nicely with your question earlier, Wayne, which was, will you have to bin off lenders that perhaps a company like I would deal with, or we would deal with? And I think that's right. You used to be able to throw enough mud at the wall and see what stuck, as a company like Arrow would just keep piling customers over to lenders. Well, now we need to look at who are our target audience, so who's coming in through our metaphorical door, and then which companies are we passing them out to, and know that we've got the right company for the right target customer. We can't just say, oh, you come and we'll see what we've got for you. It's got to be a lot more specific to that information, and again, data comes into that, because the more data a customer then shares, the more accurate we can be. We just built a bit of a drop here, but we've just built personal credit matching, which if a customer gives us their data, we can tell them which of our lenders has the greatest propensity to approve them for a loan. Not just you're eligible, but actually if you go through, you will actually get this price with this lender, and that again comes down to data and knowing our target audience.
See, this is the bit that I love, that ticks my little brain here, is that so what there is a potential here then is the sort of a referral to other entities. My favourite financial institutions are credit unions. Absolutely love the concept. I can't get why we don't have so many more successful over here. They're huge in the States, and there's a potential to be referring business to these local, regional, ethical, low profit margin lenders. I get obsessed. I flick the lid on calls with large companies that talks about regulation stifling innovation and things like that. It's one of those things that sounds true, but when you peel back any layer of it, it's massively untrue across the board. There's around about 350 years worth of economic data that shows that regulation funnels and guides innovation and creates new market, actually done by Alliance Manchester Business School just over there. So there's this. It's kind of a movement, a market, new opportunities in theory that could come from it. I love all that.
and we use credit unions, and we also look and say, sorry, Mr. Customer, a loan's not the best deal for you right now. We want to put you in touch with Money Helper or Step Change, because they're going to be better for you than us just piling more debt on top of the debt you've already got.
I think it's important for financial institutions to reflect on what happens in other sectors and in the wider market as well, because this is not a problem that is unique to financial services. It's not a problem of trying to understand your customer better through data. And I think there is a tendency, and this is not just down to financial services, it's the same in healthcare, it's the same in legal, it's the same in public sector, it's the same in travel and tourism. You tend to be filled with people who do a career path that they might switch from Barclays to HSBC to wherever, and you're experts in financial services. But being an expert in financial services is not the same as being an expert in data and usage of data. You might be an expert in using financial services data, but that tends to narrow your view of how to solve these problems. And the hard thing is to turn around and go, how are they dealing with this issue in healthcare? Incredibly regulated, lots of personal data. How do I deal with trying to find the right solution for people? How do they deal with it in legal? How do they deal with all those? And I think the one thing I'd love to see is more financial services people saying, how does it happen elsewhere? Because I think that will help the sector massively.
So I think it's a really interesting point, that. And I think one helpful distinction that you can make, I find, is to think about whether something is a commodity or whether it's a utility. And certainly in the world of credit, there's a conversation happening now about whether credit is a utility and not a commodity, right? So what I mean by a utility, stuff that you need, right? You know, we need energy is a really good example. Water is a good example, and I think a lot of the regulation around financial services products is based around, well, you know what, it's a nice to have, right? So the rules around it are more around how do you kind of govern that kind of, it's just the market, you know, and people can kind of come and kind of get it as they like. I mean, it's interesting, right? So we talk about pensions, and everyone should have a pension because actually the state can't necessarily provide it for them, but it's optional, right? So is a pension actually a commodity, or should it be a utility, right? People, you know, struggle with access to credit from time to time, right? So should credit be a utility or is it a commodity, right? The law requires you to have car insurance if you drive a car. So is it right to think about it as a commodity and not a utility? And that's really important because you know what we've seen in financial services is actually a couple of things, and this is the point around trust, which I think is, you know, the overarching theme for these sessions. You've seen industries, so you've seen FS have some really checkered history around looking after its consumers and almost taking advantage of the fact that it's like the captive person, right? So I was telling the story I've opened a couple of bank accounts for my kids, right? One's an HSBC account, one's a NatWest account. I've probably just gifted HSBC and NatWest a customer for life, right? You know, we see, you know, really poor switching across bank accounts, and despite the fact that, you know, we're trying to, right? We thought that switching in insurance was going to be the end all and be all, and we really pushed the comparison sites, and then we found that actually that's not happening. So then the regulator comes along and says, right, you cannot charge new customers less than existing customers. So I think, I think those of us in FS have got this obligation to think differently about the service and product we're providing, right? Some of the things that we sell customers, they need them, and they don't understand the products as well as we do. So there's this real informational asymmetry, and I think that puts a really big obligation on us to look after those customers, and indeed, to your point, to look at how different industries do it, because I think, you know what, some of those difficult questions around how do you give choice to customers whilst it's still a utility, not a commodity, other industries are a little bit further down the path of figuring out the answers to those. And I think it's probably one of the most fundamental questions we've got in our industry right now.
Shiraz knows I disagree with him on one of those comments, so I can't let it go. I have to speak up. So 60% of Gen Z move their bank accounts within 2 years of becoming 18. So we're moving in the right direction. People are more willing to switch. March of this year, 150,000 people moved their current account. And I know that's not a huge number when you look at the whole of the UK. That was in 1 month. And that is the average. So the average in since 2016 to today is 114,000 every month change their bank account. Now that may be that they keep hold of the ones that parents set up for them way back when, but they are switching. And I do think we are becoming more intelligent. With choice becomes the ability to move a lot quicker and a lot simpler. I'm not saying sludge practices don't still exist, but we are getting better at moving people around. People are becoming more savvy. And I know over the last 2 weeks, Martin Lewis has been every day on every forum that he has, whether that be X or Instagram, about companies who are now paying up to £250 for you to switch your current account, in some cases without direct debits. So people are becoming savvy and they are moving. And I do think it is the younger generation, but they're also willing to move. And only 1 in 5 people now, these were stats back from May this year, but 1 in 5 people have been with their bank for 20 years. And okay, it's still a larger number than I'd like to see, but it is getting better every single month. And I think trust plays a big part in that. And I think challenger banks have an advantage there. So challenger fintechs, they are set up in the main to make things smooth, to get rid of red tape, to make things easier. And people are willing to move to those businesses that offer them better benefits and slicker processes. And that's where we all should be aiming for, I think.
And we should take that same mentality. If the customers in FS are looking at better processes, better customer outcomes, the businesses in FS need to be looking at how they deliver better outcomes, and that isn't necessarily by doing a slightly different flavour of the same thing that you've always done. And don't be reliant on a fintech solution to appear to solve that, and if you're a bigger institution, go and buy that or whatever. But it's about look at utilities, look at healthcare, I think gambling and gaming is a really interesting market, albeit it's not a utility, but the way that people are protected and the way that data is used to intervene in people's behaviour to try and protect them, it's a really cultural thing that they are, they through regulation, very regulated industry, but culturally they are really comfortable with protecting their customers because they know if they don't protect those customers, they won't be customers anymore. And I always think, once we've talked, 99% of the time now, we've talked about data and tech. The tech's not the problem. There is a solution to all of this. It's culturally an issue in financial services. Maybe a bit of resource, maybe a bit of time, but it's this cultural issue of changing to be really customer focused that I think is the thing that I see that's quite difficult.
I agree with that entirely. And I think open banking is a really interesting use case for that, right? So if you take many thousand feet above it, you go, well, open banking, in my view, is designed around saying, well, look, if you're a high street clearing bank, you've got everyone's transactions data, right? You can make a really good lending decision on that customer because you see every transaction that they do. So structurally, bank lenders have got an advantage over non-bank lenders, right? As a starter for 10. So if you open up that data sources, then actually that becomes a way of giving non-bank lenders, trying to sort of level that playing field. But then how have people approached that data? It's almost become, there's almost like a lack of curiosity, right? Almost as a case of saying, we have these models that we rely upon because we're really scared of changing from them, right? Because, our whole business is built around these models that give us this sort of stuff. And we sort of tend to use open banking to confirm those biases, those assumptions we've already kind of got, right? What we tend, we've done, over my years, I've probably talked to all of the open banking providers at least 3 or 4 times over the last 5 years, kind of saying what they're saying. And it is all, what strikes me is there isn't yet this kind of real curiosity around what is this data actually telling us. I mean, so that example that you gave there about somebody checking their current account 10 times, right? What does that tell us about that customer? Well, that's really interesting, actually, right? What other kind of stuff could we look at if we looked at open banking data and what could it tell us? Instead, what open banking does, I'm sure someone's going to shoot me down here, we basically take these credit risk models, which are built upon, basically models built upon some quite static bureau payment data, and we just plug in different data into the same model that just tells us the same old stuff, without actually taking, looking at it, well, actually, this is a wholly different data category. Maybe it should be a wholly different data model that we're building to tell us something completely different. But we're not. And I think structurally, it's because, just I think I said, the big orgs have got lots riding upon the coherence of these models. And it's only, the sort of the corporate Gen Zs, right? The smaller firms have got less to lose. We're not married to these models for the last 20, 30 years that have been telling them stuff. These are the firms that can experiment, that can take risks, innovate, and maybe discover kind of something new. And I think that's where a real value that the fintechs within that kind of FS business ecosystem can really drive that kind of innovation forward.
We're sort of getting close to the end, I think, of the session. A couple of things. One thing there is Gen Z seems to have been one then, in terms of looking at converting and moving to to better products and services. So do we think that's all down to the ease of tech? Because isn't there a risk with that, the ease of switching, is that actually it's the ease of switching what won it, not the better product or outcome?
It's the slick processes that Trustpilot put out reports every couple of months on what's making people unhappy and what's making them happy. And really I was going to say 5 things, but I might not remember all 5. So there's a number of things that people are saying keeps them with their institution, whatever that may be, and the others that make them move. And one is ease of service. Another is trusting that their data is safe. That is huge now, trusting data is safe. Another is having a human journey. Now, that doesn't necessarily mean call centres, because on the flip side of that, people don't want to speak to people. They want something quick, they want something easy, but they want it to be human. I mean, there's nothing worse, is there, than press 1 for this, press 2 for that, but it's having those. And again, this is where I think challengers and fintechs are so much better at it. That web chat that's quite humanised, is that a word? Humanised? You know, it's not the press 1 for this, oh sorry, I didn't understand, go back. It's, you feel like you're speaking to a person even if you're not.
But at the same time, the regulator right now is talking about push payment fraud. So actually, top offenders, or i.e. the number of transactions per million that gets flagged the highest for push payment fraud, Monzo, Revolut, the ones where it's easiest to switch. I don't know if you guys saw in the press, Tide, who are a sort of a fintech challenger bank for businesses, they got absolutely smashed with a fraud. And actually, when there's a fraud scenario, you know, sometimes chatbots don't cut it, and actually you need to be able to get through to a human. And Tide would just didn't have enough staff, right, to kind of respond to the queries that they were getting. So I think exactly to your point, you know, there really is a risk that you kind of
get the terms and conditions right, and they've still got to read them and know what they're buying.
Yeah, and people want that ID&V process to be really quick. And if it takes too long, they're switching straight away or they're moving on. And so I think there's a real gap in tech that makes that a quick but really robust process where we can identify the right customer.
There's a real gap in FS, not in other sectors. And I think that's the challenge.
Yeah, you're right.
That it comes back to things like NHS single login, government single login, things like that that are fantastic pieces of you know, front end and back end, marrying the design and the data are really good examples. But again, it's not in FS, and it's this continued focus of, I'll try and find the solution in here. It's take that step back and look across.
Yeah. Or is it that there's more to lose in FS? So there's more to gain for the criminals?
And it goes back to, do you see data as a risk? Do you see data as an asset? And how do you think about that?
We've gone in a full circle.
Yeah, exactly.
I think there's going to be a sort of a shift. I don't know what the 5 things were. You know,
I probably didn't get 5.
And I'd forget them too. But it looks like there's going to be a 6th, and that's the ethical nature of the financial institutions that you deal with. You know, you mentioned in the other report earlier that they want to see companies do more. They want to see benefits to society, and they want to see that the right things are being done. Obviously, that's interesting that it's being regulated, that financial institutions should do the right thing. So is that a lack of trust in the operational or methods of financial institutions, because now they have to do the right thing towards the customer? I think there's then a shift to do no harm. Do no harm, do good. Yeah, it's not just can I have a mortgage, but where does that money go? Who do I invest in? How much oil have I just really bought over the next 15 years? Yeah.
On time, I can see Joe's got his arms fully folded, so Julian's done that. Thank you. Yeah, very good. Thank you very much, panel.
Thank you.
Great.
Well, thank you, Paul, and to all the panel then, and thanks for keeping to time, because we realise this session's quite a long one between the morning break and lunch, so We've got one more slot to go, but it's going to be a good one because you can't have a conference these days without talking about AI. Obviously, we were talking about data quite a lot on the last panel. We've got Alex and Heather from GFT who are going to do a fireside chat about creating real business value from AI and data. So, Heather, I'm handing over to you first. Yeah?
Yes,
Okay.
thank you.
Thank you.
So last time I was actually up on this stage, I was getting my MBA from Alliance Business Manchester School, so I'm excited to be back up here and getting to speak about, I want to say my favorite topic, AI, because you can't go anywhere without it, as you mentioned. So I'll start with a quick intro about GFT. So GFT is a modern platform engineering and data engineering firm. So we're about 10,000 people globally across 15 countries, and we have over 35 years of experience in financial services, and we've transitioned to insurance and industry most recently. So what we're talking about today is really driving that real business value. So I sit on the retail banking team, and we work with partners and platform providers such as Thought Machine, Mambu, and really integrating that network of all of, across the KYC, payments infrastructure, and building new challenger banks ourselves over in Asia and America. So very much excited on this topic. So what I was going to say is Gen AI has sort of taken the world by storm, hasn't it? And we want to talk about kind of, how do you really create opportunities within your organization to be able to perhaps use AI and grow. So I want to start with a question that I'm not sure if everyone can answer in the room, but I'm putting it to you, Alex, is how do you trust AI, and what is it?
Okay, so thanks, Heather. Nice, easy one to start with. Listen, we'll keep this brief, conscious that we're between you and some lunch probably, but just before I answer that question, bit of an intro to myself. Fairly newcomer to GFT, arrived early this year, so I've got 30 plus years experience in IT and technology roles, predominantly in financial services, within more traditional financial services organisations, banks, but more recently, the last 10 plus years of my career, working in kind of challenger banks and fintechs as well. So really excited to join GFT and be part of us now providing support services to a number of clients, and that means we're in a great position then to support a broad range of problem solving across a broad range of industry sectors. So to your question, do I trust AI? Well, that's a big and loaded question, and I'm going to talk as a consumer, I guess, but to answer that question even, I think one of the kind of key questions is kind of what is AI, and I think you're all going to have your own opinions from a consumer perspective what AI is to you. The reality is it's a deep conversation and not something we're going to resolve at the table here today or even in the room probably. But people have been asking this question for years. I mean, this goes back to Alan Turing days. Talk of can computers think, and creation of Turing tests and other models to kind of measure what is artificial intelligence and what is not. There's been more modern definitions of that, which start to explore, AI as human approach type definitions, systems that think like humans, systems that act like humans, and then there's, for some more purists, perhaps an ideal approach, which systems that think rationally and systems that act rationally. On a personal preference, I'm focused in and around the kind of the human aspect. And in fact, I've heard that word mentioned a couple of occasions today. So when we're talking about AI, for me, it's very important we don't lose the human element to that. And we'll kind of come on and talk about that. Do I trust AI? I think the reality is today as consumers, as we all are today, I think I'd kind of classify it in three ways, really. I think there are areas in which I know I'm being AI'd. I know I'm on the end of a bot of some sort, and or artificial intelligence is involved in providing some kind of service to me. And in those cases where I know it and I'm comfortable with it, I think I'm good. Other examples, I think, I start perhaps thinking I'm not engaged with any form of artificial intelligence or robotics or other aspects of automation. And in those instances, I might not know initially, and then I'll find out quite quickly, and then it'll become perhaps a different question for me. And in other examples, I think, we're all being, having AI applied to us in our day jobs and our lives more generally. And in those instances, we might not know. So I guess there's an ethical question about should we know, and should we know how that artificial intelligence is being applied to us, and should we care about that? So I think we've all got a vested interest in this on a personal level. I mean, as an organisation, I think we want to be at the forefront of that conversation and engaging wherever we can, however we can. We've got a specialist kind of machine learning, AI, and data practice, and I know there are lots of active conversations, and I think we're going to keep coming back to this kind of question of what is AI and is it good for us, and how can we ensure it is focused on the benefit of all people?
Yeah, well, sorry to start you with such a loaded question. I'll make them a bit easier now. So we noticed this in GFT and very much AI amongst other disruptive technologies, specifically within retail banking. So we actually launched the Banking Disruption Index, and we've been going, it's a quarterly index looking at consumers' attitudes towards retail banking, and we do have a copy back there, and you guys do recommend reading it. And one aspect of that is AI. So I just wanted to share sort of some of the findings that we found from that report, which is, you know, demographically, the older generation tends to be a little bit more hesitant around AI, but actually that it is a kind of complex attitude. So I think, you know, Alex, your personal sentiments towards it are very much what we see when we've done more of the market research, so it is reflective of that. But actually, through education and awareness of knowing when you are interacting it or using it in cases of fraud prevention are things that consumers are interested in because they can see the benefit and value. And I think that's echoing what I've heard in panels earlier today as well. And then the ethical practices as well. So the consumer, you know, index, consumers are saying they really want to know that those who have their data and they're using AI, they're using it in an ethical way and that they can trust it. I think that's a theme of this, is going through trust. So, you know, it's making sure that you bring your customers really on your journey. So if you are going to use it, how are you using it? And then within your practice, within your companies, making sure you govern that. So getting on to the interesting bit, as we said, we're talking about value. How do you drive value? I want to talk about some real use cases. So where has GFT actually worked with customers to create business value?
Yeah, so I guess this is the really exciting bit about working for GFT. We have the opportunity, to your point, 15 countries, 10,000 plus talents now working for GFT, and we get to engage with a broad range of clients. I'd say primarily, certainly in the UK, in financial services, but not exclusively. We're seeing the benefits start to emerge. We're seeing lots of focus in there, and GFT are providing support to those organisations as they go on that journey. I'm going to preempt anything I talk about by way of use cases, and of which there are kind of 3 I'm going to share with you today. There are literally hundreds. I think we've got 200 plus engagements where we're working within kind of data and AI across our client base. I'll preempt all of this, and based on conversations that had leading to us being on the stage here today, is that data is the key to everything. Everything kind of comes from that. So you can't have machine learning without data. You therefore can't have AI without machine learning, and then you start getting into the deep learning space and applications of large language models and generative AI kind of solutions without sorting your data. Forgive us if we repeat ourselves several times, but I think it's been echoed a lot already, and we're going to do it again. Just make sure we focus on the data first before we start getting too excited about the actual AI kind of applications. But to that point, you know, there are examples where some of those organisations we're working with have, if not they've solved that problem, but they're at least a point they're willing to kind of try and unlock the value out of using AI. I'm going to focus on a couple of generative AI type solutions.
I think that's just hot in the market right now.
Just to kind of bring that to life. It's the hot topic, but AI is bigger than just Gen AI. So credit risk, entity matching. So credit risk has been discussed again several times today. In one client engagement, in one particular scenario, so credit risk assessment, just for those that don't know, and it sounds like there are a few in the room that do, it's a central process for banks minimising loss around incorrectly providing lending to institutions, organisations, and I guess it could be applied to individuals as well. Within financial services organisations, banks, you know, there is a part of the process in terms of approving lending which is incredibly manual. It's a risk entity matching process. So we have worked with that client, and in the example we're giving here, we've used a large language model. We've then applied use of some capabilities, specifically a vector database with some clever algorithm that sits behind that, HSWN for those that want to Google it, and this then allows us to provide what is equivalent to the human matching process that is incredibly manual today in that business operation. So positive news there is that by applying the thinking and the use of that large language model in that kind of generative AI kind of scenario, we've automated the processing and manual matching processing by up to circa 99%. So, I mean, we're talking about, I know there's some scary kind of conversations around ethical use of AI and replacing human beings, but in this case, this is an incredibly boring and odious task for a lot of people, and it's actually between 9,000, 18,000 estimated hours of reduction in processing every year for this organisation. I would like to think that then frees those human beings up who are involved in those processing, perhaps addressing some of those issues that were discussed on the stage around addressing the model question about how we focus our time on improving those models. But so in that example, really positive benefits to the organisation, to probably those individuals involved in that matching process, and allow them to get on with some more interesting work. So I would say that ticks the brief in terms of perhaps a slightly slightly boring in a way, but very kind of highly efficient kind of process. I'll step into a second example. So within the customer services space, so we've heard a lot about consumer duty and regulation. We've also heard about operational resilience, and we could talk about DORA and interesting applications of use of Gen AI to improve some of that as well. But we do have a working example within an insurance company. Some insurance companies, as you may or may not know, experienced huge spikes in demand at certain activities, so severe weather events or bank holidays. Certainly if I'm doing DIY in my house, that usually coincides with the bank holiday, and that's where I'm going to make an insurance claim when I get something wrong. So they customer services teams dealing with these claims, largely over that period, they've identified that when those increases in claim or increases in contact with contact centres, whether it be self-serve or otherwise, or directly to the contact centre, they're largely around kind of 70% of those queries are fairly simple to deal with. It's just they're perhaps slightly broader than the FAQ information that's available either to the contact centre or available online to that customer, to that consumer directly. So using a large language model, again a Gen AI type solution, managed to create a case-based reasoning process which basically draws some information from successfully matched cases, historical cases, and actually based on the information coming in through that conversation with the customer services agent, then it can match that again previously positively matched cases and then provide that as a suggestion, as a suggested outcome to the agent. As I say, in 70% of the cases it's resolved that, I won't say at first point of contact, but certainly it's resolved it quicker than dealing with an agent, and therefore that allows those contact centre agents and other folks to then focus on the 30% that probably really matter. And again, meaning that the organisation from an efficiency perspective can perhaps not have to throw people at the problem and have to scale their contact centre facilities and have folks sitting there unnecessarily between the peaks and troughs.
Yeah.
So it's another really great example. I'll probably finish up with a third. We like doing things in threes here. You can come and talk to us at the back of the room if you want to know more about any of these and others. As I say, we've got plenty of information to draw from. But in the area of kind of general productivity, I think we as an organisation are looking at it. Every organisation will be looking at this. The use of generative AI in the, well, in actual fact, I'll quote Sier on this one, so you might know of him, Microsoft fame. He definitely falls into the camp of thinking AI as an augmented human capability and capacity. So what we're talking about there is effectively Microsoft branding this as kind of co-pilot services, and they're embedding it in that DevSecOps type experience, but also within all of your Microsoft productivity apps. And if you're a Google person, then you'll hear of kind of Duet co-pilot type services being available to you soon. And in effect, what we're talking about is enhancing, supercharging the experience, productivity experience for for people using services, going about their day-to-day trying to create PowerPoint presentations or focus in on building, finding results in research material and other things. So the whole Gen AI human, automated, that kind of augmented experience is somewhere where I think there's going to be a lot of uptake, and I think we'll be all hearing a lot more about these types of products and services in the future. And I'm pretty sure both in a work and a home environment we'll all start to adopt these fairly pervasively.
It reminds me of the saying was that, if you want to raise funding or, raise your share price, you've got to mention AI and your use of AI going forward. So I think common thread I'm sort of hearing, like, as we go through these use cases is really that I think there was a lot of media hype about, AI is going to take all of our jobs or AI is going to do this, but actually a lot of these examples are where AI is sitting alongside the human teams that can then be the teams that can then actually be able to get out of those manual tasks and use more time for thinking. So, but I think you already caveated it again, it depends on the maturity of your organization and what processes you have around to govern these models, and your data as well to feed into those models and how you're going to do it. And then I think, echoing again around the data being key, is very much a thread. In GFT, we sort of launched our ADA marketplace, which is looking across all these use cases. We've just gone globally. We have a lot more use cases we can use, but how do we actually use them? But there's a reason AI and data are in the same acronym, right? Because they are just so hand in hand. So I think, with the last few minutes here, maybe you can just have what are, some challenges that people can think about when they're looking to apply AI in their organizations. And fintechs are well placed because you guys might not have as much historical issuis to start with.
So rather than being specific, I'll give some kind of general challenges as I see it in the market. These aren't, this is I'll do it in threes again. There are more, but I'll give it a few. An overall lack of understanding in the field of kind of machine learning, AI, generative AI, within the general population more broadly. I think I think we've got more work to do there. The necessity to ensure kind of trusted, curated sources of data and to train the models appropriately. It's been mentioned several times before. And I'll end with what I perceive to be a big conversation that started at the moment, a lot more focus needed on this. Lack of kind of formal regulatory oversight and guidance, and I know there was talk of a data and AI summit that Rishi and Elon guest at recently. Very big missed opportunity in the eyes of some of the folks that I know working within that data and kind of AI practice. Much more focused work and effort need to be done in that area to protect the interests of the consumers of these services.
And I think just on a closing sort of note from me, I think one of the key takeaways here is understanding, where the criticalness sort of your processes are. And a lot of these, as I said, are really, you can identify, maybe lower complexity processes that you can then manage and introduce AI before tackling the very large business problems, but actually you can increase value throughout your organization and just the customer service in your software development life cycle. So again, come speak to us. We have probably a lot more examples that would be interesting to share.
Great stuff, and I think we're getting the hook from the waving mic man.
Yeah.
Yep. Thank you very much indeed.
Cheers.
Slightly alarmed by in the last few minutes at 1 minute past 1, but you got through it, so brilliant, thank you. Got a couple of notices before lunch. The first is standing in the middle of the room, just behind the chairs, is Rachel. Yep. Rachel works with the university, she's their engagement officer. She's holding a clinic downstairs in Committee Room A, is that correct? For anybody that might be interested in working with Manchester University. So there are a whole range of options. I'll mention a couple. It could be a placement, it could be an internship, it could be a KTP. Again, very popular, but Rachel is in full command of all of those options, and they are very flexible and obviously a very talented group of people here at the university. So please do speak to her, or at least get her card, get some information, and then have a proper chat with her later on. Second thing is pension funds. It was mentioned earlier, the question was raised, are they a utility or are they a commodity? They're 100% a utility. We have 3 pillars of pension funds in this country, Pillar 1, Pillar 2, Pillar 3. Those are the acronyms. Pillar 1 means the state provides. We're fortunate enough that if you've paid your national insurance contributions or you have credit sufficient to that payment for national insurance contributions, you get a pension. Everybody has a pension. Everybody. I would advise you to go and check it to make sure your national contributions are up to date, but you get a basic pension. And then you can top it up either through a workplace pension, and there's a whole auto-enrollment conversation that's gone on about workplace having to provide you with a pension fund, and then you can top it up further with your own pension funds. So pension funds are very important. They are not a commodity, they are a utility. Everybody has one. It's a good starting place. The other part was I had some reflections on what it means, what trust means in an environment where you're financially excluded, particularly in respect of data. Because a lot of the conversation earlier about trust and using data as a surrogate for trust ignores the fact that some people are data excluded. And I'll give you an example. My father, he's 86. He's the most financially competent man I know. He was a fund manager his whole life. He worked all over the world, and yet he can't make a payment because he's half blind and his hands shake. So when it comes to making a payment, he can't do it. He has to ask me to do it. I have to set it up as a standing order or a direct debit, or he just rings me or one of his grandkids up to do it for him. And that's not a great example. I mean, this is a man who spends his day listening to Bloomberg TV at full volume on a TV that big so that he can keep in contact with the markets and make his investments. And yet he can't pay for his groceries because he can't tap his card properly. And trust for him is going to Waitrose because he can hand the card to the teller. He trusts them for whatever reason, and they tap it for him. So trust is not just about data, it's something far more subtle than that. And then I get on to consumer duty and the trust that the fact that consumer duty means that the philosophical ramifications of this are that you should be taking care of your customer. So let's have a look at an example of where you may not be taking care of your customer when they really need you. I desperately need a loan. Sorry, the data tells me you fall outside of the loan criteria. Sayonara. So where does trust begin? Where does consumer duty begin? Surely it's the onus is on that bank that said no to help put you on a pathway to find an alternative loan. You wouldn't go to them unless you needed one, would you? I mean, some people are desperate for that loan to help them sort out their finances, and yet the banks reject that process. They're people who fall outside of our criteria. We're not going to give them a loan. We had a conference put together by Joe and the team about 3 weeks ago within Kuto with the credit unions. And they're sitting there desperate because they could quite easily make a loan where a mainstream bank wouldn't, if only the banks would recommend. So where does consumer duty begin and where does it end? And I think that consumer duty for me has this moral overlay much more than it does having some kind of process-based, data-driven rule set that says we've done our job, we're now safe. That's just my personal opinion. Enjoy your lunch.
Let's go for it. Let's get started, shall we? So it gives me great pleasure to introduce our second University of Manchester speaker. Is Dr. Lagner in the room? If we could have him up on stage. Join me up on stage, Dr. Lagner. Andrea, it's great to have you here. Please take it away. You can just move your slides forward with that right button.
Perfect.
Lovely stuff. Take it away. Thank you.
So, good afternoon, everyone. My name is Andrea Lagner, and I'm an academic at Alliance Manchester Business School and the Center for Financial Technology Studies. I research the business and societal impact of fintech. It is a great pleasure to be speaking here at the FinTech North conference. It's a fantastic event. I'm learning a lot about the fintech ecosystem in Greater Manchester and the UK. Imagine being so poor that you cannot afford a bank account. You have no access to card payments, you cannot borrow money. you cannot buy insurance services. This scenario is not fictional. It is the reality for many people around the world. 1.4 billion people around the world are financially excluded. They have no access to basic financial services like payments, current account, savings, credit, and insurance services. Most of these individuals live in developing countries. Having no access to financial services hinders people's ability to escape the clutches of poverty. Now, the good news is that fintech innovations can reduce financial exclusion and alleviate poverty. And the good news is that these innovations can reduce financial exclusion, alleviate poverty, and focusing on this opportunity is a great thing for fintech, because it allows fintech to be a force for good in business and society. So today I want to explore with you the topic of fintech-led financial exclusion, which is the use of financial technology to increase access to financial services, especially among individuals who are marginalized and poor in developing countries. I want to focus with you on 3 key points. I will talk about the history of fintech-led financial inclusion, the promise and its pitfalls, and finally I will conclude on how academics, business practitioners, policymakers, civil society organizations, and a variety of other stakeholders can work together to ensure that fintech-led financial inclusion truly makes the world a better place by focusing on economically disadvantaged people. So financial inclusion emerged in the early 2000s as a market-based approach to poverty reduction and economic development. The market-based approach to development has a long history, started in the 1980s. It gained momentum from the 1990s onwards with the popularization of microfinance initiatives. Microfinance promised and promises to stimulate entrepreneurial activities at the grassroots level, develop communities, alleviate poverty, and empower women. By the late 2000s, however, it became evident that microfinance was facing many challenges and falling short of empowering the poor and their entrepreneurial activities. Hence, international development organizations such as the International Monetary Fund and the World Bank, they turned to financial inclusion as a new and broader market-based approach to economic development and poverty eradication. In 2006, famously, the then UN Secretary General Kofi Annan urged stakeholders to empower the poor and to ensure that poor people around the world have access to a wider range of financial services. So microfinance and financial inclusion were and are still related. However, they differ in scope and approaches. Microfinance typically involved specialized institutions that focus on giving loans, small loans, to poor individuals. Financial inclusion is a broader concept and is a broader approach and includes the provision of a wide range of financial services. Importantly, the shift towards financial inclusion in global development governance expanded the range of organizations that play a part in building a financially inclusive society. So in other words, we have now a large group of financial organizations, but not only financial organizations. We have mobile network operators, credit card companies, philanthropic organizations, and fintech companies that they all together play a part in building this financially inclusive society. Now, how did fintech become critical to financial inclusion? When international development organizations such as the IMF or the World Bank, they were shifting from microfinance to financial inclusion, This shift was occurring right at the time when the so-called FinTech revolution was emerging in the aftermath of the 2008 global financial crisis. Within a few years, the financial inclusion agenda and the FinTech revolution will become interlinked. The FinTech revolution is a broad and variegated process of digital transformation in finance, whereby many organizations make a great use of mobile and digital technologies to develop new business models. It turned out that these tech-enabled business models had and have the potential to reduce existing barriers to the use of financial services by excluded, marginalized, poor, and unbanked individuals in developing countries. And these barriers typically include the difficulty to access financial services due to geographical distance or a lack of infrastructure, or financial services that are not suitable to the needs of poor people, and last but not least, financial services that are simply too expensive. On the ground, it was particularly the success story of the mobile money service M-Pesa in Kenya that galvanized the enthusiasm about fintech innovations and their potential to reduce such barriers to financial inclusion. Vodafone and Safaricom, they commercialized M-Pesa in 2007 as a mobile phone service that allows people to pay for goods, transfer money, save money even if they don't have an account with a bank. It works even if you have a old school mobile phone that uses SMS, text, and airtime credit. With the success story of M-Pesa and the fintech revolution in full swing, the IMF and the World Bank, together with a wide range of organizations, embraced the ability of fintech innovations to deliver financial inclusion as an effective approach to poverty reduction. And the most crucial event that completely merged financial inclusion and fintech happened in October 2018 when the IMF and the World Bank launched the so-called Bali FinTech Agenda. The Bali FinTech Agenda focuses on using fintech to deepen financial markets and promote financial inclusion, while at the same time minimizing the risks that are inherent to in the digitalization of finance. With the launch of the Bali FinTech Agenda, a vision of fintech-led financial inclusion burst on the global scene, and this vision of fintech-led financial inclusion takes to heart the United Nations Sustainable Development Goals. So, fintech-led financial inclusion has been a high priority issue in global, regional, and domestic policymaking for a few years now, and it sparked optimism and criticism in equal measure. Optimist views on fintech-led financial inclusion, they emphasize how fintech improves financial inclusion. And accordingly, more financial inclusion equals less poverty, and financial inclusion improves the lives, especially those of poorer women. And recent data by the World Bank show that current account ownership worldwide increased to 76% of adults. And it's not just about receiving payments into current account. It's, research has shown that receiving payments into current account is also a catalyst for using other financial services. And there are several documented cases showing that increased financial inclusion helps alleviate poverty. To be sure, there are still many barriers to the inclusion of the remaining 1.4 billion people, and these barriers range from a lack of reliable digital and electrical infrastructure, identity documents, appropriately designed products and services, and so on and so forth. In other words, optimist views on fintech-led financial inclusion emphasize that we need more effort to reduce such barriers to financial inclusion, because financial inclusion works as a poverty alleviation program. However, there are also several critical views on fintech-led financial inclusion. Some argue that too many organizations refer to fintech-led financial inclusion without a clear and truthful focus on the poor. So fintech-led financial inclusion sometimes may lose sight of poor individuals. Other voices highlight how financial inclusion, and particularly the use of digital financial services, is good for financial inclusion, is useful to improve financial inclusion, but do not eradicate poverty. So, fintech-led financial inclusion is the subject of intense debate. And in my work, I identified several areas where academics, business practitioners, policymakers, civil society organizations, and other stakeholders can collaborate to make sure that fintech-led financial inclusion has a positive impact on the poor. I want to share with you some thoughts on 3 of these areas in particular, and I will focus on business strategy, digital technologies, and the business environment. In the area of business strategy, we need more attention to how mission-oriented fintech firms experienced what academics call mission drift. Mission drift means that over time, companies may act in ways that do not conform with the socially oriented mission they put forward initially. And we want to make sure that the pro-poor financial inclusion mission does not become a secondary aspect when fintech firms face business-related challenges which derive from profitability, the change in regulatory environment, or contrasting views among stakeholders or among managers or employees. A second area, besides business strategy, I'd like to focus on digital technology, or digital technologies. It is important to focus on how digital technologies are developed for and applied to financial inclusion. I and other researchers noticed how many technologies in the past were not designed and implemented in ways that could be used by unbanked individuals based on their habits and needs. In academic jargon, we call it technology appropriation. And recently, many firms successfully designed and implemented digital technologies that can be appropriated by unbanked individuals. For example, a remittance provider developed its smartphone app with the unbanked in mind, making sure that remittances beneficiaries in developing countries can receive money on a mobile money account, such as M-Pesa. Finally, the last area of investigation and intervention is the business environment. The business environment is important because fintech-led financial inclusion is not just the work of fintech firms or single fintech firms, but is built on the actions of a wider community of stakeholders, and altogether this community constitutes the business environment. I want to focus first on the role of civil society organizations. Civil society organizations play an important part in identifying how to better serve unbanked and marginalized individuals. And for instance, research on peer-to-peer microlending in India shows that civil society organizations are crucial in identifying poor borrowers and maintaining a low default rate. Besides civil society organizations, I want to focus on regulation, so the role of regulators. Regulators have an incredibly important role to play. First, sandbox and scalebox activities should be geared towards enabling the scaling up of purpose-driven fintech firms and their success. Second, regulation should ensure that while new fintech innovations are licensed and launched, cybersecurity standards, consumer protection, data privacy are all strengthened. For example, fintech innovations promise to use alternative data derived from the use of mobile phones and social media to evaluate the credit worthiness of poor individuals that have no credit history. Regulators should make sure that alternative credit algorithms do not have a negative impact on poor people's agency and empowerment, ultimately reproducing existing forms of social discrimination. Finally, regulators should also ensure that fintech firms do not lower risk assessment standards to increase profits and externalize the cost deriving from possible defaults. The rise and fall of aggressive peer-to-peer lenders in China are testimony to the dangers of a sector growing unchecked. To conclude, there are a lot of investments going into fintech-led financial inclusion projects. Such investments are a tremendous opportunity for fintech firms to be a force for good in business and society. However, we should ensure that these investments are truly directed towards ventures that improve life chances for poor individuals in developing countries. Fintech-led financial inclusion can make the world a better place only if we truly focus on the poor. It was a great pleasure to share these ideas with you today, and if you want to know more about fintech-led financial inclusion and many other fintech-related research projects, feel free to reach out to me and other colleagues from Alliance Manchester Business School. We have a business engagement drop-in space downstairs, and there you can find out about opportunities to collaborate with Alliance Manchester Business School and the University of Manchester. So thank you very much.
So continuing that theme of FinTech for Good, we're going to move into the world now of green finance. So while some of our speakers are kind of making their way up on stage, I'd like to invite Clare Black to join us as well. I'll leave it to Clare to ably introduce all of our panelists and also introduce yourself as well. It's fantastic to have you back at FinTech North, Clare. So yeah, take it away. Thank you.
Good afternoon, everybody. Hope you're all still awake after lunch, ready for an afternoon of pitching after this. I thought we were just before afternoon break, but I think it's shifted around a little bit, so I shall keep us on time and going forward. I'm Clare Black, Managing Director of Streets Consulting. We're a business development, marketing, comms agency. I'm very much embedded in, well, from traditional, what I call old world financial services through to some very exciting and innovative fintech companies. It's an absolute pleasure to be with you all and our speakers in this wonderful setting. I'd like to thank FinTech North for inviting me along. I must say I love coming to, in my previous role at Innovate Finance, when I first got to know these guys, I love coming along to your events. So I just wanted to congratulate, you all, especially Julian and Chris, if you're still around, on, what you've created here. It's been fabulous to see it grow over the years, and I know from experience the hard work that goes into these things, so really well done. And Chris, if you are still here, I'm waiting for you to come and do the solo on the organ later on. I know he talks about this a lot. Anyway, today we're going to be spending around 45 minutes talking about green finance. That is a very wide topic. Fortunately, we've got some very knowledgeable people who can help me through on this topic. And it's, when I was thinking about this, doing a bit of prep, it can be really daunting. I mean, you read all those headlines, glaciers are shrinking, we've reached the hottest temperature in Earth ever. I don't know, I think back to, when I was starting out in my career as a journalist, flung into deepest West Africa, going around and talking to cocoa farmers. And even then, I remember writing a story saying that 75% of the primary rainforest at that time, this is back in the 90s, had already disappeared, had been dug up to plant coffee and cocoa. I mean, I hate to think what it's like now, 30 odd years later. So it's, you wonder why we're not moving quicker to do something. And it's interesting, hearing Chris talk this morning about in the UK, retrenching a bit on our net zero ambitions. Hearing Janine, my former colleague at Innovate Finance, I was quite surprised at how low that figure was, that only 9% of fintechs are making an impact, in the changes in our planet. I suppose you could say, oh gosh, that's not very much, it's disappointing. Or on the other side, you could see it as a real opportunity. And I know that, some of the people on our panel have taken that opportunity and they're really doing something about it. So it's not all doom and gloom, but it is hard to know where to start, what to do. So we're going to have a quick sort of canter through various topics, looking at the market itself, looking at some of the regulation that's helping to stop the greenwashing that is unfortunately happening. And I know Georgina is quite involved in that side of things. So I think what we'll do to start with is I'll just get our panel to quickly introduce themselves, and then I'll come back and steer us through for the rest of our talk. So, Georgina, do you want to kick off?
Okay. Yeah. Afternoon, everyone. Marvellous to be here. Just a little bit about me. My background is in traditional finance, private client investment management. Nowadays, I largely work as a non-exec, but through that, or in addition to those roles, I chair the ESG advisory board for a firm of wealth managers who have just been B Corp accredited. I'm a member of the Sier Responsible and Sustainable Investment Group, through which we have done responses to the Treasury's consultation on the regulation of ESG data providers. And as a subgroup of that, I co-chair the working group on the sustainable disclosure regulations and labelling regime, which should have been published as a new piece of regulation by the end of September. It has been delayed and hopefully will be out before the end of December.
Hi, so I am Will, the co-founder of Tread. Fun fact to start with, which is in the UK, the biggest source of emissions from the average business isn't anything to do with its operations, it's to do with where it holds its money. And we believe that's wrong, so we founded Tread. What do we do? We're an SME banking platform that basically helps businesses either become greener or hold their money in a greener way. So that's us.
Morning, or afternoon even. Alex Mallard, I lead Tandem Bank, so I've been in consumer credit now for almost 30 years. I lead Tandem and we're on a mission to help mainstream consumers transition their homes and their transport to a lower carbon lifestyle.
Hi everyone, I'm Catherine Caddy. I'm the co-founder of Adopter. So we're the marketing company for green technology adoption. We use digital marketing to help emerging technology solutions to climate change reach the investors, the customers, and the employees that they need to scale.
Thank you all. So in green finance, similar to finance itself, there are lots of acronyms, terms. It can get very confusing. I'd like to start off by clarifying some of those terms. Sustainable investing, SDR, green finance, B Corp, there are loads of them. They're often used interchangeably. So it'd be good if each of you can let us know what the terms mean. I mean, are they even interchangeable sometimes? Georgina, starting with you, can you maybe pick up on those terms, responsible, sustainable, impact, and maybe in the context of the recent consultation on investment labelling?
Yeah, so a year or two ago, the Treasury basically stated very publicly that they no longer believed in exclusion or avoidance as a method of trying to make an impact in any way, using impact with a small I and not a defined term there, because you need to be invested to have influence. And so as a part of that, what they've done is they have consulted on the terminology that is being used in the industry, and this is across products, this is across funds, investment funds. And the three terms that are, or the terms that are largely used are sustainable, responsible, and impact. Impact definitely has more of a definition, because impact has to have something called additionality, and additionality means that there has been impact beyond what would have happened had no action been taken. So impact was already more clearly defined than anything else. But the other two, sustainable and responsible, some firms individually, they made a distinction within their own firm as to what they meant by responsible, what they meant by sustainable. But if you went to another firm, you wouldn't necessarily get the same thing. So the consultation that we've referenced that is, as I say, hopefully going to be, the regulation hopefully going to be due out by the end of the year, is going to introduce three categories. That is going to be sustainable focus, sustainable improvers, and sustainable impact. Now, consumer impact impact's already defined. I don't think having the word sustainable before impact is great, but impact is the most clearly defined of the three. The other two, the focus, are companies that are already achieving good things through the actions that they are taking without going as far as impact. And the improvers label is for firms that are transitioning. That is going to be the vast majority of the market. And finding out what they're doing and how they are doing it is going to be a big part of the monitoring of the outcomes to see whether they actually fit that label on an ongoing basis.
Great, thank you. And I know we'll sort of come back and touch on that area in a little more detail. Will, if I can move to you, can you maybe just give us a quick definition of B Corp and what that means? Hear that and see that a lot.
Yeah, I guess like by a show of hands, who has heard of B Corp? Okay, right, actually, there's a lot. So, for those who do know and who don't, B Corp is an accreditation that you can get, which is for businesses to show that they have high social and environmental performance. So it's a series of questionnaires, and you basically go through that and monitor each one of the elements of your business. So, do you have an impact on the environment? Do you have an impact on social elements? Do you have fair treatment for your employees, etc.? And so what it means is that when you become a B Corp certified business, so as Tread we've gone through this and became certified this summer, it means that not only are you sort of holding yourself to a high standard, but you're improving or sort of committing to improve that across the board. So if you can see the B Corp logo on any business, it means that they've held themselves to a high standard, and they will continue to do so. The other thing that I think it does is it makes you as a business give a legal commitment to not just focus on profit, but to combine both profit and purpose.
And do you have to keep doing that on an ongoing basis?
Yes, so there's an initial questionnaire and an initial form that you go through, and from that you then renew it every year, which is either you've improved some areas, and it does give you a really good indication of where you're performing well as a business and where you can improve, and then each year you go through the same process.
Great, thank you. Alex, if I can move on to you, it's maybe a bit unfair to this question to do in 2 minutes. It's quite big. But can you have a go at categorising green finance?
Yeah, so the EU's developed a taxonomy, and it's highly likely that the UK is going to follow that taxonomy. The taxonomy has 6 core objectives across climate change mitigation, climate change adaptation, pollution prevention and control, sustainable use and protection of water and marine resources. And to qualify as a business, you have to focus specifically on one of the areas of taxonomy, but importantly, not harm any of the others. So Tandem, we focus on climate change mitigation through our lending and biodiversity through our people. So some examples of that in Tandem itself. So we've developed our products to a green set of products in line with that EU taxonomy. So we have 3 categories that we work to. So we have green loans, greener loans, and then obviously non-green everything else. So in green loans, these are generally emission-free products. So things such as EVs, chargers, heat source pumps, or maybe solar panels. And Tandem to date has helped over 10,000 customers install just solar panels alone on their properties. In greener loans, it's generally improvements to efficiency or a reduction in emissions. So things like financing of clean air zone vehicles, energy efficient boilers, insulation, all help reduce emissions. And then obviously, and to date, Tandem's done over 600 million of financing in that sector to consumers. And then everything else is non-green. So again, currently as a bank, Tandem has 71% of all loans have gone into green or greener lending. And we're targeting 85% by the end of 2026.
Great. Well done. On both counts, I'm fitting it all in. Kat, can I come over to you? I know we were chatting earlier, and it's fascinating to me the work you're doing integrating nature and biodiversity into financial markets. And I think people don't often think about that, or they don't actually see how you can do it. So could you maybe just talk to us briefly about another acronym, TCFD? I'll leave you to talk about it. Do it at a high level. We'll come back to that later on as well in our market section.
Yeah, sure. So TCFD is one of the many, many acronyms. So I'll try and break up all the acronyms in this explanation. So it stands for the Task Force on Climate-Related Financial Disclosures. So it's created by the Financial Stability Board, and it's a single accessible framework for climate-related financial disclosures. So to kind of break it down, what does that actually mean for you? As an investor, it means that you have a comparable measure of climate impact, and you can look at different investments on that basis. And for regulators, it also acts as a framework on which to base future regulations. So recently the ISSB, which is the International Sustainability Standards Board, developed their set of climate disclosure standards from the TCFD framework, and that will be most likely mandated for listed companies in the UK from July 2024.
Great, thank you very much. I'm going to move us on to sort of look at some of the aspects of market, how we make all this function within, obviously, your areas of expertise and what your companies are doing. Alex, if I can come to you first. Wondered if you can talk to us a little bit about how important, green, ESG, sustainable issues are to consumers and customers. And I suppose in your world, what do they want from you, financial services in its wider context now that they weren't getting even 5-10 years ago, probably?
Yes, I think generally the UK population, world population, is becoming more and more aware of the issues that we face.
Yeah.
Tandem customers specifically, I would say, have got quite a high level of green awareness. We have around 400,000 customers. We look at all of them customers, and the average EPC on a property is 60 points, or a D, in the UK. Tandem customers are currently at 65 with a UK target of 69. So that starts to show, as a green brand, how we're attracting customers that are looking to make this transition. Again, similar on our customers' transport. So the average emissions of a used vehicle, Tandem customers are about 27 grams lighter than the UK average, and we're only 30 grams away from being at the UK target of 95 grams, which is what the UK and the EU classify as a green vehicle. So I think just in them two statistics alone, it's showing that the bank is able to attract customers that wants to make a difference, and we're nearing 500,000 customers today. We also run what's called a Green Gap report, which gets published annually, and this is to try and document or identify the gap between the intentions of a customer and the actions. And some of the stats that come out of that, so around 69% of respondents are very concerned about climate change, 61% believe it should be treated as an urgent problem. 55 would like to learn more ways to reduce their impact, and the majority would change behaviour if it wasn't for how much it cost. And I think the cost of living crisis is clearly an overlay on this right now. Yeah. So what we're doing at Tandem then for these customers to support that. So we genuinely believe there's a lack of understanding around what can be done. Information is generally fragmented and often contradictory, but increasingly customers are prioritising brands over sustainability over cost. So we are at Tandem building a green hub to help connect customers with information and retailers of these products, trying to incentivise green choices, so rewarding people for making a better decision, and launching products such as EPC reductions on mortgages where you've greened your home, interest-free loans for home improvement lending to make it more affordable, and clean air vehicle financing. So I think the general message for me is consumers are transitioning, and I think sharing the successes will encourage others to do the same.
Great, thank you. And the cost aspect brings me on nicely. Will, I'll come to you. We were chatting about this, and I was interested to see, will the cost of net zero, is it being passed on to customers and consumers? Do they even want it to be passed on to them? We've got use now, I would say, we pay premiums for sort of organic, free range, fair trade, consumer products, but do you think the same will be true as sustainability sort of permeates into, I would say, mainstream financial services? So, is it going to cost us the earth to protect the earth ultimately?
So I think there's a couple of elements. So there's like the balance of purpose and profit, which I think is a really difficult balance to get right. It is more expensive to produce greener goods because you have to not only provide the service itself, but you have to provide that in a greener way, which typically right now costs more because of supply chains, because of carbon credits, etc. Because of that, there's the flip side of that equation, which is, there's the cost element, but there's also then revenue. So for us, we try to diversify our revenue as much as possible. So instead of it being a race to the bottom, it's how can you actually bring different products and services, and specifically within the financial sector. If you're using traditional monetization strategies, you can actually bring in additional ones. So we sell carbon credits through our platform. We sell tailored net zero planning through our platform, etc. So because the financial world is such like a hub of a business is like operating, it's at the heart of its operations, you can kind of monetize in slightly different ways, and that's basically how we've been going about it. The thing I learned the other day was one of Tesla's main revenue streams is not through selling cars, it's actually through selling carbon credits, because it is selling electric cars, which again shows that there are other revenue streams that you wouldn't traditionally think of, but because you're offering a greener product and service, you can then obviously use that to offset some of the increasing costs.
And you're sort of dealing with SMEs as opposed to retail. Are you finding that they are more receptive to these issues? Are they, ultimately they're going to probably have to be more receptive to?
It's an interesting one. So there's the retail customers versus businesses. I think the broader landscape is that businesses are being pushed slightly more in towards the greener space. And I think that's driven by a couple of different things. One is consumer pressure, so people buying greener products and services, greener cars, etc. The other one is that actually there's an amazing amount of people or businesses that sit in supply chains of larger organisations that have to do their carbon reporting and carbon accounting and green sustainability. Because of that, it's getting pushed down supply chains, so into the SME space. And I think kind of push from governments, push from suppliers, and then push from consumers mean that SMEs specifically are being sort of like transitioned quicker than I think the rest of the country.
Great, thank you. Kat, if I can come to you, and just, I know, outside of your day job, the work you're doing in, the Northern FinTech Cluster, I think that's what you said it was called, but correct me if I'm wrong. Can you maybe talk about some of the green finance initiatives you've come across that are really making an impact in the north of England?
Sure. I mean, I think I'm staying here, obviously in Manchester. It is the northeast FinTech cluster, but I'll focus on one area of the work that they're doing, and then I'd really like to invite anyone else on the panel who's come across any amazing initiatives to jump in as well. So the CFIT review, which we mentioned before in terms of that it led to the development of CFIT, also identified top 10 FinTech hubs around the UK. So one of the key emerging hubs that it identified was Newcastle and Durham, so kind of the northeast FinTech cluster. Whitecap Consulting developed the Northeast FinTech strategy, which developed a lot of momentum in the space. And one of the initiatives that's come out of that is called FinPact, which is a one-stop shop for Northeast FinTech for good. So 2 areas that they're focusing on to start off with, but there's still a lot more to come. So the first one is addressing specifically the skills gap, so both trying to maintain talent within the Northeast that are coming out of the universities, and also going into schools and helping with education around financial technology. And then they're also running an innovation accelerator, which includes bringing in students, like top-tier students, to help support the development of early-stage projects. Also sets you up with industry mentors. And also they've developed a kind of an open source data sandbox for you to start testing your ideas. Once you've developed that, you've got the team, you've got the results and the pilot, they'll also help to connect you with specific funders. So if you want to learn more about that, then have a look at FinPact online, and I'm sure they'd love to hear from you. Like I said, lots to come on that. So I don't know if anyone else wants to highlight any particular initiatives that they've come across as well.
I think days like this are great. And I say that as like, I think half the thing is around like learning from other people and learning from, either mistakes that people have made or actually opportunities that people are finding. And so I think whether it's collaborations like FinTech North across, there's also initiatives and leads to share between founders, like founder networks, etc. And I think they're all really, really helpful to kind of speak to as many different people as possible to kind of push your product forward, but also learn a bit about what's going on in the market.
So if anyone's interested in learning more about those, I suggest you come and grab these people during the drinks at the end, if you're still around. Georgina, if we can, I bring it back to data, which, gosh, we seem to spend all our time. Data is such a key to everything, and it's really key to making all of this happen. So I think if you can, given your recent work in terms of responding to Treasury's consultation paper on the regulation of data providers, ESG data providers. Can you talk to us about the challenges of gathering, measuring, reporting data on sustainability and ESG issues? Because I think until we get that in place and everything sort of on a clearer level footing, transparent, people can really understand and hopefully move forward with it.
Absolutely. I mean, I was at, I think, the first Manchester conference, and I think when you look at the profile of the talks over the course of the day, data has just become increasingly important. At every conference every year, there are more people talking about data. The reason Treasury actually consulted in the first place is because ESG ratings providers and ESG data providers do not fall within the remit of the FCA. And so the consultation was basically asking, should that be brought within the regulatory perimeter? And if so, what considerations should we have? And the feedback that went back to the FCA from the TISA group that I was a part of was things like disclosure of methodology and process. Standardisation across the industry is practically impossible, but that transparency so that people can look at it is really, really important. Equally, climate change is a global issue. It's not domestic, it's not just here. Therefore, it has to align to international standards, where standards are being brought in already somewhere else, look at them, see how they can be aligned to them, because the more aligned they are, the easier it is going to be to actually use it effectively and efficiently. Also a lot about the efficiency of data sharing. So whilst standardisation of approach may not be the right way to do it, standardising how you present that data so that it can be transmitted electronically, it can be used more efficiently, it can be used far quicker, and the outcomes that come from it will be not necessarily the same, because there is a judgment call on all of this at all times, unlike far more so than will be in credit ratings. It will improve that the quality of what comes through. There is also a massive link to SDR and labelling, what I described earlier, because all of the monitoring and assessment of those categories will depend on data, and that will depend on ESG data. And finally, the FCA did a separate consultation as well, which was about governance and incentives and remuneration, and whether or not that should be aligned to ESG targets and the data. And there was a real pushback on that. And if you think about it, what we talked about consumer duty earlier, consumer duty is equally as important, the outcomes for the consumer. They weren't talking about doing it in that. And therefore, I think setting targets for how you remunerate people based on achievements of data targets for ESG would be a step too far.
And do you have an idea on timings of,
that
submitting the
consultation was only earlier this year.
Okay.
Anything on that, it's not even got as far as Treasury announcing the FCA.
Okay.
It is definitely being brought within, so it will be a while off.
Yeah, okay, great. We'll get you back in a few months or years' time to see where we've got to. I wanted to move on to discuss the issue of greenwashing regulation. We know it's there. It's a little bit more noise around it nowadays, I think. Will, maybe you can sort of touch on, what can you or the industry, wider industry, do to help consumers to see through greenwashing or any other kind of reputation washing, I suppose?
Yeah, this I was going to say a stat, which might be slightly dated because I heard it a few years ago, but just an example of it. So Shell, the big oil company, generated about 1% of its revenue from renewable sources, but it basically made up over 90% of its external marketing. So you can kind of see that actually being fed information from whether it's companies, individuals, etc., about sustainability and what their commitments to sustainability, it's really difficult. The way that we approach it is I guess there's a couple of different things. So one is looking for certifications, whether it is things like B Corp, 1% for the planet's another good one. But actually having signs of or external validation that the companies are doing the things that they say they're doing. The other thing that we do when we're procuring things or buying things for the company is you just go on the website. Do they have a sustainability report? Do they have a carbon footprint associated with the business that's publicly available? All of those commitments kind of all feed into the looking past greenwashing. Also, there has been a lot of work recently around from the Advertising Standards Authority around what people can and can't say in advertising, especially related to green claims. So I know HSBC was pulled up recently for some of the adverts it was putting out about greener products and services. So I think there's a couple of different things. One is making sure that if you do run a marketing department, only be truthful on it, because that helps half the problem. But also looking for those like third-party accreditations to look past the marketing spiel, which I know is harder said than done.
Sure. Georgina, can I just come back to you to sort of just talk and touch upon what are some of the different obligations that companies have to report on?
Yeah, so I mean, we mentioned TCFD earlier. That is about the risks and opportunities. You have to report on both the risks and opportunities that climate change might bring to your business. And you've got to talk about how that might affect your strategy, what you're going to do about it. It has to be data-based, what data you're going to look at it, how you're going to identify and assess those risks, how you're going to monitor those risks. But then this is only the start, and I think Kat's going to be better placed to talk about the next stage, which is TNFD, which is the Task Force for Nature-Related Financial Disclosures.
Yes, absolutely. Do you want to pick that up, Kat, and sort of talk us through that and what's being done to help companies report on this?
Sure. So the TNFD launched its final recommendations in September of this year, so it's still quite new. It's basically to help organizations to report and act on evolving nature-related dependencies, opportunities, risks, and impacts. So their broad goal is to shift financial flows towards nature-positive outcomes. But what that means kind of practically, again, for people in this room is, firstly, it provides a framework in the same way that the TCFD did for nature disclosure regulation to come through. And you can see a few kind of examples of that happening right now with the SFDR regulation, which is from the European Union, which does focus a little bit on biodiversity impacts. So that is something to keep in mind. It also, in the same way as the TCFD, allows for like the standardization for investors and gives you a framework from which to be able to start to do your nature-related disclosures, which is obviously quite a complex subject in comparison even to climate. It also acts as a framework for companies to take stock of where they stand in terms of nature. Nature is not apart from the economy, it's fundamentally what we all stand on, and I think it's really important for companies to start to consider how nature loss may affect them. It's the fourth largest global risk in the next 10 years, according to the World Economic Forum. So if anyone's curious about nature, the TNFD has a really, really good, accessible introduction, so I would highly recommend having a look on their website and getting an introduction so that you're ahead of the game.
Great, thank you. Alex, could you maybe talk to us about what you're hearing in government at the moment, what's going to help speed up rate of transition?
Yeah, so I recently had the pleasure of attending the Labour Party conference in Liverpool and also a sustainability panel with the Conservative Party. It was pleasing that both parties are still committed to net zero, although, you know, you've seen in the recent government announcements, it's probably a little bit disappointing that some of these dates have been pushed out. That said, there's also an element of realism, I think, now gone into that. You know, you have to start somewhere, and they put some pretty big, bold dates down. You know, practically, though, we're not ready for some of these changes, but we are making steps towards them. So, you know, government's going to be an important part of this. The new stopping of new ICE vehicles, which has been pushed out, but it ultimately will get stopped. Landlords converting their properties to an EPCC to be able to rent them was meant to be 25, it's now 28. And I heard quite an interesting one the other day that they're talking about attaching your council tax bandings to your EPC. So if you have an energy inefficient home, you'll be paying more in council tax. That'll be an interesting one if it meets the meets legislation. That said, I think it's also important just to touch on local councils. I think government has a big part to play here. But 70% of local councils have yet to install any sort of EV on street parking, and also 70% of councils have no plans to do so. So that's not an encouraging statistic, and I think we really need the councils to also buy in. That's on the back of 30 million of funding that was given to councils for EV installation across 22 and 23. So clearly some work to do in the local councils. I think it is pleasing to see, though, that the way the private sector's picking this up, so businesses like Tread, businesses like Tandem, businesses like Octopus, you know, are leading the transition and helping consumers and SMEs make change. And I think that's the takeaway message for me in all of this, is there's a huge opportunity. There's a huge financial opportunity for everybody to sort of, you know, make money and also make good. I don't think you have to choose people or the planet.
Yeah.
And I sort of left it with this is, you know, why didn't Blockbuster video chain become Netflix? And it's because they didn't believe or they didn't see the opportunity that was in front of them. And that's what I see and what Tandem sees as the green transition.
Great. Thank you.
Can I just come back in with,
Please do,
one thing, sort of, you know, pulling together of the few things I've mentioned. In terms of greenwashing, I think one of the biggest steps forward we can take in this is the introduction of this new regulation, because when we were talking about the different terminologies used, the term sustainability, as you can see with, you know, the way the FCA have suggested they're going to do it, sustainable focus, sustainable improvers, you can add another word to that and it can mean something completely different. And when the asset management industry talked about sustainability, they were talking about financial sustainability. So they'd be saying, we do ESG, we are aiming for sustainability. But what they meant was, we are aiming for the financial sustainability of the companies we invested into, because those companies are disclosing their risks, we are assessing those risks, and we are making a judgment based on those risks. What the incoming regulation will do means they can no longer do that. You will not be able to make any claims about sustainability without defining what you mean by sustainability, and if you are categorised as a sustainable focus, sustainable improver, you will have to be achieving environmentally or socially sustainable outcomes. And therefore, the label, even the responsible label for firms that are not, for funds that are not doing anything, will disappear. And that, I think, it has been a massive point of misunderstanding in anyone buying a product, in that they think it's been sustainable, when in actual fact it's just been purely for risk mitigation purposes, and moving away from that is a huge step forward.
It kind of ties it in with, you know, the theme from the previous panel around trust and education, and ultimately, you know, same with open banking, open finance data. If you don't have that baseline and that trust and people really understanding what that means, then it just doesn't go anywhere ultimately. Before we move on to the last few questions, are there any? I'm sort of conscious we've gone quite quickly through a lot of topics, and it is a very wide area. Are there any questions at all? See very well. No? Okay, well, I shall move on to my last question. It's the same one for all of you, so if you can just, you know, keep it to, we are nearly at the end, couple of minutes maximum. So your thoughts on, you know, do you think we can achieve the transformations needed to safeguard our future? Is ultimately green finance here to stay? Who wants to kick off?
All right, I'll kick off then. Yes, I am forever the optimist. I think there's a couple of different things, which is, I think there's been a huge shift over the past 5, 6, maybe even 10 years towards greener financial products, so ESG investing, greener insurance, greener banking, greener loans, etc. I still think there's a big, long way to go, and I think that's kind of one of the challenges, is how do we make that transition happen quicker. One of the big things is, you know, all of the bigger banks have pledged to go net zero by 2050. But if you think about it, customers and businesses don't want to wait 27 years to have a net zero banking product. And so hence why I guess it kind of follows on from your point, which is, you know, it provides an opportunity for businesses like, you know, us providing, you know, green bank accounts for SMEs. And I think that's a huge, optimistic or opportunity-led approach. You know, fast forward 50 years, it's kind of my belief that every financial product, whether it is investment, credit cards, mortgages, loans, etc., will be greener. And so it's just a question of who's going to provide that service. Is it going to be one of the incumbents, or is it going to be one of the new startups, as it were? I hope it's the startups.
You got me to have a go? Yeah, so I mean, the way I sort of look at it, 20 years ago, it wasn't really accepted that there was a problem, although there was some noise that maybe there is a problem, and there certainly wasn't any solutions Fast forward 20 years, we all accept there's a problem and there's now lots of solutions. So I think we're now moving into the next 20 years then, which is now the adaptation of them solutions and the implementation of them. So yeah, I absolutely believe this is here to stay, and we're halfway on the journey now. Just got to finish the other half.
Great, thank you. Kat?
Yeah, sure. I mean, I surprisingly, not so surprisingly, agree. Very definitely optimistic, and I so agree with what you both said about opportunities. There's so much there. A lot of the clients that we work with are absolutely pushing the boundary, and they are going to be the winners. I think it's so exciting to be able to be on that journey with them, and to see companies like yours taking the first step and being first movers is huge. I think that the one thing I wanted to say at the end is that nothing moves without finance. Green tech's not going to be adopted unless there is the finance behind it. So everyone in this room has a responsibility, in my opinion, but also an amazing opportunity to be able to be on the right side of this transition that's already happening. So I just say, go and learn more about it and try and bring that into your work as much as possible, because you're the people who can make a difference.
Absolutely, and hold, picking up on that, hold your bank to account. If you're in a business, hold your leadership team, hold your board to account. I know, Georgina, you sit on some boards. I do and have done, and it's an issue that I would say, 20 odd years ago didn't really feature board level. It should. If it's not, it absolutely should be, along with other important topics. But Georgina, do you want to finish off?
Yeah, I think I absolutely think it's here to stay. I don't think we should underestimate the length of time it's going to take. But if you look at the direction of travel, when I first came across a business that was interested in B Corp, that was 6 years ago. No one had heard of it. It was something completely new. When I took the role as chair of the ASG Advisory Board to get a wealth manager to achieve B Corp accreditation, that was 2 years ago. There weren't many people who were talking about it at that point, although you were, weren't you, two years ago. I think probably Tread was one of the few businesses I knew that was doing it at the same time. But when you look at the number of people in the room who put their hands up when Will asked how many of you had heard of B Corp, that was a huge number, and that is it's a really good sense of the direction of travel we're going in. In addition, when you look at things like TCFD, TNFD is running about 4 years behind TCFD, and TCFD is only just kind of being fully embedded. And when you talk to firms about things like their scope 1 to 3 emissions, there's still a lot of businesses that don't fully understand the difference between the 3 and the fact that your scope 3, which includes things like the environmental cost of your staff coming to work, makes up about 65% of your emissions for an average firm. And so I think there's still a long way to go, but everything that is happening is suggesting we are moving in the right direction, and that is going to keep going.
Yeah, absolutely. I mean, there is more noise about it. People are becoming more aware about it, and I think they're wanting to do something about it. It's just educating both them, the incumbents and the innovators. When I see what's happened in financial services over the past 10 years with, the innovation and the role technology has played in disrupting something that is very traditional, very regulated. It's not an easy thing to do, but I think, the innovation, the technology, it solves those problems, and very good at doing that, so I'm confident that...
One thing I haven't mentioned as well is, obviously the regulation isn't out yet, but one thing the FCA haven't really discussed or made absolutely clear is what responsibility this will land on advisors, and the chances are a client's preference to do with ESG investing is going to become part of the suitability regime. So if you start making recommendations that don't fit, that maybe fit their financial expectations, their financial hopes and desires, but don't fit say the environmental or social ones, then you could fall foul of the suitability rules. And that is largely covered under existing regulation. So it's something that advisors are going to have to get used to immediately, and very, very quickly at least. But it will spark those conversations. It will spark that education.
Yeah.
And it will become far more common to be having conversations about it than it is now.
Yeah. Great. Well, thank you very much. We are 3 minutes early. I'll hand that back to you. Please give a big round of applause for the panel.
Good to see you all.
Massive thank you as well to Clare there for expertly piloting us through that discussion there. That was amazing. We've got about half an hour now to have another networking break. Please grab a coffee, continue those discussions that were happening over lunch. And we'll be back about 3:35, something like that, with FinTech Alliance, and then we'll be moving on to our super fast-paced trademark FinTech showcase after that. So yeah, see you soon. Thank you. Really exciting segment of the event coming up. One of our favourite parts of the day really is when we have our FinTech showcase. We do a series of really quick lightning pitches from FinTechs of all different shapes, sizes. We like to keep it moving, keep it quick. So really looking forward to that. Before we move on to that segment though, I'm going to ask FinTech Alliance and Phil to join me up on stage and just say a few words about the FinTech Development Fund. I also want to say thanks to Lewis and the team at FinTech Alliance for all their help supporting us today, promoting the event, and just in general really, you guys have been fantastic supporters of our community, so big thank you. And yeah, Phil, come and join me up on stage please.
What a weird way, in case you can't see what I look like. Apparently here's a very large photo of my face for you to remind you. Thank you all. First off, thanks to Joe and Julian and the rest of the FinTech North team for inviting us up and also giving us a great day. It's been really enjoyable to see everything that's gone through. So thank you very much. As Joe just pointed out, I'm holding you back from the kind of exciting bit of the day. So I'm going to try and keep this without any slides. I'm just going to do a couple of minutes just to kind of take the opportunity with you all here to just kind of give a couple of minutes on what is the FinTech Growth Fund and what we've done since we launched a couple of months ago, just to make sure we're kind of getting through and everybody's aware. So it was great to see the CFIT guys earlier today, and kind of we've heard a lot about them all day. We were also part of the Khalifa Review, and it's come out from there. So as a bit of history, obviously the Khalifa Review re-highlighted a very well-known growth stage investment gap in the UK. And made one of the recommendations, alongside CFIT as many others, that a new £1 billion fund should be created to invest in UK domestic growth stage fintechs. What that really means, and where the kind of investment remit the fund now comes from, is kind of top end of Series B all the way up to pre-IPO. So we'll be writing cheques for between kind of 10 and 100 million into businesses, basically in the UK, and investing across the entirety of the parameters of the kind of fintech verticals that we see across the space. So everything from the kind of traditional kind of core banking, asset management, etc., all the way through to wealth tech, payments, insurtech, regtech, etc., etc. We've been very glad to, we announced a couple of months ago, middle of August, to be backed by a group of UK strategic institutions, namely Barclays, NatWest, Mastercard, London Stock Exchange Group, and Peel Hunt. There'll be more names coming soon on that. Strategic capital is a really key part to what sets FinTech Growth Fund apart, and also where we think the value add comes for the fintechs and the portfolio companies that sit within us. Mainly because when we look at what the part of the problem was also kind of galvanising, especially when firms get to that growth stage. And we've always been very good in the UK and had a very strong kind of earlier stage investment market, especially at the seed Series A, and we've seen a lot of the firms that are around, especially in the north as well, that we've got. And again, we've had a very strong private equity market at the top, which has kind of left that kind of middle gap sitting through the middle. In that gap, we also find that the expertise that is needed in investors also changes, where the early stage support can be very generic, and as a result has led to plenty of pan-tech VCs in the market. When it comes to true growth stage fintech, where you're looking to scale across large organisations and you're coming deep into the verticals, we found that expertise level needs to increase, and as a result, the access that we have to the strategic institutions, understanding where their problems are facing, what fintech solutions they're looking to purchase and involve themselves, puts us in a really unique position to be able to support the portfolio firms that we have. And we're looking to do that quite actively with our portfolio as we go through. Also related, if you look at the kind of growth stage exits in the UK over the last kind of 5 years, circa 70% of those have gone into strategic M&A, 20% to about PE buyouts, and circa 8% or so to IPOs. Clearly, exit opportunities for those growth stage fintechs are going to continue to come from those strategic institutions. And as a result, we think there's a really interesting kind of collaboration and partnership there. In 1 minute left, before I leave you and go on to the important bits, the kind of three key things for us and what we're focusing on, and similarly how hopefully some people in the room here today may be able to get involved with us as we're going forward. We're starting to look at opportunities, so if you think you fit within our investment remit, please do reach out to us. The team are all pretty public, but you reach out on the website, you'll find all the team there. Please just reach out to us, we'd love to have a conversation. Similarly, if you think you're rapidly approaching that stage, again, please shout and get involved. Hiring the team, we're expanding, currently a team of 12 or so since we launched. We'll be moving up to a team of about 30 over the next year, including hiring people in the regions. We will have people based in Manchester. So please do kind of reach out to us if you think you or people in your network may want to be part of this journey. We'd love to hear. And the final point, which we haven't really talked much publicly about, but I wanted to just spend a minute or so before we wrap up, is on our Beyond Investing agenda. We kind of alluded to this broadly in our press release when we launched in August, but haven't really said anything much more since. But very briefly, our Beyond Investing agenda is essentially the fund's commitment to try and help grow UK FinTech and the wider impact that UK FinTech has across our economy outside of the direct remit of our investments. And then what that really means is we're spending our own capital, so the fund's capital, i.e. our management fees, on a number of projects that are hoping to try and galvanise and support the wider of the UK FinTech sector. That projects will be initially focusing on 3 kind of different phases. First being talent D&I, and that's both within the FinTech space but also the VC space. We're looking to partner and work with a number of the FinTechs and VCs in the market on that, and the work's already ongoing with a number of the interesting strategic institutions that we have. So if you have any ideas in that space, we'd love to kind of hear as we build up the programme. The second is support for early stage founders. Part of being out here and talking to you in these kind of environments is trying to kind of really kind of see how we can support more early stage firms that don't currently fit within our investment remit, get to be able to be within that investment remit. So anything that we can do to support firms in that space, we'd be dedicating both the time of ourselves, our LP network, and the founders that we have within our portfolio to support those firms. And then the final bit, which is also kind of relevant for this building, is the regionalisation and working with the clusters across the entirety of the UK. So that programme of work is being built out at the moment. It's really an opportunity where we can start moulding that and growing it. So if you feel like you have projects that you wanted to do, and I should say on this, there'll be a mixture of existing initiatives that are already out there, which we would like to try and fund and support, as well as initiatives that ourselves and our partners will be working out and building out together as well. So please do reach out again if you've got ideas, suggestions, or telling me what we're completely missing and we're being idiots and you'd love to tell us where we should be aiming it, then I'd like to hear from that as well. And generally, the team's a really open book and we'd love to hear from everybody. So please do shout however we can help. Thanks guys for your time.
I was going to say I'll ask Oliver to limp up on stage, but you move quite quickly then, Oliver. So.
Oh yeah, I can still move at pace. Does this work? Hello.
Andy, can we get the panel mics on, please? So I'll let Oliver do the main heavy lifting on introducing this next segment, and I'll leave it to him to introduce himself as well. But yeah, really looking forward to this next segment, guys. As I said, it's one of the best bits of our events, I think, when we give a community platform to businesses of different sizes, early stage regional startups, tech companies doing interesting things in fintech, and some scale companies as well. So yeah, hope you enjoy. Thanks.
Thank you, Joe. Oh, Jesus. Thank you, Joe. Joe is, of course, correct. This is the best bit. So thanks all for sticking around. I love to keep the energy levels high in this showcase section. The only reason I'm not pacing the stage like it's a rock concert is because, as Joe's pointed out, I'm carrying an injury, an affliction that plagues elite athletes and also apparently middle-aged fat ones, so I can't walk. But hopefully from this chair, I will maintain the energy levels, and I hope also that everyone that's participating today will as well. So first of all, an introduction. I'm the founder of Galibier, the PR firm that partners with FinTech North and has done since time immemorial. Why, you may ask, is there a PR man on stage, an unwelcome interloper at this event? Well, there is some method behind this. PR really is fundamentally about storytelling. Success in fintech, as in any sector, depends on who can tell their story the most effectively, the most memorably, the most credibly. And the ones that really succeed are the ones who can do that very quickly, very concisely, and really grab the attention. And of course, after 4 p.m. at a long event, you really do need to grab people's attention and make them listen. So storytelling is the theme of this last section. We've got a packed agenda of storytellers to join me on stage one by one. They're going to get 5 minutes each, no more. I've got a timer with which I'm going to be very strict. When the 5 minutes is up, a bell will ring. We'll then do very, very quick fire questions from the floor and also from some of our hosts. and then on to the next one. So the challenge really is tell your story quickly. One great example, and I'll introduce him when his time comes, I was talking to one of the presenters just before and asked him what his proposal was. And his first sort of 5 words were, "We stop people nicking money." And I thought, yes, that right there is a story about which I am all ears. I want to hear more. So that's the level, that's the standard we're looking for. I want to hear your proposition. And without further ado, let's start with the first one. Now, Sophie sets a very high standard. Sophie presented at our Leeds event recently and did an incredibly memorable talk. And I found out today that she's doing a different one today. So no pressure, Sophie, but welcome. I'll give a little audible warning when there are 30 seconds to go. So I'll start the clock with 4 minutes and 30 as of now.
Okay, thanks, Oliver. Thanks, everyone, for the warm welcome. My name's Sophie Churchill. I'm a customer success manager, and I work at a company called Marqeta. And it looks like all of you work there today as well, because everyone should be wearing their Marqeta lanyard. So, as you might have recognised from my accent, I actually am not from the north. I'm an intruder from the south, but please don't boo me off stage just yet. I've lived here for about 8 years. I'm based in York, and as I say, I work at Marqeta as a customer success manager. So, you might be wondering what these lanyards actually mean that you're wearing, and what do Marqeta do? Well, Marqeta were the first open API card issuing platform. And our mission was to simplify card payments and empower businesses to launch payment programs effectively and quickly. So as I like to say in the simplest terms, we are the action behind the transaction. And then what I'd like to talk to you guys about today is a recent state of credit report that Marqeta have recently released. It's the 3rd annual one that we've released, and given the time, I'm just going to kind of go through it in a very quick, high-level way. But if you are interested in any of these stats in a bit more detail, then I'd encourage you to visit our website, and then you can access the full report there. So, credit cards. Well, they've become one of the most popular payment methods in the world. 3/4 of Americans have one, 2/3 of UK consumers have one as well, and we rely on them for various things, including large purchases, building up our credit score, or just simply, and more, I guess, apparent now, as a lifeline. So we surveyed 2,000 people in the US and just over 1,000 people in the UK to just gain some insight into the wonderful world of credit. So I'm just going to give you kind of a few stats as we go through the next 3 minutes, and then I'll open up for questions. So the first point is, even loyal customers have their eye on what credit cards to apply for next. So you can kind of see what stats here, like you've got the difference between the UK and the US, but actually what consumers are really looking for when they are shopping around for a new credit card. Number 1 is interest rates. So you don't want to be paying too much for what you're borrowing. Number 2 is rewards, and actually looking at more personalized and tailored rewards now. And then third of all, the kind of credit limit that you're actually being offered. Biggest concern about having a credit card was amongst sort of the younger generation, 18 to 24-year-olds, and when applying for credit, they're ideally looking for a company that's actually just going to do like a soft credit check on them, so that then when they get to the point that they actually then looking to build up their credit score, that's going to help them further down the line with kind of looking to apply for things like a mortgage going forward. Like I say, rewards speak louder than words. So top of the wish list for people on rewards is anything that's personalised nowadays. I was fortunate to come to the event last night, actually, and we all got a personalised mug that we could make with our own avatar, which is amazing. And I feel like we just want that more personalised, tailored touch now in everything we do, and credit and any kind of payment facility is no different to that. So most people are looking at cashback as the number 1, but then people are looking at kind of like multi-purpose points, or number 3 that came out of the survey is that gift cards. Sorry, I sound like I'm actually on Family Fortunes now with our survey said. And then interestingly enough, more women than men prefer to have cashback, but twice the amount of men to women use their rewards for airline miles. Customer loyalty to brands rather than banks highlights an opportunity here for embedded finance. So think top of phone rather than top of wallet nowadays. With mobile payments becoming increasingly popular and I guess just more used worldwide, we're definitely looking at digital innovation and how those smartphone adoption can assist more digital payments now. So of our survey, we had around 50% of US consumers and 24% of UK consumers have a credit card, but then they have a credit card that they've affiliated with a brand. So there's definitely that brand loyalty that people are looking for there. Buy Now, Pay Later is everywhere at the moment. So Buy Now, Pay Later is serving as a credit adjacent service that consumers are interested in building their credit profile. Ooh.
30 seconds.
Okay, I will be quick. So basically, I will just say that one thing that consumers are really looking at is looking to use Buy Now, Pay Later as a way to increase their credit score. Credit remains an absolute lifeline. As we come up to the shopping season, we're going to get a lot more spending, and credit card seems to be the #1 way that people are looking to spend. And then in summary, I just want to say that I think we're going to look to see a lot more brands that want to take advantage of the rewards that launching a credit card can bring. Particularly, it can unlock revenue streams, customer insights, create stickier relationships, and overall, the main important thing is happier consumers. And that is done.
Thank you, Sophie. Maintaining a high bar there, Sophie. Beautifully delivered, beautifully timed. I have a question, but I'm not going to hog this. Does anybody else wish to interject? Oh, there's a hot mic on its way.
Afternoon, so a bit too loud. Hello, I'm Alex. I'm a final year IT and business student at the University of Manchester. Just here to see the latest trends. My question was about linking a credit card to a brand, not a bank. I might have missed that in the presentation. How can a credit card not be linked to a brand or bank? Could you go into a bit more detail about that specific statistic?
Yeah, sure. So actually the statistic is saying that you are linking your credit card to the brand itself. And so it could be, let's give an example of Klarna, for example, that actually you've used Klarna, it's worked well for you, you've maybe built your credit score, actually got some rewards from that, and then you are affiliating with that brand. So if then Klarna or another credit facility were to then offer other financial products, it could be that you've got a bit more loyalty to that particular brand. It doesn't necessarily have to be a bank, is what I'm saying nowadays.
Okay, got it.
Thanks very much.
Thank you.
That's all we have time for. Okay. I have a question which I'll ask you later.
Oh, okay.
It's a selfish question anyway. Probably just try and sell you PR.
Thank you.
Thanks very much, Sophie. Next up, we've got another old friend of FinTech North, a regular now, Mikhailo from CompuTools. Welcome, Mikhailo, all the way from Ukraine.
Thank you. Can you hear me okay?
We can.
Yeah, great. Thank you. So I'll give a brief overview of CompuTools, what we do and how we can help the fintech companies. Briefly about us, we are a technology services company, so we basically help the we are based in Ukraine and Poland, our engineering teams. I'm personally based in Grantham, and that's how I met FinTech North and started to attend these events. Our two types of clients are technology businesses, SaaS businesses who are building their platforms, integrating their platforms, and they need assistance to build those products quicker, or enterprises who are going through the digital transformation, who are changing their technology stack, and they are migrating to newer technical stack. These are the key areas in fintech that we work with. I will mention insurance and banking in a moment. In trading and investment, we work with some trading platforms, including traditional trading and cryptocurrencies, but they insisted on keeping their names under the NDA. And in investment space, we work with more like retail investors, individual investors, those types of platforms. How we do the service, basically several ways. First, we can offer a team of engineers who augment your teams, working according to the processes that are established within your organization. Another way is to have the team that is fully organized with the project management, working with your product teams, head of product, VP of product, product managers, fully organized agile teams. Or the third way is to work on a specific sub-project. This could be a feature, it could be a specific sub-product, or something within your portfolio that you are building and you don't have resources or capacity at the moment. IP rights always stay with the client because that's the service model, and typical engagement, typical projects are, I'd say, 3 to 9 months. That's not the whole duration of the cooperation, but that's usually when the teams are switching from one project to another. A couple of examples, the work that we did for a well-known bank in North America, moving their technical stack to the more modern, more flexible more flexible architecture from monolith to microservices, and also updating the user interfaces, moving and allowing them to move into the retail banking space, while they previously were focused on the more like business-to-business banking. That's the kind of typical technology stack. The way the teams work is looking from the discovery exercise, looking at what needs to be done, design prototypes, and then moving to the technology solution. A technical stack and typical team composition, as you can see on the screen. Very similar in the insurance space. We help the network of real estate agency in the US to integrate in their platform something very similar that we have in the UK, the insurance sort of marketplace where people can find the insurance provider while they are purchasing, when they are purchasing or renting the house, and that's all integrated into the journey. A couple of questions, a couple of projects that we are working on at the moment. We do the work with a company that provides the gift card and works with responsible businesses, ethical businesses, so we help them expand their outreach to their retailers. Then we are helping one of the international digital agencies to do the work with intercompany reconciliation, and we do everything related to actually extracting the data, integrating the data from the disparate systems that they are running. And the third one is...
30 seconds.
Right, and the third one is the work with technology provider who helps to secure the transactions. I guess when to reach out to us is when you have the need of extending your technical teams, when you need independent advice on your technology solutions, either past or upcoming. And also if you want to build the technical capability that you haven't done, or you think it's a little bit too risky to build it on your own, and you'd like to go this journey together with a partner that is there in the long term. And to finish, I'll just leave these points. They come from my experience of being customer relationships director before, but also from the experience in delivery. These are the key points that I think allow you to build long-term relationships with your technology provider, whoever you are working with.
That's time. Thank you very much.
Thank you.
That's perfect timing. Once again, I ask, who's going to stop me from taking over the questions? Go on then. Oh, Julian, and also we've got a hot mic in the audience.
Roger has got a question. Just say where you're from, Roger, so we all know.
Roger Chandler, it's loud, isn't it? Roger Chandler at Streets Consulting. May I ask you a question? there's quite a few software development consultancy companies out there. What distinguishes you from the others that are in this market?
Right. Thank you for the question. I think I've been asking this question myself, and I think first is the attitude. Attitude is something that you cannot replicate. It's the focus on the results that the clients want to achieve. But also another way of differentiation is when you have, let's say, technology stack, more or less the same, approaches are more or less similar. I think it's the experience that is within the business, and we tend to bring the experience not only from the fintech but also from other sectors. Like we work with hospitality, we work with healthcare providers, and there are some challenges which are similar to the fintech, to what the fintech businesses are facing in terms of data transformation, data migration, and so on, for example. So we always bring that experience that we acquired in other projects into the work that we do.
Thank you very much. Nicely and concisely put. Thank you very much.
Thank you.
Thanks, Mikhailo. Next up, we've got Moses. Moses Peter from Money Rates. Welcome Moses as he makes his way to the stage.
Hi everyone, I'm Moses Peter, and I'm here to present to you Money Rates, a product that is disrupting many decades-old industry of currency exchange in Africa by solving these following problems. In Africa, if you want to exchange your money from one currency to another, you need to, especially if you don't share border with the other currency, you need to change your currency A to USD, GBP, or Euro. Then you take your money to the next country and then change it from USD to the country-based currency. In the process of doing that, you tend to lose a lot of money. So when you change from currency A to B, you lose some money. And when you change from currency B to from currency B to A, that's from USD rather, to currency B, you also lose a lot of money. So many people have noticed this problem, and they prefer many solutions. However, those solutions they have preferred also have many problems, which Money Rate is also solving. And one of them is slow transaction fulfillment. So these people that have preferred these problems, this solution rather, they tend to, in Africa we have 54 countries and then 42 distinct currencies. So it's quite difficult for a single company to provide service to all these 42 distinct currencies. So what they do is, when you make a request, they look for, if you want to change, let's say, Naira to Kenya Chile. So they wait for you to make that request, and then after you've made your request, they source a fund, and then change that money for you, and then make the transfer. So this takes so much time, and another problem they have is with liquidity. So because the currencies are so much, and they don't have all of them available, so they tend to take so much time before they can do the currency exchange for you. So this could take as much as a week, 2 weeks, when they're making the transaction. So how is Money Rate solving this problem? The first thing we noticed in the approach these digital companies are taking is they tend to exclude the traditional guys that are doing the currency exchange at the border. Those are the BDCs. So, but what we have done is to include them into our solution by bringing them to our platform to provide the services they provide outside the digital platforms. So we partner with them from different countries, we bring them to our platform to directly exchange money with whomever wants to change. So we have a direct P2P where if I need Naira and I have CDs, all I just need to do is go on this platform, make my offer known, and then the BDCs are there to fulfill my transaction. Then, in doing this, because we've brought a whole lot of people to the platform, instead of the centralized exchange rates that all those other companies have, there are competitive exchange rates. So many people come over with different exchange rates, and when they see that there's competition, so people tend to reduce their exchange rate and make it more realistic. So because of that, you get a better value for your money. And then we have 24/7 liquidity. Because we are not the only one providing, we don't even provide liquidity, right? So it's decentralized. So many people come with their money to change on the platform.
30 seconds.
So anytime you need money, it's always available. So also our transaction is instant. We have partnered with microfinance banks, with M-Pesa, with Vodafone, and mobile money providers to quickly make local transaction super fast. In fact, our transaction could be as fast as 10 seconds, sometimes 30 seconds in the worst case. So we have built a platform, Android, iOS, and a web app to bring everybody on this platform to make their transaction. So we've also created a platform to allow you own your wallet, even though you are not in Kenya. You could own a Kenya wallet, you could own a Tanzania wallet as a Nigerian, or you could currently we support 12 countries, and a single person that is not in all these countries could own all these wallets. So quickly, this is a demo of what we have now.
No time for a demo, I'm afraid, Moses. I have to be strict. I'm sorry.
That's why. So you could just enjoy the demo as you bring in your questions.
Maybe whilst you're doing questions, you can let the demo roll. Thank you very much.
Yeah.
Thanks very much, Moses. We do have time for questions while the demo is rolling.
Have you got a question?
Oh.
Yeah. Everybody gets one question at FinTech North.
Seems to have so many questions.
Hi, this is Shankar from Ticking Minds. What have you done with money rates? What do you think the traditional banks cannot replicate? They can easily do that in a day and be a competitor for you?
Okay, so for the traditional banks, for them to bank in another country, they need license. Apart from license, they need a whole lot of governments that are highly regulated. So it's quite difficult for them to switch to operate in all these countries at the same time, compared to people that are already doing it in place. So that's why we are not trying to reinvent the wheel. We only just partner with existing businesses that are providing these services. And that way, we are extremely cost effective than banks. And that's the reason many people in Africa, they don't change their money through banks. They usually use the BDCs because they have the best rates, unlike the banks.
Thank you very much. Thank you very much, Moses.
All right. Thanks for having me.
Next up, we have Lucy Mounter from Intercash, another long-time friend of FinTech North. And those of you that have been to previous events may have seen Lucy present before. Welcome her, please, to the stage.
Hello everybody, I'm Lucy Mounter. I'm the Senior Business Development Executive at Intercash, and I've been working at Intercash for 6 years now, and I have to say it's a pleasure working with the team and very happy to be placed there. So what does Intercash do? We are a program manager that specialises in prepaid and debit card issuing. So we were established in Canada in 2012 and have since expanded across the globe to various other destinations such as Mexico, Malta, and we also have an office space now in Newcastle upon Tyne, which fits quite well in with our northern hemisphere in the UK. So we're a self-funded organisation as well, so started off as a family-run business. Since then, the team has maximised in capacity, and we are an international organisation, so we work on a hybrid model all across the world and connect with each other on a regular basis, both digitally and in person. And we are issuing cards in the following jurisdictions, which includes the UK, EU, Canada, USA, Mexico, Caribbean, and Latin America. So why does a business need a program manager? So enabled to launch your own payment card product to market, you need to be integrated into the following third-party providers. So this includes the scheme networks. We work with both Mastercard and Visa. Issuing banks, so we have a range of banks that we work with in the UK and internationally as well. The processors, which manage the transaction ledger, so updating the transactions as they happen on the scheme network. And the card manufacturers, where we work with Thames, based out of the UK. So we have a very local presence in the UK, as well as an international presence across the globe. And we're very grateful to our partners for assisting us in being enabled to offer this platform across our clients so that they can launch their payment card products to market. So these are the kind of card products that we offer. So we've got quite a range here, including reloadable cards, so consumers that might want a card product with an expiry date up to 3 years. That could be anything from banking, loyalty, rewards. So rather than just issuing those one-time cards with lower balances that they might be spent quite quickly, then the reloadable cards are enabled to be loaded regularly over a long period of time. So that makes the card product more effective and less waste, less connected to wastage, because the product itself is a very useful and resilient tool. So gift cards, for example, we do offer gift cards, but also virtual cards. So in the sense, if you want to reward your staff or your customers or launch a promotion, for example, rather than issuing them a plastic card, you can issue them a virtual card which can be spent via e-commerce channels. We do also have a range of different materials that we can source via our third-party card bureau. So things like metal cards, which are very premium and very desirable, particularly for high net worth kind of clients, which are very easily recyclable. We also have recyclable plastics and wooden cards. But also quite an exciting product is the wearable items. So things like contactless chips, which became extremely popular after the pandemic, can be embedded into any kind of wearable items, so things like bracelets, key fobs, and there's a never-ending business case of why a customer or client might come to us and want to launch an innovative product on a wearable contactless chip. So this is our prepaid gate, which is our own proprietary technology platform. This is the system that's integrated into all of those third-party providers which I mentioned before. And it's from here that we enable our businesses to either integrate directly with us.
That's 30 seconds, Lucy.
But they can also source very valuable cardholder transaction data to understand how their customers are using their card products, We also offer different ways of launching, so we can do an MVP style solution where if you don't have much investment, you just want to move into the financial space and test the market. It doesn't cost too much investment to launch on a generic branded card. But then we also do have further premium integrations where you can integrate this entire online banking system to your own application, including a website or mobile app. These are all the kinds of functionalities that are available through the card portal, which can also be fully white labeled if you wanted to do that more MVP style speed to market solution. Why choose Intercash? 20 years experience in technical development and innovation, but also the versatility that I mentioned. You know, we don't just look to do very costly integrations from day one and full card designs. If you do want to do an MVP style program, we are very flexible to work with you, consult you, and help guide you through the market with our experience and expertise. Also flexibility to build very innovative products. So the entrepreneurs and SMEs we work with are really the ones that have those very creative business cases, and we assist them with tailoring their ideal products. We're also passionate about our clients' needs and goals. So that's me, Lucy Mounter, Intercash. If anybody would like to discuss how we can launch a prepaid or debit card to market, please come and speak to me. Thank you.
Perfect timing, thank you. Any questions? I was going to say, so far, you collectively have prevented me from asking a single question to any of our speakers, and I think many would say for that reason alone, you are the best audience we've ever had. So let's keep that energy up. Who's next?
Lucy, I'll ask you a question, but don't worry, it won't be the one that you think I'm going to ask you.
Thank you, Julian. I do have the answer to that one if you want to catch up a bit later.
Just let me know, yeah. She actually does know the question that I'm talking about. What would be the ideal size organisation that you would like to work with? So, like, kind of, what's your ideal customer look like?
So thank you very much. We don't have a specific target market. We do see sort of trends of specific industries that might want to have similar ideas about how they want to capture the market. So we've seen a lot of alternative banking recently, SME banks that might be offering banking features like bank accounts, IBANs, but they might not have the full card product available yet. So they might come to us to help them build that outside of their organisation so they're not over-exhausting their internal resources. But we also work with all kinds of industries across, say, pharmaceutical, retail, clinical trials, and the care industry, as well as travel and luxury.
Thank you very much.
Thank you.
Everyone, please join me in thanking Lucy. And next up, we have Miroslava from Griffin. Please welcome Miroslava to the stage. Hello. Thanks for joining us.
I need to figure out the clicker first. Give me a second.
I can't help you there. It's alien technology.
Great. There we go.
There you go.
Hi, can you hear me? Okay. Mike, okay. Hi, I'm Miroslava, head of FinTech at Griffin. Head of FinTech. If you're thinking that's a really exciting job title, probably a bit of a made-up one. It's both of them. What's real, though, is our bank, and let me tell you about it over the next few minutes. We are the new kid on the banking block in UK. We've been awarded a full banking license in March 2023. And ever since then, we've been working really quietly with some of our first customers, trying to become a partner for companies in the UK market that want to become fintechs, even though maybe their main proposition or main solution is not fintech related. So how did this happen? How did we become a bank? We're standing in a beautiful hall, which looks like something out of Harry Potter. The banking license didn't come with a magic wand from Harry Potter. It was a relentless work of about 5 years of a really, really exciting team. Some of them came from companies in USA, some of them from brands that are more known to the fintech in UK, such as Monzo or Form3. And a little bit about our founders. What happens when you take two really geeky engineers sitting in an office in San Francisco? They have an idea, let's go to UK and set up a bank. And that's exactly what happened, and 5 years later, I'm super happy to be standing on this stage talking to you about Griffin. What was one of the main reasons that we wanted to enter the market? As you can see from these stats on the screen, which I'm happy to share with you later, embedded finance. Embedded finance is part of our everyday life, and over the years, gradually it built its way up to being super involved in everything day-to-day users and consumers are doing, the way they're interacting with their money. Okay, so what? We had banking as a service providers in UK, in the market for many years now, embedded finance, banking as a service, it's not a new thing. No, that's true. However, there is a really big difference between providing, so to speak, banking as a service without a full banking license and banking as a service with a full banking license. One of the really cool things about working with a true banking partner is you can make some money from the interest, the funds that are safeguarded with your banking partner. You can utilize already built tech platform, and you can also utilize already embedded onboarding solution. Okay, well, what is that? What is she talking about? Like, why are we still standing here talking about the license? The license is really the core of what we have, but it would not be the same value if it wasn't for the technology platform that enables you to power the financial services that you want to pass on to your customers or their customers. And our CTO and a co-founder has a very beautiful way of describing Griffin. He says, we're just a tech company that happens to have a banking license that will then help you to enhance your proposition further. And then what we're trying to do is to be the bank for fintechs. So super easy integrations through API, wide label technology, and then you can be the next fintech on the market, or you can add another layer of financial services and enhance the proposition you have for your customers. When we break this down, and again, this is a list of products and list of solutions that we are able to offer, and I'm very happy to have a more detailed chat with you about it later. But we want to bring all this to life, so kind of take away what you see on these slides and how does it happen in a day-to-day reality, and what does it really mean for customers? Who are these customers that can be using this new banking as a service provider? Quietly in the background, we've been working with about 6 showcase first market customers from a variety of sectors and verticals who decided to place their trust in our technology platform and a license.
30 seconds, please.
That's a sign for you to wake up in case you fell asleep talking about banking. And then bring our expertise and our license and their ideas to help customers to interact with financial services better in everyday life. What we really put emphasis on in making sure that our partnerships are very open and transparent, and that's also one of the reasons why we're making sure that our sandbox or API documentation are made public. So if we have any engineers or anyone who builds apps as part of their job or in their spare time, you can go on our website, griffin.com, have a look in the sandbox. For the rest of you who spend your free time in a more casual way, you can speak to myself after or my colleague Adam, who is in the room. Thank you very much.
Perfect timing, thank you. Okay, the roving mic is roving. Who wants it?
I'm going to jump in again, just so that you can't answer.
You just want to keep up your 100% record of stopping me talking, don't you?
Yeah. Well, actually, I just wanted to say that David from Griffin got in contact with us at FinTech North quite a few years ago, saying it sounded quite an interesting forum and maybe it would be of interest. So this is the first time we've had you guys speak, so that was brilliant. So thank you very much for coming to be part of that.
Thank you for having us.
Yeah, and I've been getting his emails for however many years it's been, so I've seen the progress. It's obviously it's a tough market to get into at the moment because the investor appetite seems to be getting a little bit more, I say limited, or maybe just getting a little bit more expectant about things. So have you found that? Because you guys seem to continue to raise funding and go through regulatory hurdles quite well.
That's correct, and I think it is a tough market for fundraising, but it also very much depends from the story and the product you have. To get a banking license is incredibly difficult. If it was easy, there would be many of them out there. So that is the real pride and also the very public secret of our ability to connect with the market, connect with the VCs, and connect with our customers before we even fully launched. And we're going to be rolling out in January 2024. So it's not easy, but it's definitely very exciting. Thank you.
Thank you very much. Thanks, Miroslava. Moving on to our next guest, which is Julian Graham-Rack from Prin6 Technologies. Welcome, Julian. Thanks for joining us. And the clock is running.
Thank you, everyone. So, let me tell you about Prin6. We are a digital orchestration platform. What we do is on a foundation of data and analytics. We control every single element of a customer journey, the bits that customer sees, UX, CX, comms, and the bits that they don't see, back office processes, back office data services, third-party services, and we orchestrate all of those together to create these hyper-personalized, incredibly powerful customer journeys. Why do we do that? Well, we created the business because we had two fundamental beliefs. Firstly, we believe that everybody's unique and they need to be served as unique individuals. The second is, we believe the biggest barrier to digital adoption is technology. It's too expensive, it's too slow, it's too rigid, and it is a barrier to innovation. So, what market need do we meet? So firstly, treating customers uniquely is powerful everywhere. We have a client who, by delivering them highly personalized journeys, has transformed their upsell upgrade program beyond what they've ever experienced before, by giving each individual customer a unique journey to upgrade. But our core market is regulated because you have to understand the customer before you serve them in a regulated market. And the whole conversation around consumer duty is fundamentally, that is the issue. Do you understand the customer sufficiently to serve them? Why do we think the technology is inadequate today? Well, we see two fundamental challenges when it comes to delivering customer journeys. One is data fragmentation. Data is everywhere. It's disorganized, you often can't get at it, and it's been hinted at today before, the first thing is get the data. So our first challenge is to go integrate, get, and assimilate the data. And that data then allows you to create highly dynamic, adaptive journeys. The second thing is the technical landscape is fragmenting. Internal systems are fragmenting, but there's all the external SaaS-based really cool stuff, but that's just creating a hugely complicated environment for IT teams to struggle with. And they're failing to struggle with this level of diversity. Let me be clear, IT teams are very good at what they're supposed to do, which is hard, solid, robust, dependable, reliable, back office, ERP-style systems. Where they struggle is digital front-end journeys, because they're supposed to change, they're supposed to innovate, they're supposed to optimize, and IT doesn't like that level of change. So what do we do? Well, that's our job. Our job is to create those rich, personalized journeys. So we liberate that data so you can understand the specific individual customer. That creates actionable insights, something that you can then do something with. And what you do with it, you curate unique customer experiences. We're a no-code platform, so you can configure these exceptional journeys that allow you to engage with a customer how that customer needs. In the regulated environment, one of the phrases we use is journeys that are as short as they can be, but as long as they need to be, so that you can understand that customer. We remove the need for people to plug the IT gaps. Everybody has got the operational workaround. The operational workaround is because IT has been unable to address the problem. It's probably stuck in an IT backlog. It will be there forever because IT is doing bigger stuff. And so we relieve IT of this headache of continual change, obsessive continual change. And we empower the business to own and be able to do that change instead of IT. And clearly I didn't plan this very well because I got 15 seconds late and I'm sure left, and I'm sure I could have said one really compelling
Got 25 seconds left.
Oh, well, this is
luxury.
But,
okay.
But anyway, so that's Print 6.
Thanks very much. We have a question. Is that Roger over there?
So I had one as well.
Oh, okay. Wow. Let the fight commence.
I'm going to catch you out at one point there.
You off the mic. Hey, Julian. Quick question. Who are you targeting with? Who are you targeting within the client base? Because obviously, the IT aren't necessarily going to be.
No, we don't. Our conversations never start with IT. I mean, I and a lot of our team came from the world of consumer credit. That's where this challenge. Anybody in consumer credit will recognise the illities of affordability, vulnerabilities, sustainability, suitability, responsibility. And that was really hard to do, so that's where we came from. So we started the business focusing on credit, but what we find is our customers into credit, debt, advisory, investment, payments, they all have the same challenge of trying to get customers through journeys as efficiently as possible, but without compromising the insight that they have, but equally without putting friction where it's not necessary. But the people who love us are the commercial guys who want to make it as frictionless as possible, but where the compliance guys say that's fine, but you need to make sure you understand the individual.
That was a great question, Roger. It was exactly the question I was going to ask as well.
There we go. Very efficient. Thank you very much. Thanks for joining us. Next up, we've got Becky Baker, who is new to this stage with something completely new, Receipt Safe. Let's all welcome Becky.
Good afternoon, everyone. I am Becky Baker, the founder of Receipt Safe. Receipt Safe is a brand new, shiny company, very, very early stage. So I just wanted to say a big thank you to FinTech North for giving me the opportunity to speak here today and tell you all about it. But also on a personal level, just to be here and immerse myself in the ecosystem and all the learnings that I will take away from today are absolutely massive. So thank you again for that. I'm sure the image on screen looks very familiar to a lot of you out there, and probably, if you're anything like me, fills you with a bit of dread. I'd like to bet that every single person in this room has been asked for their email address whilst purchasing either online or in store, or making a booking, getting some concert tickets. We are constantly asked for our email address. And I'd like to double down on that bet and say that at one point or another we've all hesitated in giving it over. because we know what's going to follow, a whole load of marketing emails that we don't really want clogging up our inbox. It's a real customer pain point, and one that I personally believe is only going to increase as we move towards more digital, paperless receipts. So I'm hoping that the Receipt Safe is going to try and combat that problem. The idea behind the Receipt Safe is that we're a free-to-use app for the consumer. When the consumer downloads the app, they go through a registration process, and they're asked to select a unique handle. Mine, or one on screen there, is ts@trsafe.com. The idea is that then whenever you are purchasing online, asked for your email address in store, making a hotel reservation booking, any of those types of things, booking trips, you use this email address instead of your own personal or your work one. Any email correspondence sent to that address is then received into the app, and we smart file it for you. Not only is this helping take care of your cluttered inboxes, but it's also dealing with that pesky task of life admin. The next time you go for compare the market, getting an insurance quote, use our email address, register the policy with this email address, we'll remind you when it's due for renewal. High value goods warranties, use our email address, we'll let you know when they're due to expire. The other example I like to use personally is I'm going away to New York, very lucky girl, for my birthday in February. Use this email address. The booking confirmation will go in and it will make a suggestion, do you want to create a trip folder for New York? Absolutely, I do. So then whenever I book anything with the same date intervals or anything within the email body that says New York, it automatically files it away in that same trip folder, so that when it comes to taking that trip, I know that all my bookings, reservations, everything is held within that one place. Receipt Safe isn't about disrupting email marketing. We're not completely against it. But what we want to try and do is put the consumer back in control. If I've bought from a product or bought a service, there's a good chance I do want to hear from that brand again, but I want to look for it at a time that suits me. So I want to use the quick search function in the email to bring up all the emails from that brand. And if there's a discount, great, I'll do it when I'm ready. So we're not here to completely disrupt email marketing. The model of the business, as I said earlier, it's free to use for the consumer. So what's the revenue stream, you might ask? There's two different ways we're looking to monetize it. The first, and it's been mentioned a couple of times today, is the brand loyalty and rewards. So like a lot of the major credit card companies do, the individual can expressly consent to share their data, they're in control, and we're empowering them to benefit with rewards and loyalties that are customized to what we know they like to spend on. On the other side of things, I understand that there is immense power in the data we'll be collecting behind all the spending insights. And whilst we wouldn't be sharing those at an individual level, there'll be a lot of work we can do to segment the data that we get in the platform and provide whole of market insights. It's not limited to one banking provider or retail outlet. This will be whole of market consumer spending insights. So our revenue model is the data monetization. As a very early stage business, we've got a phased roadmap because we want to ensure that we're getting product market fit right the way through. I've been having lots of different conversations with people, and we do have a partner who's interested in working with us, and they have an existing platform that has receipt scanning technology. So whether it's physical receipt or paper receipt, their technology allows us to extract every bit of data that's held on that receipt. No matter how big or small, because we really truly understand the power of that data. We currently have an MVP live and available on both the App Store and Google Play if you want to download it. But as I say, we are super early stage, and the reason I'm here today really is just to build that network in the ecosystem. I'm looking to talk to strategic partners who might help us with some of our customer acquisition challenges down the line. I'm not open to funding at the minute, but if there is anyone in the room who wants to give me some money, I will never say no to a conversation. But thank you for your time today, and I hope you can agree that Receipt Safe is looking to solve a problem that we're all going to face in the future, and whilst it's a really simple way to solve a customer pain point, the data opportunities that it presents for the sector are really interesting. Thank you.
Thanks very much, Becky. Any questions?
Go on, Oliver.
Oh, really? It's my turn?
I told you I would catch you out.
No, that's fine. You never catch me out. You're never catching me out. Okay, well, I have a question which I always like to ask, and you actually did start to answer it, which is, when you come to a room like this, you meet so many great people, you make so many connections, and you know, as I will attest over the years, it turns into business. If there was one ideal persona, one perfect person that you would hope to meet in this room, can you describe that persona? Where do they work, what do they have to offer, and what are you selling to them?
I think it would be someone that really understands the value of the data that we will be collecting. It was really interesting. I was fortunate to chat to the chaps from Mastercard last night at the dinner. You know, they do a lot around their data insights platform, and when we talked particularly, and I wheeled out the example of the New York trip again, and we were just sort of saying, can you imagine the power of the data you would get around tourism in different geographical locations? And they were saying, for them, that is something that they get asked for a lot by people like the City of London, City of Dublin. You know, they want to know, when people come to visit their cities, how do they spend their money? What are they looking to do? What are the different demographics? So for me, who admittedly am new to the fintech space, anyone who really understands the type of data we'll be collecting and the value of that and how I can set myself up well for the future in that space would be incredible.
Thank you very much. I think there's a lot of us here that would like to pitch to Mastercard. Talk to Joe, he'll make it happen. He'll lean on them hard. Thanks very much, Becky. Lovely to have you with us. Next to the stage, we've got Tom Woodruff from Mutual Credit Services. Thanks for joining us, Tom. Please join me in welcoming Tom to the stage.
Thank you very much. Good afternoon, everyone. I'm Tom Woodruff, a co-founder of Mutual Credit Services, and we describe ourselves as a network fintech, which is a bit of an unusual term, but I hope over the next 5 minutes I'll give you a sense of what that's about. So, me and my co-founder, I'm actually a physicist. I did my PhD in applied nuclear physics at the University of Liverpool, and my co-founder, Dill Green, is a former architect and a serial founder. And so neither of us have a traditional finance background, but in the last couple of years of working together, we've become, I think, recognized leaders in the emerging collaborative finance space, which I realize is another slightly unusual term, but again, hopefully this talk will give you a sense of what that is all about. And what that really involves, to a large extent, is really looking at tools which are already in use within the mainstream financial and the corporate sectors, and finding ways to adapt that for the real economy, and in particular SMEs. And really the driver for this and the opportunity is that if you look at conditions in the real economy, that graph is from the Office of National Statistics, and we can see things like late payment, bad debt, inflation, increasing energy prices are driving huge numbers of SMEs to insolvency. And the question is, of course, well, what can we actually do about this? And our analysis is that at the moment there are two kind of dominant lenses for looking at this problem, neither of which are actually able to address the root causes. And the first lens is the individualistic, atomistic, one-by-one approach, looking at the balance sheet of a business, looking at its accounts payable and receivable, and saying, well, perhaps we can go to an invoice factor, or perhaps we can take out a loan, and go even more into debt just to keep ourselves above water for a bit longer. And that has its place, but it's not, of course, going to address systemic issues around over-indebtedness and lack of productivity. The other main lens is the statistical, aggregated, top-down policy lens, which the government gets from doing things like survey data. And again, this can be a useful way to understand problems, but actually any intervention which comes from the top down, from the centre, based on an aggregated statistical lens is always going to have unintended consequences and is not going to be able to address the individual circumstances businesses or communities find themselves in. And we maintain that there's actually a third lens, a kind of missing middle, if you want. It's not micro, it's not macro, it's meso. And this is what we see as the network lens, and this is where our concept of a network fintech comes in. And Julian was talking earlier about the fragmentation of data. but actually what's happening at the moment is that invoice data is becoming increasingly digitized, and lots of accounting software packages are starting to become more interoperable, and so actually accessing data about businesses' outstanding obligations to each other, their invoices, is becoming entirely feasible. And if you can collect this data, it becomes entirely possible to apply some very powerful and quite transformative approaches from network science in order to look at interventions in the economy as a network which can actually directly address the root causes of systemic indebtedness and thereby help individual businesses, but also lead to some quite interesting emergent outcomes, which I'll talk about very briefly in a minute. But just to explain what this is showing, this is some data we collected in Lancaster. And we basically did a bit of a survey. We went round to small businesses and we said, can you tell us a bit about your local trading partners? And so the nodes show businesses and the arrows show their payment obligations. And I'll give an example of one of the very simple but quite powerful things you can do if you look at this network and apply some fairly simple tools. And so one thing you often find in these trading networks, once you reach a certain critical density, is that actually you find loops. And the interesting thing about loops is that they're these closed structures where everybody owes each other money. And by default, at the moment in the economy, they're not actually resolved, and a loop is a gridlock situation. All of these businesses can look at each other and go, well, I can't pay because I haven't been paid yet. And unless one of them has some working capital or goes and gets a loan, often these gridlocks will cause systemic late payment. But actually, each loop is also an opportunity. You can simply cancel out the smallest amount of debt common to all obligations in the loop. It turns the loop into a chain, which is much more easily resolved, and it minimizes the amount of money everyone needs to settle their obligations. And if you have a systematic way of collecting that data and running that analysis, you can imagine clearing large amounts of debt from local economies. And so that's exactly what we're building. The outcomes, in short, are for individuals, cash flow is king. For the business community as a whole, systemic late payment reduces. And we argue that actually this is incentivizing the circular economy from the bottom up, with the circular economy being a really key part of efforts to adapt and mitigate to climate change. I'm very sorry to say to Manchester that we're doing this first of all in Liverpool. We're launching Local Loop Merseyside, and that's us. We are very interested in talking to anyone who has a network view of the economy and is interested in making more of their network understanding. If you're a Chamber of Commerce, a local authority, for example, or even just an anchor business, please come and talk to us.
Fantastic. Thanks, Tom. Questions for Tom?
So I'll ask you, Tom. What sort of reception are you getting in your conversations today? You're obviously doing well in Liverpool with that. What were the things that made the penny drop with the guys over there?
I think one of the framings which works really well is the observation. And thanks, Julian, that's taken us a long time to figure all that stuff out, is exactly how you frame these things and present them. But one thing which goes down really well is the observation that, as I briefly alluded to, these kinds of mechanisms are completely normal, unconventional in the mainstream financial sector. Banks have been doing this kind of thing for hundreds of years in their clearing systems. And in fact, every time a group of friends goes to the pub or goes on holiday and uses something like TriCount, you're using a very, very similar principle. And again, it comes back to this missing middle. The big global institutions are doing this and benefiting from it. Ordinary people do it in the pub by buying rounds for each other without even thinking about it. But there's the whole of the real economy in between, for which these tools are just not available yet. And that is a way of presenting it which certainly seems to go down very well with, for example, Chambers of Commerce, because we say we can turbocharge your network using these financial tools.
Brilliant. Thank you very much. Thanks for joining us, Tom.
Just before...
Oh, your mic's died.
Just before you introduce the next speaker, I just want to say we're running a few minutes behind. The drinks reception is scheduled to start at 5 o'clock. The drinks reception is going to start at 5 o'clock. The drinks are going to be served to the room. So in a few minutes' time, the guys will be coming around and you'll be able to get a drink. We'll probably run over by about 15 to 20 minutes, I expect. So we're merging the showcase and the drinks, and then we'll kind of spill into networking after that. Just wanted to let you know, in case you were clock watching at all. Okay, Oliver.
I was going to say exactly the same thing, just thank everyone that stuck around to support these showcase participants. It really means a lot to us and to them. So yeah, we are in the final stretch. I'm sure we're going to claw back some time because there's only a handful of people left. Next up, we've got Georgie from Orlando. Please welcome Georgie.
Hello guys, nice to be here. My name is Georgi Tonchev. I'm the Managing Director of Wando Solutions, a subsidiary company of our main company, which is Bulgarian called Lando. And let me start with a little bit thank you about this wonderful place and wonderful people. We work with companies all around the world, from Israel to the US, from Brazil, all the way to Finland. But we choose Manchester because of its people, to create our first international subsidiary. And so far, it's been successful and we love it. And it's all because of you. So round of applause for all of you, first and foremost. And the guys from FinTech North. So, what's the challenge? One of the biggest challenges we have is like the two main challenges in the tech sector. Too many startups and not enough scale-ups. Similar, too many juniors and not enough senior engineers because the gap of the market is way too big between junior and seniors. And why scale-ups, UK scale-ups can't scale faster enough? First and foremost, the organizational challenges in front of them to establish a scalable model and then to put the right people in the right roles. And this is never easy. What's our mission? And this specific proposition is to help scale-ups to scale faster in a sustainable way. How do we do that? We do that mostly in a, I would say, collaboratively consultative way, getting into partnership with the scale-up and understanding inside out the proposition, the business, the goals, and helping put the framework in place, the process, the right processes, the right platform, the right tech stack, as well as the right people and the right roles, and go from there. Who we are? Wando is a Bulgarian company, about 60 people, about 2016 established, 4 offices in Bulgaria, 1 here in Manchester, projects around the world, kind of different clients all the way from corporates to scale-ups, but I'm here to talk about scale-ups particularly. This is our scaling framework we use, which is not entirely ours. It's kind of based on the STEP framework from Scale Up Institute, kind of a very innovative organization down in London, which we collaborate with, and it's all based on bringing those 3 segments together: technology, people, and execution. And as I said, is on the people side, really is about role definition, creating the right workflows, creating the whole software development processes. It should be scalable, accountable, and avoiding any bottlenecks. Because with a lot of scale-ups, specifically when they merge from startups to scale-ups, they're very chaotic organizations. That's what we've seen. And we've worked with a number of them, I think 5 so far, in different corners in the world, and it's always the same story. Either they have enough financing, but they cannot scale because they cannot hire enough people, they don't have robust processes at the same time, or if they have a big market success, they have difficulties to enhance the products, onboard new customers, and really get it from there. Usually, we collaborate with companies between 18 and 36 months, and what makes us different, and I want to say here, is we're not typical technological partner who wants to stay with someone forever. If we stay, the better, no problem. But what we want to do, we want to work collaboratively and help the scale-up build its internal software development function or technology function. We're happy to upskill people, train people, work together to create the people, a product roadmap as well, and execute it together. And if the scale-up decides to spend more time with us or stay longer with us, which is in most cases, is very welcome to do so, but there is no obligations, because ultimately we want to come in, we want to sort the scalability of it, and yeah, we can continue working with them, but we can get out as well, depending of the requirements. One thing we're very keen on to help address the skills gap as well. Here in Manchester, the great universities, the great coding schools, boot camps, I would say as well, but still more and more big companies are moving their R&D centers here. And so they're kind of hovering all the talent and stuff. And specifically with senior engineers, it's very difficult to find them, very expensive as well. So what we do, we create this managed solution, which pretty much
30
unites.
seconds.
Okay, thank you. Unites kind of some of our specialists based here on the ground in Manchester with junior developers fresh from universities or school or boot camps, and kind of upskill them as we go on the project as fast as we could. So in a way, kind of try to create local opportunities for local people as well. The people we want to employ and currently employing are mostly based in the UK and Manchester as well. There are always support from Bulgaria, but that's not the core of the business model. The business model is kind of the local people to do local projects for local businesses. And yeah, our solution can be kind of employed very easily. We're very happy to discuss. And ultimately, we want to help the scale up, scale faster in a sustainable way. Helping with the people, helping with the technology, helping with the execution. And yeah, that's us. Let's partner up, please. Thank you.
Perfect timing, clearly very slickly rehearsed. Any questions from the floor? Oh, we do have one. The hot mic is on its way.
Hi there, Georgie. How do you define scale up, and what's the ideal profile of fintech that you're looking to partner with?
Scale up, I would say a company which really kind of gets its validation from the market, has enough firepower, it wants to scale fast. The size, we kind of, we're open to size, but mostly we partner with scale-ups between 20 and 80 people, because they're in this kind of a chaotic stage of their development, and they really need somebody to help them kind of put the scaling framework in place, help them execute it, and kind of build the basis for a much better and faster journey going from there.
Thank you very much. A very concise answer. Thanks very much for joining us, Georgie. Next up, we've got Priscilla Israel and James Garner. According to my list, that's 2 people. Okay, I was going to say a violation of the rules, but you're getting away with it. Thanks for joining us.
Thank you. So today I am both James and Priscilla, or Pames, or Gisela, you could say.
I'm not going to presume which of those 2 you are.
Exactly, that's the right attitude. So, folks, it is so exciting to be in front of so many people today. I know it's late and we're all desperate for a glass of wine. And today is a particularly exciting day because we're here to talk about the future of physical spaces. Now, if you've got a lanyard just like this, would you like to just hold it up and show it to me so we can all see it? You are holding a part of the future of every physical space in the world, and it's beginning right here in Manchester. I'm the CEO of Sticky, and Sticky is the operating system for physical spaces where you can solve any consumer or payments problem in a physical space. The problem that we all solved today was networking and finding out each other's information, and also keeping up with the agenda and making sure we all know when the wine is coming out, which, as we can see, is about 1 minute's time. But we can solve other problems in physical spaces as well. And to do that, I'm going to guide you through what it's like for me when I go on a night out. And just as a forewarning, it's pretty messy. So when I start on a night out, I start drinking about 1 or 2 p.m. And I remember just last week, I was walking down the street, and I bumped into somebody who was raising money for charity. And they wanted me to fill out this hugely long form and give all my details away and end up paying the Dogs Trust, not that charity in particular, but a much worse one, for a very long time. And all I wanted to do was just give them £5, but I couldn't. Later on in the day, we got to the restaurant, and we weren't ordering through a sticker at the table, but right at the end, I wanted to pay. I wanted to pay quickly, and I couldn't, because I had to wait for the card machine, and I found that very frustrating. After that, I went to a nightclub, and I was out on the dance floor, and I thought, wouldn't it be great if I could just get a very large, I don't know, vodka and tonic, or, 5,000 shots, which is what I would drink in a very small amount of time. And, yeah, I just couldn't do it. But towards the end of the night, I drank a bit too much, and I felt like I was in danger. I didn't really know where I was. In fact, I couldn't even remember the name of the club, and that does happen a lot. And in this scenario, I really didn't feel very good. But Sticky was here to help as well. These are all problems that we can solve in physical spaces. So I'm going to give you some numbers. Over 1 million unique people have tapped our stickers before, so you're just the latest ones to interact with this technology. Every sticker in the world is unique, That's why you each have a unique business card, and it changed from being that, put your information in, to your own business card at the end. It also means you can turn a sticker into a card machine in real time after someone's paid. It just changes back all by itself. Sticky remembers who you are, so if you take another sticker from downstairs and tap it to set up another business card, you'll see your information is already filled in because it's remembering you and you on your phone. And we're really excited about the possibilities that that creates in the future. We have some really big customers, all the way from the US largest casino company through to Byron Burger here in the UK and a FTSE Top 20. We partner with great companies like WorldPay and Stripe, and also now into open banking, which I'm sure you'll all be excited to hear about, through NuaPay, HSBC Open Payments, Boodle, Yapily Connect, and lots of others. We're one of a very small number of customers or partners or companies that have rolled out open banking successfully into a physical space, and we have a customer that's taken over £1 million of open banking payments in a very short period of time. More generally, we've processed over £100 million of payments, all the way from open banking through to card in a single tap, and indeed, we're on track to process $1 billion by the end of 2024. Each of those payments is 10 seconds or less inside a physical space. So let's talk about stickies a bit more. It's not just about this, it is about the platform and how you build what's on the sticker, but these are an important part of our business because they're easy to deploy inside a physical space. You've got them here on your lanyard, but it could be on the back of your phone, it could be on a table, it could be on a window outside, letting you buy something inside a shop, even at some crazy time of night, through to a little plastic stand that actually lets you make your own card machine. It can be anywhere you like, and they're really powerful. It's an exciting time for our business because we work with some other amazing partners as well, one of which I just really want to name drop today. They're called Assistive. They're in West Yorkshire, just where my hometown is as well, and they've actually helped hundreds of people with quite unique challenges and disabilities get jobs through our stickers as well. Because the sticker remembers who you are, it remembers that person with a unique challenge as well, and that means that when they tap the sticker, they get content and information that's unique to them. In other words, their own learning style. So if I tap the sticker here, I know exactly how to clean a place like this. So it's just a brief kind of 1, 2, 3. But for that individual, it's not. It's more extensive, and it guides them through the whole process. And that makes us all more equal as people and creates equal opportunities. And we're so excited to support use cases like that on top of being a fintech challenger in physical spaces.
30
Folks,
seconds.
It's drinking time, so I'm going to take just a couple of questions, then we're going to have a very large glass of wine. Yes, over here.
Thank you. There's a
just
hot
shout if
mic
you
on the
like.
way. We've got multiple questions, I think.
Hi, I'm still Julian from Print 6. This might be more of a statement, two statements. This is the coolest thing I've seen for an awful long time, but it scares the shit out of me, the amount of data you're collecting on me, and you know everybody I've tapped.
Yes.
That must be a barrier to adoption.
It depends who you talk to. So, like, the biggest group of people we have to get over the line are consumers, because you've got a choice about whether you tap a sticker or not, right? And that's really good, because unlike other things like Bluetooth Low Energy, you don't have a consent there, right? It's just kind of collecting all your data anyway. When you have an app, it's collecting your location in the background. You have to consent, you tap, it's transactional at that particular moment. So we've got to persuade people just like you. The one way we do that is by making your life easier now that you've put some information in. So think about one example. Think about a large fast food chain that's replaced all of their kiosks, which are all dirty and covered in COVID, with cute little stickers like this. You've tapped a sticker in there and you've put in your name and your email address so that they can read your name out when your burger's ready and you got an email receipt. That's great. You then go to Starbucks later on and you're talking to the lovely lady, the lovely barista at Starbucks, and you're ordering face to face. You then simply tap a sticker to pay. She's saving Starbucks loads of money on card machines. Your drink just comes out with your name on it by itself and a receipt, bam, just straight in your inbox, no data entry. That is what consumers want, and we are the guardian of how we share that information safely between our customers, and we're very excited to show the world how we do that as we build the business further.
Fantastic, thank you very much. I'm afraid we don't have time for more questions now, but I get the feeling a few of us are going to want to talk to you afterwards. It's really fascinating and very cool. Thank you very much.
Thanks, folks.
Next we have Gabriella from Goodwith. Thanks for joining us, Gabriella. Please join me welcoming her to the stage.
Right. Hello, Thank you very much for the invite. I am an interloper because I'm not actually from the north, nor am I from the UK originally, but I live in the south, in deepest, darkest Devon, Cornwall. I don't even know where I am. So I'll start with a little backstory. So we're Goodwith. We are building financial confidence and competence in credit-invisible young adults. So after graduating from university some time ago, I got into a lot of credit card debt. I got on the spend down credit to build credit slippery slope. And with no financial education to speak of, I was paying minimum balance and maximum interest. And it was my first very expensive lesson in compound interest. So fast forward to today, and we're still asking young adults to spend on credit to build credit, despite the fact that they don't know anything about money. And despite the fact that financial services don't solely rely on traditional credit scores anymore. So we brought together a team of clinical psychologists, neuroscientists, behavioral scientists, essentially people who understand humans and human data, to help produce a more holistic approach to teaching young people about money, how it works, what the relationship is with it, and develop their financial capability in a more holistic and safe way. And our research shows that financial services are currently misjudging around 6 million young adults. These are credit-invisible young adults, so they have no history. But 2.7 million of them are actually really good with money, but they have low confidence. And frugal Coco, our archetype, is actually being misjudged. So 2.7 million of them. While Drake on Fire, our archetype, is a risky customer at the moment, but he is getting lent some money. So he is at risk of defaulting and getting lent credit. In this scenario, banks are losing £8.7 billion per year, and the Cocos and the Drakes of the world are losing life options. So our behavioral risk model reveals a person's true financial capability without the need for the spend on credit to build credit methods. And it predicts psychological readiness for credit, a better predictor of risk, shining a new light on who the Cocos are, who the Drakes are, what support they need and when. Through Goodwith, credit invisibles become visible. So we developed an app. We take our users through a AI-driven app that delivers financial psychoeducation to build up their FinIQ, their financial IQ, showing then Goodwith who is financially competent and who isn't, and then making them visible to financial services when they're ready. So they download the app, they connect their bank account, we measure their financial capability, the objective financial capability, we deliver personalized content, and then we safe match them, safeguard them, or help them safe pay their debts if they've already gotten into debt. In this scenario, Coco gets confident, Drake gets competent, and financial services are able to increase their safe customer acquisition and reduce loss. So our value proposition for financial services is applied across from acquisition through to affordability and risk, helping people maintain out of debt, unmanageable debt, and helping banks maintain more of the money that they've lent. So banks lose, I think it's 90 pence on the pound when they have to sell to debt agencies. And our mission is to pair responsible banks with responsible people. We're in charging ourselves to build these responsible young adults through our app, and we're asking financial services who are interested to pilot our readiness score with us. So we have 3 banks already signed up to the pilot, and we're looking to invite more financial services to help us further validate our readiness score. So this is the pilot, and this is what financial services get in exchange for it. So we're looking for financial services. We're also hiring, so if you're aspiring CTO or an engineer, we'd like to talk to you. And we're raising angel investments, so if you're interested in supporting a FinTech for Good app that's received Innovate UK funding and various grant fundings, then we'd like to speak to you. Thank you very much.
Thank you. Thank you very much, Gabriella. If there are no immediate questions, I have a very quick one. I'm interested in what your revenue model is.
So our revenue is, when we talked about the safe matching, safeguarding, or safe pay, we would, when Coco is ready to borrow, we would help her access Fair Finance earlier. So it's a matching financial products and services, relevant ones, to Coco, so she can borrow with fairer rates.
So Goodwood would take a commission based on unlocking access to a product that previously wouldn't have been able to be sold.
Exactly, and at a cheaper rate, because we're showing the risk that she represents.
Fantastic. Thank you very much.
Thank you.
Brilliant. Thank you, Gabriella. Thanks very much for joining us. The penultimate participant is Simon Groom from Magnify B. Please welcome Simon. Thank you very much for joining us.
Thank you, Oliver. Hi, everybody. And I know there's quite a few less of us this time of night, but thank you so much for being here still. I think the first thing to say is Magnify B is a bit different. So we sit in the fintech space, we also are in edtech, and we also are particularly around the business tech space. I put this first slide up purposely to show you where we're at. We're about to launch. So we're pre-revenue. We're a business set up with a SaaS-based product, software as a service, subscription-based, trying to help the consultancy world, the accountancy world, and small businesses in general. Yeah. The need. So we've done 2.5 years of research. We've just got to the stage where we created an MVP, but the need is basically the 56% of SMEs that fail due to bad management. And of course, the biggest figure is 60% fail overall in the first 3 years. It's a massive problem we have. SMEs really struggle. And of course, it leads to massive losses in terms of 300,000 businesses failing every year and the job losses therein as well. And the solution, well, it's got to be, as I said before, software as a service. And what we're saying is, we got a what-if analysis tool that analyzes your business. We have something that controls your business in terms of its baseline, in other words, understanding where it is, your performance management. We benchmark your business against your peers. We have data from 6,000 businesses we compare with at the moment. That's rising to 20,000 shortly with our data analytics partner. We also have a learning platform as part of the application, and that teaches you how to do things the next stage. I'm going to skip some of these slides because I think the forum probably needs that. We're trying to support at least 70,000 UK SMEs over the next 5 years. It's really possible because we've already had I guess, requests from a few hundred to talk to us about our early stage adopter launch, which is going to happen on the 23rd, hopefully the 23rd of November. And also accountants, we've got about 15 accountants on board, 2 of which have invested in us as well, which is fantastic. I'm skipping through some of them, but just to explain what it's all about. So we have information coming in, information coming out like everybody else does. But what we do in between is quite unique. So again, think about the fact we've got a knowledge base around all the different things in business you can achieve or you have to go through. So we're covering business development, HR, business process re-engineering, but particularly finance. Everything about what we do is trying to achieve 3 things. It's around productivity, profitability, and cash flow for small businesses. This, bear in mind, came about from when we were thinking about this as consultants years ago and realised the smaller end of the SME scale either can't or won't afford consultancy, can't ask the right questions sometimes because they don't know what they don't know. Okay, so the business model really is very simple. We're aiming to get this out to launch, and we've got it on test at the moment with quite a few companies, £47 per month. Our early adopter deal is less than that, but that's something we can talk about another time. We've got videos on our YouTube channel and our website as well to explain what that's all about. And skipping through to 3 routes to market, key routes. We know there are around 5.5 million SMEs in the UK. What we're saying is 2.8 million actually have a finance system that we can access. We seamlessly bring in that data into our system with your permission. We play that back instead of dashboards, and then we explain how you can get to your goals, and then we teach you how to do that on the platform, all done on the platform, which enables you to then consider, once you've grown a little bit or got to the stage you're financially more viable, to then consider consultancy at the right time, or your accountancy in terms of their services, maybe more tax services than basic receipt processing services. We've also got other referral organisations as well that we're talking to, membership organisations particularly, and letters of intent from one with 18,000 members. and also discussions with the likes of the Federation of Small Businesses and others about how that might affect them as well. And then, of course, direct, as I mentioned before. Forgive me, that should have been silent. Just to say then, what we've got is a potential for funding at this moment in time, but actually we're going to launch as we are. We've got enough funding from angels, which is fantastic, and also support from our development team, which was even greater right from day one. They love what we're trying to do so much that they decided they were going to, and it's an outsourced one, they decided they were going to invest as well. So we're at the stage where we've got lots of people ready to go with this. We've got a real opportunity to try and launch. Our early launch deal is just £15 per month, fixed for 2 years if you pay up front. It's £360 for small businesses. You access the full system we've got currently and any other upgrades, which of course is the full launch in about April, hopefully next year as well. So we're pre-revenue, early stage, and we're looking for people to come on board. Thanks very much.
Thank you very much. If no hands shoot up, I have a very quick question. What you've described is clearly sector agnostic, but would you say there is a particular vertical sector where you're anticipating the most action?
So that's interesting. So in terms of our discussions so far, no. What we found is that accountants really love this. They recognise they can save a lot of money on poor management information or getting better management information for a start, and save a lot of money on their bad data, as they call it, that they get in. So what we're finding is that it doesn't matter what sector, but accountants are our primary aim at this moment in time.
Makes perfect sense. Thank you very much once again. Thanks very much for joining us, Simon. We really are in the final stretch now. I would like to welcome our final participant of the entire day. And may I add, Matt, this is the one I've been looking forward to. Matt is the one who, when I asked him earlier, what do you do? What's your story? He said, I think in 5 words, we stop people nicking money. This is a story I've been looking forward to hearing. So please, Matt, join us on stage.
Don't know if I need to introduce myself now, but yeah, hi, Matt Pennington, co-founder of Safe Capital. We help stop people from nicking money when it's being moved between law firms and their clients. Law firms handle large amounts of money. As regulated professionals, they have designated bank accounts to hold client money, and a lot of regulation around how they should look after it, what they can do with it, what they can't do with it. And as one law firm we spoke to recently said, losing client money is a business ender. Both law firms, regulators and their insurers sort of take a dim view of the loss of client money, and if the losses are significant then the firm gets to shut down. And also due to the large amounts of money that get moved, law firms are basically a target for money launderers and fraudsters. So whatever size the law firm, at the beginning of a transaction, if they've got to get client money, they have to find a way of getting their bank details from the law firm to the client in a secure way. Because a lot of the communication between law firms and their clients has been traditionally over email, firms used to send bank details by email, and fraudsters obviously became clued up to this, started sending bank details at the point people were completing transactions, and that money was getting sent elsewhere. So in most cases, criminals have targeted people moving houses with devastating consequences, lots of money going missing. But thankfully, firms have got a bit more wise to this now and have stopped doing that by email. And most try to proactively warn their clients now that there is a risk that someone's going to try and target them and that they're not going to send any bank details by email. So the other thing is that if a firm was to routinely share its bank details by email or phone, again, you've got a risk of those that technique being copied and spoofed, and criminals would just use that. So this reason now, most firms tend to actually just send the bank details very old school on their engagement letter that they send out to their clients. They put the bank details in that at the beginning, which is great, except now money launderers have got clued up to this, are getting copies of the bank details for the firm, sending money in to the firm, saying, hey, can we have this back? The firm says, yes, we don't want that money, and the money comes back clean, and then they go, thank you very much, and they can move that money on to somewhere else, and that money is now clean. It's been laundered through the firm, and firms may not want to speak to their regulator about that, because obviously money laundering is a bad thing, so they might just want to keep that quiet and not talk about it. So this is going on, but probably no one will tell you about it. So in addition to all of this, you've got interest rates that are running at over 5%. Firms are under pressure to sort of return money to clients a lot quicker than perhaps they may have done in the past. And by not having bank details on file for their clients, sometimes firms are then struggling to return that money, and it's taking a lot of time to do that. So that's sort of the overview of where the sector's at. As a business, Safe Capital was designed to protect firms from having money nicked from their clients. We use open banking to enable payments so that they go from the client to the firm safely and securely without disclosing bank details. And also use open banking to obtain the client's bank details so that then if the firm needs to send money back later, they can do. And you've got that lovely loop where everyone knows everyone's bank details and can move money safely. So in addition, we also try and help firms educate their clients on the risks they face. And by using our services, basically firms are deploying a single gateway, which means all the money's going through one place and they can send that money back later if they need to. So that's what we do today. Unfortunately, there's been a lot of cases now where the money's going missing on the other side of things, where it's basically your hand in the till problem. So now we're seeing a lot of cases here where people actually within the firm are taking money. The largest case at the moment is this Axiomints case that's going through, where they've lost 64 million. The contingency fund, there's a contingency fund that all solicitors pay into to kind of cover losses. This is not going to cover this loss. Every solicitor in the country is looking like they're going to have to put their hand in the pocket to the tune of 500 quid to cover the loss of this one firm. And why is this? Well, it's all, as far as we're concerned, down to one simple fact. Client accounts are not fit for purpose. So our plan basically is for the next phase of growth, we want to leverage the strengths of banking as a service, combined with the stuff we've just been hearing earlier today about sort of ISO 20022. And use those things to make it much sort of safer and so much more transparent as to where money is and what's happening with it and where it's going, so that this stuff isn't happening anymore and that client funds are looked after.
Perfect timing. Thank you very much, Matt. Brilliant. More than a few questions here, but in the interest of time, I'll let the hot mic make its way over to the back left, if whoever's got it. Joe is springing into action.
Thank you. Thanks. David Parker, Polymath Consulting. This is, and please correct me if I'm wrong, a basic request-to-pay service using PSD2 banking infrastructure. And if so, there are, I can think of at least a dozen RTP providers in the market. Now, I understand you're targeting a particular vertical, but it's not very hard for any of the RTP providers to start providing this service to the legal profession. So why and how do you think you've got a market differentiator?
It's a good question. I think at the moment, because we're trying to wrap it into a service where we provide, obviously, if you know open banking, you've got certain things around that with limitations on payment amounts at the moment. So whilst it's a great solution for some payments, you still need to be able to provide the backup of just basically providing them bank details still at the moment. So we've built in a load of the fallovers and things around there as well. So we take the open banking payments, can still take card payments if the customer's not got open banking, and also built in the ability just to see the firm's bank details if they really still need to do that. So I feel like we've delivered a service built upon those basic rails that are there for the open banking, but beyond that, it's a way of containing all of these things within one service rather than having, payments over in one place, client bank details coming in from a different place. All of that stuff should be in this one central point. And as I was talking about, the idea that the banking as a service thing is going to deliver a lot more what we can add around payments, which is really going to help when we want to start looking at the movement of money from the firm back out. That's obviously a big side of things, and I was touching on the risk there as well from the hand in the till problem. And obviously there's a massive change coming in with this ISO standard around tracking money and what that means for source of funds and things around firms. So I just think there's a load of potential to build on what we've started with that is going to make us different than somebody who just wants to provide a payment gateway, because as you say, just a payment gateway is a payment gateway.
Thank you very much. What a way to end. Thank you, Matt. I said I couldn't walk, but I think that what we've seen this afternoon is worth springing to my feet for. I'm not going to say anything else. Nobody wants to see my face at this time. I won't even pitch. If you want the best PR agency in the market, come and talk to me, but probably not now, because you're all going to be, this is more important. Thanks again. I'll hand over to our hosts.
Thanks, Oliver. Final thank yous. It's just fallen to me to close things off for today. Thanks to all of you for sticking around. Obviously looking forward to enjoying a drink with you all as a bit of a reward for your endurance and perseverance there. Thanks obviously to our event partners, NCC Group, our headline sponsors, AccessPay, the University of Manchester, Mastercard, Rise created by Barclays and GFT. Also want to say thank you to Marqeta and Intercash as well for their wonderful support. Huge thanks to Ryan, Rachel, the FinTech North team, to Hirt, our musician, Andy, our AV guy, Julian, Oliver and Chris as well. All of you have helped make today a fantastic success. Our next big conference is going to be at the end of March in Liverpool. So I'd really welcome any more chats around speaking, sponsoring, all of that stuff. Hopefully we'll see you all again in the Northwest soon. And other things to mention are our feedback survey on Sticky as well. So if you've got any tips on how we can make our events better, any positive or negative feedback, please, we want to hear that. So yeah, scan that QR code, scan the Sticky, and we'll get your feedback in due course. So yeah, let's all have a drink. It's been amazing bringing you all together. Thank you.